a common shareholder. It's completely uncompetitive. But the reality is it happened. And it's happened not once, it's happened in the past too. They had an incident some years ago where the runway was blocked for a long period of time. And the only airlines that could fly in and out of Dubai was Emirates. Everybody else was shut off. The investment into airlines in India is completely open. People can come in. I think it's one of the most friendly policies in terms of starting up an airline. There's no barrier to that. People can come in and do what they have to do. But to have airports start an airline, I just think is a fundamental issue.
A quick check on the earnings action of the day. Adani Enterprises has reported a net loss of over 1,100 crore rupees in the first quarter. This is in comparison to a net profit of 885 crore rupees that it had reported during the same quarter last year. The net loss for the quarter is due to a one-time loss of over 2,600 crore rupees, which it paid as a settlement amount to the U.S. Office of Foreign Assets Control. Revenue grew 50%, while margins narrowed by over 400 basis points on an annual basis. Asian Paints has reported a strong set of numbers in the first quarter, beating estimates on all parameters. Net profit jumped nearly 40% year-on-year, comfortably ahead of the CNBC TV18 poll. Revenue grew 18%, also topping estimates. The paint major's decorative business posted healthy volume growth as well. FMCG giant Dabur's first quarter results came in largely in line with estimates. Net profit rose. Hello, good morning. You've tuned into CNBC TV18. You're watching Power Breakfast with me, Vinny. Along with me is my colleague Rachna as well. Rachna, very good morning to you.
Very good morning to you as well, Vinny. Let's start the show with headlines then. Tensions in West Asia continue. US launches powerful attacks on Iran after President Donald Trump threatens to hit back very hard over a ballistic missile attack on an American base in Jordan. Iraq condemns US-Saudi strikes on the country.
Indices on Wall Street see a sharp sell-off after the Federal Reserve held interest rates steady, with AI-related chip stocks adding to recent declines ahead of the quarterly reports from Microsoft, Meta and Nasdaq 100 index, marking an 11% drop
from its June record high.
Markets in the Asia-Pacific region also open largely lower, tracking cues from Wall Street. The GIFT Nifty is indicating a lower open for the Indian market.
Brent crude prices hold above the $90 per barrel mark, underpinned by the renewed fighting between the US and the Iran that threatened further disruptions to global energy supplies. Meanwhile, gold climbs towards $4,100 an ounce after the Federal Reserve left interest rates unchanged despite mounting inflationary pressures stemming from the renewed conflict in West Asia.
In key earnings, Eicher Motors reports a 21.4% rise in net profit from a year ago. Revenue surges 31.5%. Watch out for numbers from M&M, where raw material costs and higher EV mix is likely to weigh on margins. Also watch out for numbers from Bajaj Finance.
Those are the top headlines for today, but in terms of updates coming in on West Asia, we have a lot of Asia actually. We have updates coming in on West Asia where the uncertainty has increased, and that is why when you look at Asian markets, they've opened up a bit mixed as well. Taiwan index is strong gains, 2.5%. Look at the Hang Seng on the other hand. We're seeing 0.3% of decline coming in for Hang Seng. We have ASX 200, that is the Australian index, that's trading with cuts of around 0.3% as well. On the flip side again, today Kospi saw that recovery coming in. It opened up with gains of 4%, still holding on to that gains of 4.5% as well. Japanese index Nikkei also has opened up with gains of 2%. So while a couple of indices on the Asian market front are trading with cuts, most of them have opened up in the green. Now, yesterday, Indian markets, we did see a good trading session coming in as well. Nifty closing around that 24,250 level for the Nifty 50, 1% uptick. Nifty implied open today as of now is indicating a 63-point downtick. So that will be interesting to see whether we actually see a recovery coming in, or because of the West Asia tensions, we see that pressure continuing. Crude oil prices obviously seeing and trading around that $90 per barrel mark as well. So Rachna, it will be key to watch out for in terms of updates now that come in more in terms of West Asia and where we head in the trading session.
Well, speaking of updates from West Asia, then US President Donald Trump says Iran will be hit very hard after the IRGC launched a ballistic missile attack on US base in Jordan. Meanwhile, a drone hit a US-owned gas. About the attacks, this is what Donald Trump had to say.
I've been briefed. It's a little more of the same, but it's going to be straightening out. It's going to be straightening out. In the meantime, we're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but they tried shooting it last night. So we had 5 rockets shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement at some point, but we're going to hit them very hard.
Additionally, Trump said he wanted to add Iran to the tariffs list and not just for sanctions, adding that was pushed by Senator Lindsey Graham before he died recently. Elsewhere, Iranian media report 4 Iranian advisors were killed in joint US-Saudi strikes on Iraq. Iraq has condemned those strikes, warning they risk dragging the country deeper into the conflict.
Okay, that's the update on the West Asia front. But then what is happening in the world of commodities? How are metals moving? How is crude moving this morning? Let's go across to Manisha Gupta, who's here to take us through all of that. Good morning, Manisha.
Morning, and thank you for that. Well, I'll start with the Brent crude prices, where we did see a gain of 8% yesterday. So much so that we saw the prices gain up above $90 a barrel as well. But in the Asian markets, we've come off those kind of levels. That is because there's a data that shows that nearly 39 ships passed via Bab el-Mandeb Strait into the Red Sea on Tuesday. So that is much higher than 10 or 15 or 17 ships that we have seen going. So 39 is a good number, and that is the reason there is some easing in case of prices. Having said that, major of the other issues are still on. You have renewed fight between U.S.-Iran, the U.S. pledging strong response after attacks on U.S. forces in Jordan. And this really seems to be spreading right now because it is in Yemen, the Iran-backed Houthi rebels are making a blockade around Saudi Arabia. And then Egypt now has reported drone strikes on 2 natural gas vessels. So yes, there are concerns still continuing into these markets there. Having said that, because the U.S. Fed has left interest rates unchanged, the gold and silver prices have seen some buying come back. The markets will now watch out for the Bank of England, the European Central Bank, their monetary policy meeting. That happens in this week as well.
All right. Thank you so much, Manisha, for that update. Now, how will the overnight cues impact our Indian market? We have our research team joining in with how the trade setup looks like and the stocks that are likely to be in news today. First up is Hormaz. Hormaz, tell us all about the market cues that you are watching out for and tell us we need to watch out for today.
Morning, Rashna, and we are veering towards the gap down, but we look fairly better compared to how volatile the rest of Asia and the US markets have been. It's an important session today because of the fact that it's the Sensex monthly expiry today. We react to the Fed rate decision and the subsequent sell-off on Wall Street, and that is exactly why the 85-point gap down on the GIFT Nifty still looks better than the way Wall Street ended overnight. We also react to the 24,000 on the downside will be an important level to watch on the index, and if we do recover from the lows and we try to move higher from yesterday's levels, the 17th of July high 24,367, that's going to be the first hurdle to watch on the upside. For the Nifty Bank, it's almost been not talked about at all through the week, considering the outperformance from IT. You see that 57,500 level yet again on the upside. You see if there is any supply that is emerging from those levels. And speaking of IT, that continues to be the index to watch after that 3-day rally, and even in the sell-off that you saw on Wall Street yesterday, the Infosys ADR was still up 2.5%, mind you, so keep that on your radar. The stock I'll be watching out for, though, is Swiggy. The stock is up 14% in the last 3 sessions, reporting numbers today. That will be important to watch out for. Plenty of other results as well from Bajaj Finance, Mahindra & Mahindra, Tata Steel, Vedanta. So there's plenty to track today as well. Global cues, domestic cues. The oil markets are subdued as of now. They are not reacting to a lot of news flow that is coming in. Be interesting to see if that moves. But for now, the GIFT Nifty is indicating a gap down. Be interesting to see if 24,100 and 24,000 acts as a support.
Okay, Hormaz, we'll watch out for that, because in the last couple of minutes itself, from around 60 points decline, now we are seeing 80 points. So, 20 points decline there. So, where it's going to be headed is going to be key, and the support levels as well. But let's go across to Ananya, who's here to take us through the stocks to watch out for in the trading session. Good morning, Ananya.
Good morning. So mostly these stocks will be reacting following their Q1 results. So let me first start with Waaree Energies. Their revenue rose 79%, but EBITDA margins and profit missed estimates, with margins declining to 18%. Now, coming to Hexaware, they reported 6% year-on-year revenue growth and a 13% EBIT margin, but PAT declined 6% sequentially, and FY26 revenue guidance was cut to 6 to 7%, so that investors will watch out for this also. Bajaj Housing Finance, they delivered a strong quarter with AUM up 24%, disbursements up 33%, and PAT up 23%, although margins remained under pressure here, so that will be a key monitorable. Coming to MTA Technologies, they posted an excellent quarter with revenue rising 2.3 times, EBITDA nearly 3 times, and PAT around 4.5 times year-on-year basis. Acme Solar, they saw revenue rise 68% and profit increase 80%, supported by strong contract wins and new hybrid PPAs. Now coming to Dabur, they reported 3,760 crore revenue, 20% margin and 5% domestic volume growth. And then finally, coming to Oberoi Realty, they signed a Malabar Hill redevelopment agreement with an estimated free sale potential of around 68,000 square feet. So watch out for these stocks in today's trading session.
All right, Ananya, thank you so much for that. Finally, Sudarshan joins in with cues from the F&O space. Good morning, Sudarshan.
Good morning, Rachna. So we made a good start to August series, but the midweek fight is back, and that has led to a sharp increase in crude prices. Now it's back to the levels around $90 per barrel. But the positive part is the move we are seeing in the currency market. Rupee continues to appreciate against US dollar. That might provide a big support to banks and NBFCs. Now the level or range for Nifty 24,000 to 24,600. Anti-AI theme has been playing on for the last few weeks. Let's see if IT continues to support the market. But my major big bet would be on banks, considering the move we are seeing in the rupee. Talk about GIFT Nifty. At one point, it was flat, but currently it's down almost 80 points, 83 points as I speak. And FI's flow, they have been positive. They have bought both in the index future and in the stock futures. They have added long positions. They have reduced short positions. And now, longs exposure has seen a minor increase to 10%. Coming to the options data on the input side, 24,000 and 24,200 have seen maximum change in the open interest, while on the call side, 24,200 and 24,450 were the most active ones. So first support for Nifty would be 24,120. That's your 20 DMA. Next support comes around 24,000. First resistance 24,450 and next resistance comes around the recent high of 24,600. Some of the stocks that I'll keep an eye on, first one is Swiggy, has been seeing fresh long addition, and also today company announces the earnings. Max Finance amongst all the insurance names has been seeing fresh longs, and last one is KPI Tech after the Q1 earnings has been seeing addition on the long side.
Okay, Sudarshan, thank you so much for that. Those are the cues in the world of F&O. But on that note, we're going to step into a very short break. After the break, we'll come back and tell you cues that have come in from the Wall Street. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now, the U.S. Federal Reserve left rates unchanged for a fifth straight meeting at 3.50% to 3.75%, with a 9-3 vote that revealed growing dissent among the policymakers. Here out Steve Leisman, who's here to give us the highlights for this.
The Federal Reserve keeping interest rates unchanged at 3.5 to 3.25%. However, the vote was 9-3 with 3 dissents. Logan from Dallas, Hammock from Cleveland, and Kashkari from Minneapolis all dissenting, and the 3 dissenters preferring a quarter-point rate hike. Other than the notation for the dissent, the statement was exactly the same as last month, or virtually the same. It said economic activity is expanding at a solid pace despite elevated uncertainty. The source of that economic uncertainty is the conflict in the Middle East. It noted strong productivity growth and capital investment, as it did in the prior statement. It says job gains have kept pace with the workforce, an interesting statement that some economists said should have been modified because the unemployment rate fell, suggesting that is not the case. In any event, the statement says inflation remains elevated relative to the 2% goal, reflecting supply shocks, including in energy. And it ends with the terse statement once again: the committee will deliver price stability. That's it. It also adds that notion that they are going to maintain an ample reserve regime in the banking system.
And after 3 policymakers had dissented in favor of a hike, the Fed chair, Kevin Warsh, said he wanted a family fight and got it. Listen in.
The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight.
Well, that's Fed Chair Kevin Warsh on the internal dissent. But Wall Street ended sharply lower on Wednesday as investors worried that the Federal Reserve could be falling behind in the inflation fight after the central bank kept interest rates unchanged. The Dow Jones plunged more than 1,100 points, marking its worst session since April 2025. The S&P 500 and Nasdaq also closed lower. Now getting you the latest on Trump-related developments, we have Vinny, who's hopped across the wall in our special segment, Trump Watch.
Thanks so much for that, Rachna. But let's get up with that and get started with those updates. President Donald Trump has stood by a Federal Reserve Chair, Kevin Warsh, after the central bank held the interest rate steady, calling him fantastic and brilliant while placing the blame actually squarely on calling the Fed board more political and resistant to cuts as well. Now, Trump insisted that the U.S. would fight through elevated rates, pointing to record investment levels as proof that the economy remains strong. Moving on to the next commentary that we had coming in this morning, President Trump also defended Americans' light touch approach to AI regulations, arguing that U.S. holds a commanding lead over China. He said that Washington must be careful not to over-restrict domestic AI firms and risk falling behind Beijing, calling the AI race the defining contest of the era. Whoever wins with AI is going to win. Moving on to the next one, President Donald Trump called his White House meeting with the Ukrainian President Zelensky good, saying he directly asked Zelensky to end the war with Russia, and Trump described his approach as simple as he maintains good relationship with Putin as well as Zelensky, and said that the onus now is on Kyiv to move towards ending the conflict. Now, in the last post that we had that came in on Truth Social from President Donald Trump, he renewed his attacks on the Supreme Court and blaming it and saying the rulings against his birthright citizenship order, the tariff power, and all of those have lost US trillions and trillions of dollars. And it's the latest in terms of a running feud between President Trump as well as the US Supreme Court following these rulings that have come in earlier through this year as well.
Thank you so much, Winnie, for that update. Now let's slip into a break. We get you more news and updates on the other side.
Welcome back to Power Breakfast on CNBC TV 18. As of now, Asian markets, right, some of them are in the green, some of them are in the red. Shanghai is in the red, ASX 200 is in the red, while Nikkei, Kospi managing to hold on to gains, Taiwan Index managing to hold on to gains. But Nifty implied open, where is that moving, right? Because in a few minutes, we've seen an increase coming in. Now, from 63 points downtick, we're seeing an 87-point downtick. So for the Indian markets, maybe a gap down start is what we're keeping an eye out on right now. But yes, that's the update that we're keeping an eye out on in terms for the Indian markets. But in the big interview of the day, from a low-cost airline to now a dominant force in the Indian skies, Indigo's 20-year journey is one of resilience and cost efficiency. Now the airline is betting big on a global expansion, and here's a snippet of that exclusive interview and exclusive conversation that Shireen spoke with and had with the promoter, Rahul Bhatia.
1/3 of our production is in markets where nobody else flies. And it's not because other airlines cannot fly those routes. They can, but they choose not to. We keep getting badgered on our size and scale. What is not understood is what we are doing, which no one else is doing.
What changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
The next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India.
Are there limits to this lean, mean machine that you've operated for 20 years? And were those limits really tested in December?
December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. I think there was a confluence of several different things that came together, and then the cookie crumbled. You cannot have on the one side an aspiration for the nation as a whole to get onto the stage of global aviation and yet have its airlines compete with the rest of the world with an uncompetitive cost structure. If we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
All right, we'll get you more of that exclusive conversation through the day, but that's all we have on this edition of Power Breakfast. Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Thursday morning and the world's looking a little bit different compared to where we were yesterday. It's an all-boys team on Bazaar today. I'm Prashant. With me, my colleagues Mangalam and Nigel. Guys, hi. Morning.
Hi, morning. Good morning. You know, every time the market's moved in a certain direction, we often wonder whether it's going to break out or break down this time around, only for the news to turn around and for us to stay in that range that we have been in. Yesterday, the up move was so much that we thought maybe this time around it's for real, where you go above the 24,300, 24,500 sort of mark. And the week before, when we were breaking down, we thought maybe this time around we're going a lot lower. But turns out maybe the price moves in the range and the news moves around it.
Provided Brent crude prices remain subdued, I think that's going to be music to the ears of the bulls. But clearly the visuals and the commentary overnight wasn't very, very great on the geopolitical front. And the Fed did, I think, what the markets wanted.
Absolutely.
They paused.
Absolutely. They paused. But, you know, it's a bunch of things, right? Take a look at where we start. And it's two things, right? Oil's back near 90, 89.4. And the Fed's kept rates unchanged. So those are the two big cues that we are starting with this morning. You know, the U.S. market session was pretty interesting. Actually, the Fed decision came. U.S. markets rallied for the 1 hour after the Fed decision and the statement, by the way. And then towards the end, markets sold off. So people are scratching their heads and wondering, well, what happened? I mean, actually, the S&P was up about almost 1%. That was an immediate reaction, or actually the post 1 hour reaction to the Fed and the Fed statement and all of that. But then there was a sell-off, and we closed near the session lows. It's more to the same. The Philadelphia Semiconductor Index, that's the SOX, basically down about 5.5%. You know, chip stocks, AI stocks, all of that stuff came down pretty hard. Now, you know, two explanations that people sort of, you know, pointed to. One is, of course, the big move in the long end of the U.S. bond curve. 30-year, 10-year, 11, 9 basis points. These are big jumps. But what led to it? Was it oil? Because oil prices had started to move up. Because around that time, you also had reports which came in that a drone had hit a US-owned gas storage tanker in Egypt. So it was a bunch of things, right, which all kind of happened together, which... and then, of course, when people started to look back, whether did we miss something as far as the Fed is concerned, whether, you know, there was a clue to what perhaps they're going to do next and all of that stuff. But I think it's more a few things coming together at the same time. And of course, I mean, there was a Trump comment which said we'll be hitting them very hard in response to, I mean, the so-called surprise attack which Iran had launched against U.S. bases in Jordan. So that was the Iran and the U.S. bit per se. Now, as far as the Fed goes, they've kept rates unchanged, nothing, and so it's in line largely with expectations. There were three dissents, basically hawkish dissents, who said, well, perhaps rates should go up. And I mean, you know, the Warsh press conference was, oh boy, something else. He said a lot. He sounded very firm, but he said very little. So go figure. This comment will come up on your screen. He basically said, let me reiterate, this perhaps is the one thing, right? Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only one target, and it's 2%. The point is the Fed, not under Kevin Warsh, but I mean, over the last two Fed chairs, has missed inflation target, that 2% number, for what, 4-5 years now. You know, but as I said, you got to go watch it. I mean, on YouTube, and it's there on the CNBC TV 18 YouTube handle. The questions and the answers. I mean, the art of not saying anything at all while saying a lot of stuff, and you know, quite incredible in that sense. The doubt is, for many people, the doubt is whether, I mean, remember the Kevin Warsh in his first meeting appointed these 5 committees to do a complete overhaul of how the Fed works, does, targets inflation, etc., etc. Are those just a cover to basically change this 2% number? I mean, you know what, because I mean, that also came up during the meeting. Anyway, just to come back to US tech, Meta was down 10%. They gave a disappointing revenue forecast for the quarter we are in right now. There was Microsoft, which was up about 3% the last I checked after hours, beat on key metrics, including the cloud revenue for Microsoft. And of course, Apple and Amazon will report numbers later today. It's been a tech-heavy week. It will remain like that. And every day I've been putting out what US tech has done, right? I'm talking about US software tech has done. And look at the changes. This is last night. Cognizant, 11%. Accenture, 5%. EPAM and Globant, about 6.5% and 8.5% respectively. I started this Monday by saying that, and if you remember, people like Naren and others have all made the point that, how do you figure out whether, tech is starting to turn? You watch what these companies are doing in the US, because you'll see it there first. And perhaps there could be a rub-off here. The rub-off has been very strong here in India as well. Every day the indices, the IT index has moved up. It's off quite a bit from the lows. The question still remains, is it just a tactical rebound or is real long money moving in? So I think we'll keep debating all of that, but this is the handover from last night as far as US software is concerned. So for IT, this is a good read-through once again. I'll just leave you with levels. Resistance at 24,200 and 24,500. Just fine-tune these levels basis the big rally that we've had yesterday. And the trailing support will come in at about 24,134. So those are levels to work with. GIFT Nifty, I think, is indicating a lower start, but not a disaster. 100-point lower start, 0.5% or so as far as the open is concerned. Nigel has walked across to the wall with the F&O cues, the positioning and more. Nigel, take it away.
Well, the GIFT 50 is suggesting we pull back 100, 150 points odd, and at lower levels, there could be some interest that will creep in. I say that because, the GIFT 50 is pulling back on news that crude oil prices have spiked up. But I'll tell you what, in the last hour or so, it's cooled off yet again. Remember, crude is reacting to commentary coming in from Trump. This is saying that he's going to be hitting them hard. There have been some strikes as well. So that's why crude oil prices did spike up, and then it's cooled off a little bit. The US yields as well have moved up in reaction to Fed's verdict that we saw overnight. But Brent crude prices again at around $89 per barrel mark. And if you get 100, 150 point downtake, the bulls will believe that, in fact, they would like to get into this dip. That's the sense you get going by yesterday's trading session as well. The flows, they were positive. Both the FIs and the DIs they bought. In fact, the FI buying was quite healthy in trade yesterday. And as we made this point yesterday, if you look at it in the month of July itself, they have turned buyers, which is heartening after quite a while. But clearly, there was a big bout of short covering that took place yesterday. The Nifty Bank moved up, and the open interest on both those two were down. And that perfectly tallies in with what the FIs did, both on the index as well as on stock futures. Let's pull up the index futures first up for you. They covered close to 9,000 contracts, and they added close to 1,000 contracts. So that's a 10,000 swing factor that took place yesterday. The short positioning continues at around 90%. However, you need to keep in mind that, in fact, in absolute terms, those number of shots in the system are actually lower. But clearly, we're moving up on shots that are covering out. And even yesterday's trading session, just take a look at it. On stock futures, we did have shots that covered out close to 67,000 contracts, though the FIs have remained net long on stock futures itself. But clearly, shots covering out. What's heartening to see is the kind of put writing that's come about. And in yesterday's trade, you had close to around 10 puts that were written for every one call. And that's what caused the PCR to move up to around 1.2 or thereabouts. Remember, the upper end of the range, it's at around 1.5, which is a distance away from here. But the put writers are back into play, 24,200, 24,000 put. You put it together, close to around 1 lakh shares were added at both those two strikes, which is telling you at lower levels, the bulls will want to come in to fight. So if you look at a broad range, well, on the downside, it's at around 24,000 odd. On the upside, the resistance comes in at around the 24,500. However, on the way on the downside, you have this 20 DMA, which by the end of today, you won't want that number to actually break on the downside. So we'll keep an eye out on this. That's the broad range that you're looking at. The Nifty Bank, yes, it showed signs of coming back to life, but it's at a very, very crucial juncture right now. It could start off on the back foot, but the 20 and the 200 DMA, those are the marks that you're looking at for it to conquer on the upside, and then you could see a bigger short covering bounce that plays out. So interesting session. Start off on the back foot, but let's see whether or not that dip gets bought into.
All right, start off on the back foot. Let's see whether the dip gets bought into or not, and it will all depend on how the other markets behave as well. This morning, Korea is actually up nearly 4%, and that's led by a 7% up move that we've seen in Samsung. Good numbers coming in, revenues doubling, over 130% gain is what we've seen there. Alongside that, we've seen a near 18 times jump in their operating profit as well. So the Nikkei as well as the Korean indices higher this morning as well. Remember, they have been underperforming for the last month or so. The US Federal Reserve left rates unchanged for a fifth straight meeting. at between 3.5 to 3.75%, with a 9-3 vote revealing growing dissent among policymakers. Remember, the same time last meeting, it was a unanimous decision to hold, and now it's 9-3. After 3 policymakers said they dissented in favor of a hike, the Fed chair, Kevin Walsh, said he wanted a family fight and got it. Listen in.
The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight.
A real family fight indeed. We do have Ed Yardeni, president at Yardeni Research, joining in. Ed, what do you make of the Fed's action yesterday? Obviously was pretty much on expected lines. But the commentary that came in from Kevin Walsh, the more we hear from him, the more we don't know where he stands.
Well, I think we actually do know. He keeps repeating over and over again that he wants price stability, and he in the last FOMC meeting, the statement that came out today, the last statement in that document said that the committee will deliver price stability. So he said that this time. He said that in the statement last month. He said that same thing in his press conference last month, and yet he didn't deliver. And he said, we're watching and thinking about it. And the bond market did not react well to that at all. And I think he just kind of lost some credibility here because what's he waiting for? I thought that he really should move by 25 basis points. Maybe he couldn't get the votes. There were certainly 3 dissenters that wanted to raise the Fed funds rate. He could have been a dissenter, but that would not have looked very good if he had been. So maybe he was pushing for a rate hike and couldn't get the votes. But so far, I would say that the bond market is not giving him a vote of confidence.
Exactly my point, because, I mean, the more he speaks, we know where he stands, but the actions suggest otherwise, and which is why the more we don't know, which is...
Yeah, exactly. He's saying one thing and then not doing it.
But is he saying anything at all, Ed? I mean, just look at this, right? The question was, at the press conference, this is verbatim. The question was this: if inflation is too high and not coming down, is the best remedy to raise interest rates? His answer, again verbatim, is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution, but I wouldn't say it's in isolation. I mean, it's a straight answer, right? This is a what do you call it? A word salad.
Yeah. Yeah, look, so far I have to say I'm not impressed. This fixation with not providing any guidance. I mean, already we know from the Fed presidents, the regional Fed presidents, are going to keep giving speeches. And so we're going to get plenty of guidance that way. And the other thing I would point out is what he's really saying is, like, the Fed shouldn't influence the markets. He's saying the Fed should not be data dependent. He wants the markets to be data dependent, not Fed dependent. And then he wants the Fed to listen to the markets and to react accordingly. Well, he's not listening, because the 2-year Treasury note right now is 75 basis points higher than where the Fed funds rate is. And it's basically, the 2-year note is saying that the Fed really needs to reverse those 3 rate cuts that happened at the end of last year, because the rate cuts really weren't necessary. So right now, as I said, he's got at least in my mind, he's got a credibility issue.
Yeah, absolutely. The sell-off coming to markets, right? And so just to complete that loop, bond yields all jumped, 30-year, the 10-year, the long end basically jumped. Right. And that's basically the bond market calling him out?
Absolutely. I coined the phrase bond vigilantes back in 1983, and he's basically said that he's going to listen to them, but he's not listening to them, and the bond market reacted accordingly. What I think is that you have to raise rates to lower rates. You have to raise the federal funds rate in order to bring the bond yield down. The bond vigilantes want to see that the Fed is going to be vigilant about inflation. And the bond vigilantes right now are saying, well, the Fed didn't do it at this meeting, so we're going to be even more vigilant. And so now we've got the 30-year bond yield at 5.2%, which is the highest has been in many, many years.
The chip stocks, right? The stocks, the Philadelphia Semiconductor Index, 5% again. I don't know how much we're down this week. Must be 10, 15%, right? How do you read it? Where are we in terms of this pullback?
Yeah, well, whenever you look at a stock chart and you see that the price has gone straight up in a very short period of time, almost always you can anticipate that there's going to be a move straight down. The only question is how far down? Is it a correction? Is it a bear market? Is it going to have any fundamental impact on the company or on the industry or on the overall market? And what I see is that the earnings story has been phenomenal for semiconductors, and even for the hyperscalers. The cloud computing data shows that a lot of demand for computing, and I think these hyperscalers have concluded that they wish they already had that capacity because they could make even more money. So I'm very encouraged by what I'm seeing here, in the sense that I don't mind having a sell-off in the high tech area, which actually is creating buying opportunities because the earnings are holding up very, very well, and the valuation multiples are getting to the point where these stocks are just downright cheap.
I see. So you're not in the camp that this is over, this is done, this is none of that, right?
None of that.
Directionally, this is a good buying opportunity.
Yeah, it's a good buying opportunity. I think there's clearly some craziness in the market in terms of its volatility, but if you got the stomach for it, I would say this is not, you're not really catching a falling dagger and hurting yourself. I think these are good opportunities.
Got that. Ed, we'll leave it there. Thank you very much for joining us. Always great chatting with you. Appreciate your time here on CNBC TV 18. Well, here's what you'll see coming up in the program. 8:35, the management of Quest Corp comes up on their quarterly performance. 9 o'clock, Abneesh Roy of Novama will be with us. Spotlight on FMCG. Amisha of BofA Global Research will be a market master of the day. Markets and more. 9:30, the management of Prestige Group talks about Q1. Sirma will be with us at 9:40 on their quarter gone by. 9:50, Vinity Organics on Q1 numbers again. It's a full-on earnings treadmill. Lata discusses the Fed's rate trajectory and the recent equity market slide with Jahangir Aziz at JP Morgan. So that's the lineup coming up. Okay, we'll take a break. Top stocks to discuss, top stocks to watch on the top 10 list with our research team coming up in just a bit.
Welcome back. You're watching us here on Bazaar Morning Call. The Gift Nifty indicating a 100-point downtick to kickstart things. Now it's ameliorated to about 79 points. The question is whether this dip gets bought into or not. But a lot of stocks on our radar as always, a lot of earnings. Our research team standing by with the CNBC TV18 list of top stocks for the day. Let's go across to Sudarshan first on Eicher Motors. Sudarshan.
Good morning. So the bullet run and top gear speed for Eicher Motors has continued even in Q1 FY27, and that's reflecting in the volume growth that company has seen. It was up 24% YY, and that has led to company reporting revenue growth of more than 20%. If there is a bit of a concern, that's the gross margin because of heightened raw material cost that company has seen, which has impacted gross margin in the range of 4 to 4.5%. It was partially offset by value engineering and the price increase that company had taken in the month of April, but the offset was very minimum of just 1.6% against 4 to 4.5% increase. But talking about the headline numbers, revenue, as I told you, has seen an increase of 31%. EBITDA too was up 32%, and margin has come in at 24% versus 23.9%. And input cost 4 to 4.5% increase. And company is also looking to refresh the higher models above 350cc, and that's 450cc and 650cc, looking to up the capacity, and they are going to invest more than 1,200 crore on the plant. But on overall numbers and the outlook, I'm going with light green. But make sure that most of the positives are priced in Eicher Motors stock.
All right. Thanks a lot for that, Sudarshan. You went 450, 650. I was hoping that they speak about the 750 because I'm a buyer of the bike. But Mangalam, tell us about Dabur. How are the numbers?
Buyer of the red toothpaste. That's all I can afford. But, I'll tell you what, it's largely in line, these numbers which have come in. Domestic volume growth 5% versus 6 to 8%. Now, this is a trend that we've seen across a lot of the large companies where, it was a mild miss on the volumes, but nothing really to complain. Look at the revenue. 3764 crores. The poll was 3770 crores. EBITDA 741 crores. The poll was 742 crores. Net profit at 586 crores. The poll was 573 crores. So pretty much in line with what the expectations were. And the company had given the cheat sheet already as well. What stood out for me is that the company said that rural outperformed urban markets for the 8th consecutive quarter, even as the urban is now picking up. So the gap between urban and rural is narrowing, not because rural stopped growing, but because urban's come back as well. They target double-digit top-line growth in FY27, however, with pricing more than volumes, and that will be a big positive trend across all the staples this time around because price growth has come by without a big decline in the volumes. While there may be some pressure on volumes due to higher inflation, pricing growth will more than make up for it, and FY27 margin should continue to expand via price hikes and cost control. The stock ended about 2% higher yesterday, seeing a mild green on that one today as well. But Bajaj Housing France, that's the other one that reported numbers. Ananya joins in with more.
So yes, it was an operationally strong quarter for them, we can say. If you look at the business growth, AUM rising 24%, disbursements up 33%. And if you look at the core operating profitability, it was 23% up YOY. It was supported by strong business growth and exceptionally low credit costs here, while asset quality remains a key strength with stable GNPA and NNPA and benign credit costs. Now, margins was a key highlight. It remained under pressure with NIM declining as higher yield legacy loans were replaced by lower yield new originations, and management expects this trend to continue through FY27 also. Now, management also said that the overall housing market remains in a stabilization phase with near-term demand still somewhat muted, but highlighted that the company continues to gain market share through broad-based growth and expansion in the near prime and affordable housing segments. Now for FY27, the company maintained guidance of 21 to 23% AUM growth, 20 to 25 basis points of NIM compression further, and 10 to 15 basis point of credit cost. So also valuation remains stretched here, and market is expecting better growth for Bajaj Housing going forward.
Yeah. Got that. Thanks very much, Ananya, for it. Well, let's just talk about Hexaware Technologies, which perhaps also reacts to numbers. Vinny is here with details. Vinny, morning.
Hi, good morning. So for Hexaware, Q2 calendar year 26 numbers largely in line. But where the miss is coming in or where the worry is, calendar 26 guidance that's been cut. Now, dollar revenue that's up 4% QOQ, 6% up YOY. EBIT margins have come in at 13.6% versus 13% QOQ as well. And profits, that's seen a decline of 6%. Now, in terms of deal updates, deal momentum, what has the company highlighted? That Q2 witnessed strong deal momentum. They saw wins coming in across outsourcing, transformation programs as well. And increased deal momentum especially came in for deals above the $10 million mark as well. So that was interesting. But guidance, they've cut the revenue guidance in the range of 6 to 7% is now the guidance versus the earlier guidance of 7.6%. What is the main reason for this cut in guidance? They said that there is a delay in terms of deal ramp-ups, and a worsening macro is a bit of a worry for them still. So that is why they're reducing the guidance to 6 to 7%. Also, this includes a 50 basis point reduction coming in because of the CP rebadging deal as well. So because of that, there is a further guidance cut come in here. EBIT margin guidance, they've maintained it in the range of that 13 to 14%, but revenue guidance cut, and that is why red expected on the screen.
All right. Got it. All right. Thanks a lot for that, Vinny. Well, let's go across to Sudarshan. He's here to tell us now about Balkrishna Industries. Sir?
So the leader in off-highway tires segment, Balkrishna Industries, has come out with a very strong set of numbers, and the main reason is the sharp increase that company has reported in the overall volumes, which has seen an increase of more than 16% versus our expectation, or say brokerage expectation of an increase in the range of 10 to 12%. That has led to company reporting revenue growth of more than 24%. EBITDA has seen a jump of 7%. Like all the other auto companies and auto ancillary companies, this too has seen a dip in the margin, and that has come at 20.6%. versus 23.8%, but on the margin front too, it's in line with the expectations. And OHT, that is off-highway tires, contributes 90%, and carbon black 10% to total volume. Now, going forward by FY30, company is looking to increase revenue growth by 2.2 times, and also they have given other targets for 2030. But on the basis of Q and FY27 numbers, I'm going with green.
Got it. All right. Thanks a lot for that, Sudarshan. Well, Ekta's tracking a couple of companies, Piramal Pharma as well as Syngene. Hi, Ekta. Morning.
Morning. Well, I'm going to start with Syngene, which was a very disappointing set of numbers. The earnings this time round were impacted mainly due to a lack of offtake from a major biologics client, according to the company. So we had revenue, which declined 16% year-on-year. Margins came in at around 12%, which was multi-quarter low, and a 9 crore loss for Syngene this quarter. Guidance, they expect a decline in first half of FY27. They expect the momentum to improve in second half. FY27 still guiding for a single-digit revenue decline and margins in mid-20s. Kiran Mazumdar-Shaw will take on a role of executive chairperson, and remember that this is the first quarter with Siddharth Mittal as CEO. Call is at 9 a.m. So more details then. Piramal Pharma revenue was up 17%, margins 8.6%, some improvement on a year-on-year basis, and a decline in terms of the loss on a year-on-year basis. CDMO, complex hospital generics, all three of the segments did increase. The company said they're seeing healthy requests for proposals and looking forward to sustained revenue growth, margin expansion through FY27. So expect the stock to probably see some mild green. Commentary from the call at 9:30 a.m. this morning again will be key.
Indeed, Ekta. Thanks a lot for that. Let's go across to Ria now on MTAR Tech. The stock's been a bit of a downtrend over the last month or so after a big surge that we've seen. Ria?
Well, yes, this time around, MTAR Technologies has reported a very strong quarter. It's a beat on all fronts, in fact, and this has been driven by strong execution across business verticals of the company. Now, in terms of the revenue, that has gone up by 130% compared to an estimate of 104% increase. EBITDA also up nearly 200% compared to estimates of 150% growth. Margins also expand sharply by 540 basis points to 23.6% in this quarter, and the net profit is also seeing a significant rise of 348% this time around, 250 crores versus just about 11 crores of net profit that we saw in Q1 of FY26. Now, the thing that stands out here is the order book, right? Because the order book has crossed 5,143 crores, which has already crossed the full year order book guidance of 5,000 crores that the company has given. So today, in the earnings call, that will be key to track whether the management ups the guidance and what the overall execution cycle for this will be. And apart from this, they have also retained their FY27 guidance for the revenue, which will be 80% growth on the revenue front, and EBITDA margins at 24% for FY27. So strong quarter overall for MTAR Technologies. Today, the stock is expected to react positively.
Got it. All right. Thanks a lot for that, Ria. Well, Vivek's going to wind this down with a couple of renewable energy plays, Vari as well as Acme Solar. Vivek?
Well, good morning. Vari Energies will be in focus. Slightly subdued operational performance when you're talking about the revenues. Across the board, it's a bit of a miss as far as what the consensus was pricing in. A couple of one-offs as well that will be very important to track. So revenues, although it's higher by almost 80% on a year-on-year basis, EBITDA jumped up 44% on a year-on-year basis. But this time around, the EBITDA has a one-off item where the company has recognized income in relation to a refund of reciprocal duties. This amounts to almost 350 crore. Excluding that, the EBITDA margin dip is quite significant, but the EBITDA margin that the company has reported is at 18.2%, profitability higher by 14%. Now, in terms of the order inflows, continues to remain quite robust, 16,000 crore worth of order inflow, order book quite healthy at over 61,500 crore. Now, interestingly, the company has maintained the FY27 operating EBITDA guidance of 7,000 to 7,700 crore. And when you're talking about, the module production this time around, it's been slightly subdued on a sequential basis, 3.2 gigawatt versus 4.2 gigawatt on a sequential basis. Now, UBS has gone ahead and done the calculation in terms of the adjusted EBITDA. They're saying that excluding the 350 crore tariff refund that the company has priced in, margin was just around 14% versus 18.6% on a sequential basis. So it's a sharp dip on a sequential basis. Now, talking about Acme Solar, very good set of numbers. Revenues highest by almost 68%, led by increased power generation. EBITDA up by 60%. Margins are strong at a little over 85%, with profitability higher by 80%. The company managed to commission 2.3 gigawatt hour of BESS, which led to increased top-line growth.
Right, Vivek, thanks a lot for that. In fact, on that note, we'll thank the entire team for stopping by and giving us all the stocks that we need to watch out for in today's trading session. In case you've missed that, let's give you a recap. Stocks with positive news flow: Eicher Motors, good numbers coming in; Dabur, broadly in line; Balkrishna Industries, Piramal Pharma, Entar Tech, Acme Solar, all of them in the positive. Whereas stocks with negative news flow, we have the likes of Hexaware Tech, Syngene International, and Vari Energies. A mixed view on Bajaj Housing Finance. With that, let's go across to Manisha, who joins in with a roundup of all the action coming in from the commodities market. There was a mild spike in crude overnight, Manisha.
Oh, yes. It has been quite a volatile last 24 hours, by the way. Yesterday, we saw 8% of gains in the crude oil prices. We traded above $90 a barrel. Slight profit taking right now, and that is because there have been reports that there are ships passing via the waterways. 39 ships have passed via Bab el-Mandeb straight into the Red Sea on Tuesday. It's much higher than what we've been looking at numbers earlier, between 10 to 15 to 19. So 39 is a stronger number, and that is the reason there is some easing in case of prices. But the fact that we're still holding around that $90 a barrel is because the U.S. has led strong response after attack on U.S. forces in Jordan. Tehran continues to insist on maintaining control over Strait of Hormuz. And this whole thing now, Steve, seems to be spreading around because Egypt, for the first time, has reported drone strikes on 2 natural gas vessels, and that is keeping the prices on the higher side. Apart from that, the markets are reacting to the U.S. Fed meeting, where the rates have been unchanged, and we have seen gold, silver, copper, zinc, all of these metals come back as the dollar index comes off slightly in the markets.
Manisha, thanks very much for that. So that's oil in focus. Questcorp management on the other side on the first quarter performance as the first management this morning.
Welcome back. Hope you're having a good morning. Well, let's get to a first management on the show. Quess Corp. That's the one that we're looking at. Reported actually a pretty good set of numbers in first quarter. The best growth rate that we've seen in the last 2 years. To discuss this, what went on in the past quarter, what's the vision ahead? Mr. Lohit Bhatia, the CEO and Executive Director at Quess Corp joins us. Hi, Mr. Bhatia. Good morning. And thanks a lot for joining us here on CNBC TV 18. Well, let's get a couple of broad numbers out first. The revenue growth, as I mentioned, was looking quite strong at mid-teens. What kind of an outlook do you have for the year? What kind of growth rate? And also, is there any further upside to the margins or will they continue around this 2% odd band?
Very good morning and glad to be on your show today. This was a very, very symbolic and an important year for us. We completed 10 years of our original IPO since 2016. This was one full year that we completed the 2 demergers out of Quess Corp and 2 new listed companies were born. And Quess, by that standard, became a RemainCo company, which is focused towards workforce management. As a company, we were looking at 3 distinct tracks. And first, I'll talk about briefly the numbers, and then I'll come into the tracks. The revenue, as you mentioned, is up 15%. We came in at 4,182 crores for the quarter. If you look at the EBITDA, this has sharply increased by about 21%. But even better was the PAT number, which is up 61% at 82 crores, giving us an EPS for this quarter at 5.5. As a management team, post the demerger, we were very, very clear that foundationally, as Asia's largest workforce management company from India, we wanted to deliver a strong set of numbers and build on our foundation of talent and technology. Today, as you know, India is at the forefront of talent and technology both.
Right.
Mr. Bhatia, running a little short on time. So, our audience as well as your shareholders and the viewers would like to know what's the outlook. You made a fairly decent point out there. But could you help us out growth rate as well as margin outlook?
So for ourselves, we've created a 1+3 year roadmap ahead of us. And as an organization, we would like to continue delivering 10 to 11% as far as headcount growth is concerned, between 13 to 15% on the revenue growth, and 19 to 21% as far as PAT growth is concerned, consistently for the next 4 years. We also want to build, and that's the point I was making, we wanted to double down on 2 clear, distinct functions for the company. One is obviously we are a volume and a scale player. That gives us high operating cash flow and free cash flow. It also gives us a high ROE. But using that capital, we want to build on higher margin tracks for the next 4 years. One of which is the Japanese corridor that we've already announced in the month of June, and work has already begun there. The second is obviously the track on technology and skilled workforce deployment, both for India as well as the international markets. As far as your question on margin is concerned, last year we started the year at 1.8% and we ended the year at 2.2. We've started this year a shade over 2%. But we are very confident that this will inch upwards as we go into the year. For us, our medium-term target is to get to 2.4 to 2.5%. Long-term target, which would be 4 years and beyond, would be 3% and more.
Got that. So that's helpful. 13 to 15% is the revenue growth, which you're aspiring to, and 19 to 20% is the profit growth, and margin guidance is 2.4%. That you'd like to get to. Lohit, I think that's what shareholders want to hear, and good to see you on the program. Just a slightly off-the-cuff question, but maybe quite relevant for those who are watching as well. Which are the most in-demand jobs, Lohit, in terms of software right now?
So for us, obviously, it's a very, very large portfolio. In terms of software, our biggest deployment goes towards GCCs at about 71, 72%. Today, within GCCs, digital transformation is at the heights. Some of the GCCs have gone into IP creation as well. So while on one side, you will see a lot of existing AI services work, cybersecurity, data, cloud, analytics, and mobility. But we are also of late hearing of new skills coming into India in a big way, which is blockchain as well, especially for the banking sector, which wants to operate out of India using, the kind of technology talent that India has.
Okay, Lohit, we'll wish you all the best of luck, and those numbers are strong, solid. And we'll speak again. Thank you very much for joining us and coming on this morning here on CNBC TV 18. Deepan Mehta is with us of Elixir Equities. Deepan, good morning. Good to have you with us here on the program. I don't know if you have a view on Quest, but I mean, of all the numbers that our team put out earlier in terms of result earnings, what stood out to you the most?
Oh, good morning, Prashant. Thank you for having me on your show. I just missed the first part, so I don't know which are the numbers that your team put out. But talking specifically about Quest, I think that, this company which has really underperformed in terms of its potential. And I thought that human resource management and outsourcing of providing outsourced services would be a great business. But somehow I think so many acquisitions they have done so many corporate actions that hopefully now I think things are stable and we would evaluate the business on a steady state basis. Valuations are attractive, but somehow the growth rate which we expect from a business like this is just not happening. I thought you would see a good shift from unorganized to organized, but that also is not evident. They do have a few good quarters, but the top line doesn't move up as much as at least what I expected. But maybe now I think things are stabilized and valuations are attractive. So hopefully you may see good earnings growth as well as good returns from companies like S4.
Let me ask you one specific name, MTAR, is going down, limit down, right? And we had Renu Baid of IIFL yesterday. This is, selling off because this AI sell-off in the US, and they are suppliers to Bloom, which is in turn dependent on this hyperscaler capex, etc. I think that for almost from 9,000 stocks at about 5,000 now. And I was looking at IIFL's estimates. They're saying, well, they do 400 crores in profits in FY29. That's day before yesterday that was at 40 times. I think it's a little lower now. But your thoughts, if you have a view? MTAR went up like a rocket.
Prashant, I'm watching that stock like a hawk, and at some point of time, it's going to get into a sweet spot where certainly you can consider taking a nice long-term investment in the company. Because end of the day, okay, the AI trade may be, falling apart, but the investments are going to keep on continuing. Commitments have been made to set up data centers, and data centers are required, I think, for AI, for even the way the growth is there and the data consumption. So that's a given. And MTR's position in the entire ecosystem also is phenomenal, and they're expanding capacity. They're entering into new product lines as well. So this is the perfect time. I think it's actually a prime example that you have a high growth business. If you didn't invest in it first, it just went out of hand. A multi-bagger stock, and now that it's corrected as much as it has, and if you still feel the fundamentals are strong, the growth story is intact, then this is the opportunity to get into a stock like MTAR, where the valuations become reasonable and the company has a great business. It's the perfect, I would say, recipe for getting good return from a stock, which I think now everything is known. Only valuation was the problem, and now that also getting correct.
All right, take that point. Thanks a lot, Deepan, for joining in. What we'll do is ask you to stay on because we take a short break, come back on the other side. We have an exclusive conversation with Rahul Bhatia, the MD of Interglobe Aviation. Perhaps ask Deepan his view on Indigo as well as it completes 20 years. Stay tuned for that.
Welcome back. There's 15 minutes to go for the pre-open session to kick off. Now, from a low-cost airline to now dominant force in Indian skies, Indigo's 20-year journey is one of resilience and cost efficiency. The airline is betting big on global expansion now. In a rare television interview with my colleague Shireen, Rahul Bhatia said that India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines. Listen in to a slice of that interaction.
1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in. We only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure, we are able to experiment and the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing for the sake of the country.
Let me ask you now about, beyond the international bet, what are some of the other priorities that you intend to focus on? I know, as you look at expanding both domestically as well as internationally, what changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
I think Indigo's journey over the last 20 years was all about building an extensive domestic network. We are not finished doing that. We will continue to do that. That will remain the core of the airline. But having built this network, the next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India. And that's something which, for reasons I probably prefer not to discuss, was handed over to airlines and geographies outside of this country. With that, there was a lot of export of economic wealth from this country to airlines that don't reside here, and we're carrying Indians. I think there's an immense responsibility on our part as Indigo and on the part of airlines like Air India to bring all of that back. So that's our sort of next step. And I think we are well positioned to do that just because of the domestic network. We're able to collect people into a hub and then fly them on bigger planes to other parts of the world. So that's really what we want to do as stage one. And there will come a time at some point in the future where we will, once see the airport hubs sort of mature, where we will carry customers from one geography to another through India. They don't necessarily have to be our customers, but I'm taking an example, somebody from the UK to Australia. I think once we build our network and once the airports are transit friendly, we see that happening.
Is that a decade journey?
I think phase one is certainly more than a decade worth of journey, but in that you'll start to see tricklings of what we call sixth freedom carriage.
Well, you don't hear Mr. Bhatia very often, and he sat down for that full interview. We will play more sound bites out of it, the full interview later. But that is the top boss at Indigo with some perspective of where the airline is going. Deepan, it's been an astounding wealth creator, right? You compare it to global airlines and you look at the fleet size, etc. Indigo is what, 400, 450 planes. And it is the or maybe the second most valuable airline company in the world. So for shareholders, it's been quite incredible, isn't it?
Yeah, it has been, but last 3-4 years have been a bit disappointing, and I speak as a shareholder as well. But look, Indigo is not slowing down. its market share is not going away anywhere. In fact, every quarter it inches up by 2-3% or so. And now that SpiceJet also has got certain challenges and there's no new player, I think that this kind of a market share is dominant market share will remain for some more time. Just valuing this company is a bit difficult, but the way I have worked out is that in March 24, which was like a blue sky situation for Indigo, they made 8,000 crores net profit. And from March 24 to now, they must have increased the capacity, what, 40-50% or so. So if you go back to a situation where the aviation fuel is under control, the forex rate is also stable, then I think this company can do what, 16,000 crores of net profit, easily possible. And 2 lakh crores, that gives a market, that gives a P multiple of less than 20 times also, which is very reasonable for such a dominant business and such an important industry. So it's for investing in Indigo is not for the faint-hearted, and you have to have a really longer-term view, 3 years, 5 years or so. And this company can give very good returns, but you need to remain invested.
Got it. Okay. All right. Quick question, Deepan, with regard to the Royal Enfield. You know, steady performance. Some believe that most of it is in the price, but we've heard this before. Competition coming in there, valuations expensive as well. But the bullet just continues to thump along. What is your view on the stock? I think you all have been long-term holders. I was looking at the international business as well. The international revenue has now scaled 1,000 crores for the first time ever in a quarter. What's your view?
Nigel, you know, how can we have an interview and not talk about Royal Enfield? Our favorite company for various reasons. But I think, yes, I mean, the engine keeps on, kind of chugging along well. And people on and off talk about high valuations, competition, and the EV trend. I think Eicher Motors got hit when that policy came that Delhi will now allow only 50% or some percentage of, or they want to achieve a particular percentage of electrification by 2030, and Eicher Motors doesn't have an EV product. All these concerns keep on coming from time to time. But when you look at the numbers, monthly production figures, the quarterly numbers, and the way the company is expanding its capacity, I think that you just keep your faith in the company, remain invested, and at corrections, look at buying into this stock. It's a two-wheeler company, no doubt, but the brand is something which differentiates it from anybody else in the entire industry.
Okay, all right. You know, I think we just saw a large trade that took place on IIFL Finance. Deepan, do you have a view on this particular name? You know, I recall we discussed it at sub 500 rupees as well. The stock had corrected a good deal. I think from 700 rupees went down to around 450 rupees. But valuations are on their side. You pull up a last 1 month chart, you'd see the stock has moved up very, very nicely. At around 600 rupees, what is your view on the stock? You know, from around, as the chart is telling you, from closer to around 700 rupees, it went down to 450 rupees odd because a host of issues, cropped up. And now it's gradually pulling back. It still has valuation comfort. Your view?
No, I agree with you that valuation is what is in favor of IIFL Finance. And I'm pretty certain that it'll get re-rated higher and higher. It's amongst the few nice multi-product NBFCs where I think that is growing far higher than the industry. And they had certain problems with NPAs in the past, but now all of that is sorted. And that also is very much under control. They have made great strides on the gold loan side. And that's gone kind of unnoticed. So a lot of their products now are completely I would say there is securitized, whether it's gold loan or whether it is loan against property or housing loan. So I'm very confident of the company. Having said that, it's a company which we have invested and it remains an outperformer, and yet the valuations are significantly lower than peer groups. So it's an opportunity if you ask me.
Okay. All right. Got that. Thanks a lot, Deepan, for joining and giving us that view, sounding optimistic on the prospects of IIFL Finance as well. We'll have to keep an eye out to find out who exactly was part of that large trade. But let's hop across to Hormuz. He's here to tell us about some of those big movers yesterday, some that were backed by delivery. Hey, Hormuz, morning.
Morning, Nigel. And unsurprisingly so, you start off with Infosys, with the kind of moves that you're seeing on the IT names over the last 3 days. In fact, even yesterday when the entire Wall Street sold off, the Infosys ADR was up 2.5%. The third straight day of gains yesterday for Infosys is up 12% now in the last 3 sessions. The premiums on the 1200 call option more than doubled in value yesterday. Volumes were the highest in over a month as well. 3.5 crore shares were traded. The 20-day average is just over a crore, and close to 60% of those shares were marked marked for delivery. So the fact that the delivery volumes for Infosys have been in excess of 50% for 8 sessions in a row now, and 2 crore shares were marked for delivery. The 20-day average is just over 70 lakh shares, and the stock now up 15% this month, still down close to 30% for the year. Keynes Tech was a surprise mover on the upside yesterday. Double-digit gains that the stock saw, the biggest single-day gain since December of last year. The third straight day of gains for this one as well. It snapped a 6-day losing streak on Monday. The premiums on the 3500 call option went up over 350% in yesterday's session. The volumes were the highest in over 2 months. The volumes were 6x its 20-day average. A quarter of those were marked for delivery. The 14 lakh shares for delivery, which was also 5x its 20-day average as well. The stock, as a result of yesterday's move, has cut its year-to-date losses now down to just 7%. And lastly, Swiggy, that's possibly going to be the stock to watch out for today. The third straight day of gains for it yesterday as well. 14% now in the last 3 sessions for Swiggy. Snapped a 5-day losing streak on Monday. The premiums on the 300 call option more than doubled in value. Volumes were the highest in nearly a year yesterday for Swiggy. 7.5 crore shares were traded, 3x the 20-day average, and 38% of those were marked for delivery. So around about 3 crore shares for delivery. The 20-day average of around 77 lakh shares, still down around 27% for the year, below its IPO price. But you need to watch out for today is the fact that it reports its results during the course.
All right, thanks very much, Hormuz, for that. So that is the picture with regards to the big moves that we saw yesterday. We'll take a quick commercial break. The pre-open will be with us. We'll also have Avnish Roy of Nuvama Institutional Equities and put the spotlight on the FMCG space. Lots of numbers coming through thick and fast over the last 48, 76 hours. So a spotlight on many of those coming up.
Welcome back. Well, let's get our technical experts onto the show. We have Sudarshan as well as Mitesh who join in as always. Good morning, gentlemen. If you wanted a dip, you've got it this morning. Crude oil prices are up and yields a little bit firmer, while the dollar index as well is holding on to its own. So the GIFT Nifty suggesting we pull back by 100 points. Sudarshan, you go first. What do you do?
Hi, Nagin. See, look at our Nifty behavior. We had that one-day abnormal decline to 23,600, fallen to almost immediately. Since then, the market has been giving very decent rallies. Now, within a rally, a dip is normal and expected and welcome. So I think this market is now ignoring external factors We are on the verge of a breakout if we decisively break above 24,300, 350. I can't say when and if that will happen, but we should be prepared for it. So this dip is a buying opportunity. Your stops are at 23,900. Be patient and let the market take its course. Be long.
Okay, well, big dips will come, and when they come, you need to be ready to take advantage of it. Sudarshan, morning. Mitesh, what's your advice?
Good morning. So, for me, I think it's still a market which is kind of directional. It's just chopping around within this broad range. But overall, I think the moving averages, the short-term averages, which is the 10, 20-day averages, are placed around 24,100, 24,050. So that becomes a near-term buying zone, and on the upside, around 24,300, 350 zones is where the profit should be taken. I think looking at the overall movement of the Nifty and the Bank Nifty and other indices, I think it makes more sense to trade with more of stock-specific biases. Particularly, we have had a lot of long positions on IT in the last few days, so I think that's how traders should approach. Index, just keep the levels in mind. Try to buy near your levels where the stop loss is close, but otherwise trade with more stock-specific focus.
Got that. Let's talk about individual stock trades then. Sudarshan, why don't you go first?
The entire pharma sector and IT and both export-oriented businesses, both sectors are attractive. Pharma is a buy with a stop under 15.55. RN Dynamics BDL is a buy with a stop under 12.35. Swiggy, which I heard about, and it's the technicals, it's a buy with a stop above 280. So Oro Pharma, BDL, Swiggy, and Union Bank is a sell with a stop above 191.75.
Okay, all right. Those are the four names, four trades from Sudarshan. Mitesh, what about you?
For the day, I had a mix of buys and sells. I think 361 Wealth Management managed to get past earlier highs. So that's a buy with a stop at 1139. Look for targets of 1200. Bharti Airtel finally conquered 1920, 1925 zone. So we'll be getting slightly lower in the opening trades. Buy around 1940-45 with a stop below 1920. And 1995 is the target which I suggest the stock could do. On the selling side is Cummins. After a long time, the stock price is dipped below its short-term averages. Could see some profit booking and correction. So sell with the stop about 465 for targets of 5100. And PNB Housing similarly has broken below its key support level. So could see some more price decline. And that's a sell with a stop at 1071 for a target of around 1020.
Okay. Right. Thanks a lot, gentlemen, for that. We'll come back to you shortly once again for your calls before pre-open. Let's put the spotlight on the FMCG earnings. We've got earnings over the last couple of trading sessions from HUL. We got it from Dabur, Asian Paints, Colgate, Varun Beverages, what have you. The entire gamut of numbers that came in. Abneesh Roy, who's the Executive Director at Nuvama Institutional Equities, joins in. Abneesh, a two-part question. One, this quarter shows signs of inflection where price growth has come by. Things are looking good. Margins have been protected. But on the other side, the price moves, they're so not in line with the kind of numbers that have come by. I mean, what explains a 7% downtick that we saw on HUL on a mild volume base, and the subsequent day there was a big up move? How do you explain this to your clients? Because anytime these numbers flash on the air, we say it's in line and the stock is down about 4 or 5%. We don't necessarily look very wise.
Yeah, hi, good morning. Thank you, Mangalam. Great question. So yes, I think that is opportunity to add such stocks. You are absolutely right. There was the FNO pre-positioning in such cases, in my view, and there is also sometimes some irrational expectation because Nestle, I think results were very strong. It bet expectation. Bajaj consumer results bet expectation. So I think there is always that element also. But definitely, I would like to break up my coverage into three spaces from a recommendation perspective. One is, of course, the compounding stories. So Nestle, Pidilite, Radico, etc., Marico. These four stocks are compounding stories. Second will be, of course, valuation comfort plus reasonable recovery. There, I would like to pitch Colgate, Hindustan Unilever as the top ideas there. And third will be the reform space. So clearly, Alcobev, a lot of reforms happening. In my view, Tamil Nadu, which is one of the largest market, there clearly TASMAC privatization is starting. I think all the Alcobev companies will benefit. There's a UK FTA benefit. There's a Karnataka tax reforms in Alcobev. So these three are the buckets we would like to pitch stocks to the investors. But you are absolutely right. The 6-7% got reversed largely in HUL yesterday. Varun Beverage also. So Asian Paint also yesterday strong numbers, but I think yesterday crude was up 6-7%. So yes, we are positive on most of the companies, but definitely Asian Paint and all paint companies will see strong numbers in Q1 and Q2. So we are positive on the paint space overall also.
The management of Asian Paints said that they believe they grew faster than the market in the first quarter. Do you back Asian Paints right now, or do you continue to back Berger because the Bengal revival theme and perhaps continuing to stay stronger?
No, I think entire space will see recovery. Even Indigo Paints, which is a very small paint company, will see very strong numbers in Q1. Even Birla Opus will do well. I think the industry, the issues are behind us. So I think everyone will see broadly definitely 15 to 18% sales growth across the board in Q1 and Q2. Yes, you're right. Berger will see the additional benefit of Bengal revival. That plays out over the next 2 to 3 years. So we like all the companies, but definitely whenever recovery happens, the number one player takes market share. So I'm not saying only in Q1, but definitely the 20% local players in paint, they will lose market share because crude is so volatile, and now Asian Paint has got the VAM-VAE facility also. So the kind of strength we are seeing in the body language of Amit Single, I think that is on the stronger side versus what we have seen in the past. So yes, we like all the companies, but Asian Paint definitely will gain market share from local players.
Interesting. You said you read income statements and balance sheets, and now you're reading the body languages as well, Abneesh. What about the tobacco companies? I mean, the street was expecting some sort of resilience to happen. That hasn't happened in the first quarter. Godfrey Phillips saw a volume decline. We saw a decline for VST Industries as well. And tomorrow, ITC is reporting its numbers. Do you think the worst is priced in, or maybe these will continue to languish?
I think worst is priced in because next 2 to 3 years, my sense is the Modi government will not increase the taxation too much. Because if you see the last 10 years history, only in 1 year we saw very sharp taxation increase, which is behind us. Yes, Q1 results for ITC will be weak tomorrow, but I think that's largely factored in, and definitely in Q2, you will see gradual bouncing back. Yes, next 2-3 quarter, cigarette volumes will be negative for ITC, but every quarter you will see some recovery in terms of the volume decline. So from a high single-digit volume decline gradually, I think by Q4, we should see close to low single-digit decline. Similarly, in terms of EBITDA decline, also we'll see that same benefit. So I will say that yes, valuation comfort is very high, but someone has to take a 1 to 2 years view on cigarette stocks. Plus dividend yield is also 5%. So we are positive on ITC more from a 1 to 2 years perspective, but near term, you will see that maybe some more time correction can happen, but valuation comfort is very high.
I'm not sure if you track the hospitality space, Abneesh. ITC Hotels, if you have that under your coverage, because the stock from about 250 thereabouts has fallen to about 160. And, the hospitality theme, the structural theme is pretty much fairly underway right now.
I don't cover that space, but if you are asking on that kind of consumption, we'll prefer Alcobev there, because clearly in terms of the urban consumption, Alcobev will capture the reforms, etc. Tamil Nadu TASMAC reforms, Karnataka tax reforms, UK FTA. So I'll not be able to comment on hotel space, but definitely we'll play the urban consumption through the tax reforms in the liquor. So we like United Spirits, Radico Khaitan, Allied Blenders. We have a buy on all three.
Abneesh, morning. Just one quick question. I know you don't cover quick commerce, but there's this big thing which is going on. I'm sure this Zepto IPO valuation, big difference between what's on offer, what's the ask, etc., whether it'll be deferred. I mean, what we understand is that the management is sticking to its gun, saying, well, no deferment. We'll see. How do you see this? I mean, one way or the other, does this directionally mean lesser competitive intensity, not just for other QC players, but perhaps for, the FMCG companies, even Avenue Supermarts, for example? I mean, is there a broad read-through from this, that the market is ascribing wants to ascribe lesser valuation multiples to a new company trying to IPO?
Sure. So I'll not be able to comment on that space, but definitely from a Avenue Supermart and FMCG perspective, I think the competition in the Q-commerce will sustain because Amazon now, Flipkart minutes are very aggressive, which was not the case, say, 1 year back. So that is good for definitely FMCG companies. If you see even Hindustan Unilever, so very strong growth in the e-commerce, quick commerce across the board we are seeing. So that means that even for Avenue Supermart, the same store sales growth will be a challenge. They already pointed out that in the annual call. So definitely FMCG is a good way to play the rivalry in Q-commerce because they will keep funding a lot of that growth and there will be less bargaining power because that's a fragmented space. So yes, FMCG will gain because of that, but definitely competition in Q-commerce is not going away. You can't see just one listed likely IPO because Amazon and Flipkart definitely are global companies and they are very aggressive on this space in India.
All right, take that point, Abneesh. Thank you so much for joining in. Just before we let you go, any final thoughts that you have? There are a bunch of numbers that have come by. There are a number of stocks which are currently at near 7 to 10-year lows. We've seen, the price at which HUL is. The last time was available at the same time in April 2019, pre-pandemic. ITC, June 2017. Imami, the last time we saw a similar price was close to about 11 years ago. So it's a bit of a lost decade. Do you think that these are value traps right now, or maybe it's a good opportunity to enter for the next decade?
So 4 key things. Yes, these are good time to buy some of these. So out of these, I'll prefer HUL and Colgate for sure because of 4 reasons. Our sense is because of the Korea and Taiwan sell-off, I think India will get some benefit and a lot of the large caps will get that FI benefit inflow. Second, of course, is inflation is good for large companies. They gain market share. Their pricing growth leads to operating leverage also. Third, of course, valuation, as you have already highlighted. But more importantly, I think El Nino is too much of a unnecessary overhang. We have analyzed the data. Companies have addressed that issue also. Only 15% of the rural GDP is now linked to the agri, right? So, and definitely a lot of subsidies are there. So I will say that HUL and Colgate will come back to glory. I think and plus the D2C startup space also, these companies are now participating and we are going to see a lot of M&A in that space in favor of the large listed companies.
And Colgate will come back to glory. That's something that we'll take away from this. Thank you for joining in, as always, Abneesh. With that, let's go across to Sudarshan and Mitesh once again for their 9-10 call. Sudarshan, your call.
It's Ola Pharma, buy Ola Pharma with a stop under 15.55.
Mitesh, your 9-10 call.
Yeah, I'll go with the buy call as well. That's on Bharti Airtel. Buy for targets of around 1995.
Okay, got that. Thanks a lot for that, gentlemen. Well, let's talk about a couple of other numbers then. Vedanta, iron and steel, now we have the demerged entity and the numbers look quite good. So on the top line, there was a growth of close to around 18%, which is very, very good. Volumes on iron as well as steel were up in low single digits, but pricing as well helped them. So that's what caused the good growth on the top line. Besides that, you had the margins that expanded to around 13.5% from around 10%. And if you look at the EBITDA per ton on both the parameters, on steel as well as iron ore, on a sequential basis, there was a bit of an improvement out there. Actually, on a year-on-year basis, there was an improvement. On a sequential basis, there was a mild dip in terms of iron ore. So the EBITDA per ton on steel is at around 5,900 rupees per ton, while on iron ore, it's around 1,200 rupees, which is quite good. They've taken various operational efficiencies, and that's why that looks good. They also reported a net profit, but you're heartened to see that the finance cost has come down because the inter-corporate borrowings have got cleared out, and now the debt in the book stands at around 2,700 crores or thereabouts. So the numbers look good, but execution from year on is going to be important because they are talking about taking capacity to around 5 million tons by 2029. And from there, they're talking about 15 million tons as well, from around 3 million tons currently. So good numbers, but their aspirations need to be tracked from year on. Thumbs up just to kickstart trade. Hopping across to Vinny, though. She's here to tell us about Syngene. Vinny?
Hi, so Syngene, obviously a weak set of numbers, an all-round miss that's coming from the company, mainly due to the lack of offtake that came in from the major biologics business and client for the company as well. So on the back of this, what Macquarie is saying, it's a quarter that one could forget for Syngene as well. They're maintaining the outperform rating though. Target price is 735 rupees per share. What they highlight is the commentary that came in from the management, right? They said that they expect a degrowth in H1 FY27 because the business momentum has been weak right now. So H1 would be weak, but H2 could start seeing a pickup coming in. FY27, estimating a single-digit revenue decline for FY27, and margins are expected to be in the range of 20%. But right now, margins were quite weak. So, however, what Macquarie is highlighting is that this represents a downward revision in terms of revenue guidance that are given in Q4, and a single-digit revenue decline is what now they're expecting, and that is why we could see red on the screen. Nothing exciting in terms of guidance or numbers coming in from the company.
Right, Vinny, thanks a lot for that. Prashant, we run into market opening right now?
Yeah, no, absolutely. Oh boy, we start with, half a point change on the Nifty, and the Sensex is down about 15 or 16 odd points. So this is, all told, a great start. We pick up on that very quickly. We'll go after looking at the opening levels as far as indices go to individual names, because that is where all the action is with regards to earnings reaction. So what do we have? 24,200, not 24, I think unchanged pretty much. So just maybe a little lower. So settling down now, 24,200, yeah. Nifty Bank is down 0.4%, 56,900. The mid-cap index is starting about a third of a percent lower. The small-cap index also will come up with a cut, maybe a small cut at that. The oil sensitives, Indigo was down yesterday, Indigo was down this morning. And IT, let's go straight to the Nifty IT index and see if you got another 1-2% pop. Okay, about a 1% pop, 0.9 right now. So that's the green on the screen as far as IT is concerned. Sirma is reacting to numbers at the bottom of the screen. It's got about 4% on it. The Nifty heat map comes up. It's kind of, 22, 23 names which are higher. Infi is the biggest gainer, followed by ONGC, Wipro, HCL Tech. On the other side, you've got Asian Paints, Ultratech and Eternal, which are lower at this point in time. Mangalam.
Well, if you look at the broader markets, the mid-cap index is slightly lower, but no real problems because there are big moves out here on both up and down. On the way down, we have Syngene numbers not looking particularly good, and that stock down about 7%. Dabur started about 4% lower. Again, we were fearing that the volume miss, a mild volume miss, would do an encore of HUL, and which is why Dabur is down about 4%, despite all the other numbers being broadly in line. Vari is down about 5%. And KPIT saw a big move yesterday. It's coming in for some bit of decline in today's trading session so far, down about 4%. On the way up, we have Balkrishna Industries up nearly 9%. IFL Finance does well with about a 3.5% gain as well. And movers from yesterday that continue into today as well. Thangamayil Jewelry was down about 10% in yesterday's trading session. Opens 10% lower this morning as well. Reddington, good numbers coming in. That stock up 15% straight off the bats. And SML Mahindra, yesterday, the restructuring of the Mahindra Group with the truck and buses business going into SML Mahindra took that stock higher by 20% by the end of trade. And this morning itself, it's up around 15%. So a bunch of stocks moving in the broader markets in opposite directions, led either by news or by numbers.
Well, that's right, Mangalam. Reddington, it's actually a blockbuster quarter that they're saying. They've shifted the product mix from low-margin distribution business to the high-margin AI services business. That's what's helped them, and that's why that stock is flying away. A couple of words with regard to Balkrishna Industries as well. The reason that the stock is running away is because they have reported the highest quarterly tonnage. That's what's led to a beat on all parameters, revenue, EBITDA as well, and the volume growth is seen across India, Europe, as well as the United States. Star Health, that's the other stock in there. It's popped up in trade. I know from the top it's been a relative underperformer, but this morning it's getting an applause actually from the bulls because underwriting as well as the operating parameters, that's what's aided the net profit beat out there. Though from the top we are seeing some kind of supply because the stock has already recovered considerably from the recent low. Tractors India, yesterday, recall, the stock was around 215 rupees. And just as the market started, we had highlighted that there was a large trade that took place. There's an influential name that's come in there and, picked up that stake. So from yesterday at around 215 rupees, the stock has already moved to around 270 rupees. So that's why it's not running away in trade today. On the downside, the big reaction you're seeing is KPIT Technologies. That stock has come in for a bit of a knock. It's pulling back yesterday's gains that we saw. Equus, that's down close to around 4%. We'll try to get in the management in a bit from here on. And Lakshmi Organic, I noticed that stock in the last 1 month was up close to 25%. Now, this morning, the stock actually is giving up post the results. So it's down close to around 4% as we speak, as is the case with PCBL as well, down 3.5%. Another stock that rallied more than 10% ahead of its numbers. The stock, Mangalam, we just covered, Vedanta Iron and Steel, that opens up with a gain of around 2.5%. So the street likes it. but the vision ahead is important. And as all three of us did a quick market check, the markets have moved into the green.
Yeah.
Just one point on MTAR Tech. The stock has been on a lower circuit trend for the last many trading sessions. This morning, Ria said the numbers are good. Management's maintained the guidance. It's opened about 2.5% higher. Let's see from the top whether we see some selling or whether this marks the end of the decline that we've been seeing in the stock over the last month.
Yeah, no, absolutely. And I think, that's something we've discussed here yesterday and today. One-way sell-off on this one, MTAR Tech. I mean, they are into all the right hot button areas, right? I mean, they're into power, which is, the AI-led power electrification theme they provide to nuclear park operations. So there's a nuclear bid. They're associated with the space program. So it's like this one, business with exposure to all three. But the stock was trading at 150, 160 times earnings at one point in time. Not anymore. 10-point change at this stage is what you have. Car trade is down about 4%. Again, it's had a phenomenal run lately. Hexaware, again, results came through, is down 7%. And there is Timex, which is down about 4.5–5% as well. So some volumes in it, not much, but volumes not completely lacking here. KPIT, of course. KPIT has gone the other way, right? Yesterday, finally, it started slow. There was a call, and the stock went up 5–6%. It's giving them back all of it this morning, KPIT. And Vari Energy is the biggest volume-led loser right now. It's down about 6% at this stage. All right, let's bring in Amish Shah, who's head of India research at BofA Global Research. Back after a while. Amish, great to have you with us here. Thanks very much for joining us. I saw your note from a few weeks ago, just kind of sort of outlining everything from a macro and micro standpoint, reforms and everything else which the government has done. And it was kind of a report which took stock of where we were. But I think we've moved on quite a bit since, right? Just because of the global environment. There is a big unwind of this high pressure, high charge momentum, AI trade. Earnings are coming through, and earnings growth is tracking very healthy if you look at it. So just wanted to, in that sense, ask you to market your views to where we are now.
Absolutely, Prashant. So I completely agree with everything that you said. And as a result, we've changed our views as well. And so the markets have gone nowhere. But you would recollect that, we turned cautious on the markets or bearish on the markets 2 years back, or almost exactly 2 years back. Since then, we now think that the risk reward for the markets are more balanced. In our base case, we are arguing that from current levels, in the next 5 months till the end of this year, Nifty can return 9% upside. In a bear case, we also think that there can be 8% downside if all the risks were to play out as the markets are debating. But our bias is more favorable. We do think that the probability that the base case 9% works out is much higher in comparison to the bear case that we argue.
So you're still sticking with the 9% kind of upside level, right?
Absolutely, Prashant. So unchanged price target. We are still arguing for Nifty at 26,200 by the end of this calendar, which offers 9% upside. Yes.
Okay. Just your coverage universe and what you're seeing as far as earnings go. Is there an earnings numbers are good point to point, but is there an earnings acceleration that you see from here? Because the market will try to price in what's coming, not what's already in the bag. Of course, that'll also happen on earnings day. But is there a general trend of acceleration in your coverage universe based on what you've heard from companies and what you've seen?
Short answer is yes. So if you look at it, FY24 is when Nifty gave 18% earnings growth. 25 and 26 was 5 to 7%. And now we are arguing that it will accelerate to 10%. We are still lower than the consensus at 13, but 10 is still a meaningful acceleration from where we were before. Same goes for the mid caps. So the small and mid caps had a 1,400 basis points extra earnings growth over Nifty between FY21 to 24. That number shrank to 0 during 24 to 26. We are now arguing that over 26 to 28, small and mid caps earnings growth premium over Nifty is again going to accelerate to 817 basis points.
Okay, all right. Hi, Amish. Good to see you in. Take your view on board. Amish, the other big burning debate is whether or not the FIs are back for good. You don't seem so confident, right, in this sort of a scenario where the dollar index is showing strength, when the yields as well are spiking up. You believe that this current trickle of inflows that we're seeing from the FIs, I'll tell you what, personally, what we're celebrating is at least they're not selling as big as they were in the last 5 months. And in July, they've turned mild buyers. But you're not confident that this trend sustains? Tell us why?
Nigel, as you said, that the correlation is a perfect negative correlation to the US bond yields versus EM flows, not just India, but emerging market flows. So in an environment where your 5-year US Treasury is at 4.4, 10-year is almost close to 4.7, and 30-year is 5.2, it's an environment of a risk-off. And it's very hard, therefore, to get flows for emerging markets. So we do think that the pace of outflows of FIIs is going to moderate because they've already sold a lot. But we are not in the camp of seeing big FII inflows yet. But the 9% returns that I spoke about is factoring in the fact that FII outflows will continue, even at a moderate pace. If indeed FII flows were to turn positive, that's an upside case to our 9% number.
Right. Amish, you turned cautious in the market in August 2024, timed that perfectly. It seems that way. And now you've turned positive. So obviously the street will take your view with a lot of importance. 9 to 10% upside is what you're seeing as your base case on the Nifty right now. What do you think will lead to this upside? Because the banking pack is a consensus buy. IT, while this is a consensus sell, a lot of people are now getting positive with the kind of revival that we've seen from lows. And then you have the capital goods segment as well. So across the board, what do you think will lead the gains that you're seeing on the Nifty?
So Mangal, both top-down and bottom-up factors. So from a top-down perspective, as we were discussing, that the economy as well as the corporate earnings has shown a very good resilience. That's reflected in a variety of high-frequency indicators like GST tax collections, direct taxes, auto sales, power demand, so on and so forth. So there are a variety of macro factors that are encouraging. On a bottom-up basis, clearly the first quarter, which was the middle of the West Asia crisis quarter, we are currently run rating at 12% earnings growth, which is definitely a handsome beat. So I do think that top-down, bottom-up both adds up. Going on to sectors, we do think that you have two pockets of opportunities. One where sectors or stocks offer value, and in that basket, I would argue you could have financials, you could have regulated power and gas utilities. You could also have upstream energy. So all of this is a value basket as we see it. And then there are options for growth or sectors that give you high visibility of growth. So even if the valuations there are a bit expensive, markets will continue to chase growth. And that's a longer list. So you have autos, you have jewelry, internet, non-ferrous metals like aluminum. So now, and small and mid caps that we were discussing, some of them are good bottom-up opportunities. So I think markets would probably do well on the back of chasing stocks that offer high growth and some that offer value.
All right. Amish, what about the other one? The top sector of the day, the top sector of the last 1 week, and the top sector of the last 1 month. Let's stop it at that, because if you widen the time horizon, then it's been a relative underperformer. How are you all placed on tech? Initially there was that big fear with regard to the AI trade. Now suddenly this anti-AI trade is coming back. The under ownership is being talked about. Valuation support is being talked about. Flash in the pan, or do you think it can get its act together? Your view, and how would you approach this space, large and mid-cap names?
So Nigel, structurally we are still not very optimistic on tech, but recently we have upgraded it from an underweight to a neutral, specifically on the back of anti-AI trade, that if they were selling off when AI was doing very well, then if AI is not doing well, conversely, then tech should at least rebound, even if tactically. So we think that tactically it will do well, but the moment the valuations from currently 14 odd times goes to 16.5 times, we think that the sector is likely to start underperforming again, because the worries or the structural worries on AI disruption continues to be out there. Large cap versus mid caps IT, we still think that the growth is much better in the small, mid cap IT. So relatively, we prefer that over the large cap. But within large cap also, we have a preference of one over the other.
Right. And in this mid, which you believe will continue to trade at a premium, are there any particular pockets that you like? I mean, we've seen themes that play out fairly well. Power equipment was one of the themes that did well. Renewable is something the other that did well. And then we did see a surge in defense as well. Any particular theme in this mid space that you like?
So pockets of opportunities, I would not generalize it as per sectors, but, we find some of the financials and broader financials, including exchanges, brokerages, some of those exciting. We find a lot of consumer discretionary, including internet and autos, exciting. Some of the travel tourism themes we still find exciting. So these are some of the big pockets, but most of the other pockets that you spoke about, we think are now going to languish. So defense, we think very strong thematic, but including the valuations now, we think that defense is now going to be sideways. Real estate, tactically, we think has done very well recently. Now it's likely to be sideways. Renewables, we think markets are chasing growth, but it is not profitable growth. Most of the renewable developers make single-digit ROEs. So when the market starts focusing on returns, we think that renewable developer particularly are not going to make that much good stock returns anymore.
I got that. Fair enough. Got it. Amish, last time you were on, and correct me if I'm wrong, we did talk about this entire one of the themes you outlined, right? Was energy and energy transition, right? As a core theme, which perhaps continues to play out in a big way. I mean, we've seen, at least at a ground level, policy level, E20, higher flex vehicles, etc., etc. All of that is playing out. What do you have coverage published on in that space, and what are the best ideas there?
So absolutely continue to like that theme, Prashant. We think that can be like a multi-year, perhaps a multi-decade theme. So within that, we are currently positive on power financing companies, positive on the power regulated power developers. We are positive on cables, but we are not so positive on the power gensets. We are not so much positive on the power transformers anymore. So again, some like, some dislike, but we continue to believe in that theme.
So power financiers, so REC and PFC, and those are better ways to get exposure, Amish. And maybe others.
Power financiers offer more value. Same goes with regulated power utilities. They are more value, whereas the transformers and gensets, etc., are now very expensive valuations.
I see. What's the view of the global team, Amish, on whether the correction in US is in the semiconductor space is just a pullback, healthy pullback? We had Ed Yardini, who's a veteran, in the morning, who said, well, if you've got the stomach for it, it's the time to step in. I don't know what the global team is saying at BofA.
So the global views are that AI capex continues. Clearly, the argument or debate on returns on that capex is a very valid argument. More importantly, right now, the big macro call that we have is that for every next Fed meet, we will have a rate hike. So we are arguing for a 75 basis points of rate hike. That obviously in the near term is not so much positive for the AI-linked stocks. But otherwise, from an AI capex perspective, the views are that it will continue.
Okay, all right. Thanks very much, Amish, for that. And we will speak again soon, and sort of, once again get your views on what's happening. I think we'll have a better sense of, a wholesome sense of earnings as well. This is the heaviest part of the earnings season. Some of the, used to happen in the past that some of the weaker numbers would be reporting later. So the composition so far is strong. Will that change? We'll wait for it. Let's just get on with the next conversation, and we have the Prestige management with us. Reported perhaps a muted set of numbers, if you want to call it that. Pre-sales fell sequentially and on a year-on-year basis as well. We have Irfan Razak, Chairman and Managing Director at Prestige Group with us. Mr. Razak, good morning. Great to have you with us here on the program. Thanks very much for joining us. Could you start by telling us what happened, sir? What's the reason for the decline? And, your guide is 20% pre-sales growth for 27. Will you be sticking to it, sir?
Good morning. Yes, we certainly will stick to it. And I think the first quarter has done well, considering that we had only one launch and that too in Hyderabad. So it's a matter of what we call the overall launches that we do. Like in the previous quarter last year, we did a launch in NCR, that is the Prestige City, Indrapuram. That's where the numbers got bumped up. And this quarter, we did do a large launch in Hyderabad, the Prestige Golden Grove, which did extremely well. But in spite of that, the numbers are different. And that I do believe that we've got 3 more quarters and there are a lot more stock that is to come once the approvals are in place. And I'm very, very sure the teams are working hard to see that they'll exceed the guidance that they have already set out for.
Mr. Razak, we had Lodha with us, predominantly Mumbai-based player 2 days back. And there also, the pure residential sales, excluding land sales, etc., fell. And we asked them, well, what happened? They said, well, we consciously did not launch new projects. I mean, just calibrating our launches in that sense. In your case, this was more approvals related, or this was, a decision to hold back?
No, as a rule, we don't hold back anything at all. As the product gets approved and as we get the RERA, we launch, and we actually are struggling to have more inventory. And I believe that we've always met with success, and there is demand on ground because we are in several markets, and all these markets, whichever we are present in, are doing well.
You said there was one launch in Hyderabad. That's been a big contributor. What geographies will drive growth in FY27, Mr. Razak? I ask you because, while Hyderabad and the other places, there are launches, there is a lot of competition that is there in NCR as well. We heard Oberoi launch a project out there, did extremely well, and they had to put a stop on the sales immediately, saying that this next phase will come by at a much higher price. So just wanted your thoughts on competition in these micro markets and what geographies will lead growth for you.
I think there is competition in all markets. It all depends on your product, the brand that you have, and the type of location and the pricing that you come up with. And we are very confident that wherever we are, our customers are loyal to us and they have that belief in the company. And I'm very sure that whenever we launch, and that's why even Hyderabad people were a little skeptical, but we did a good product and a good launch, and that met with extremely good response. And that's where we are enthused. And I believe even Mumbai, or for that matter, Bangalore and NCR, all of them will do well once we bring in the product. We are trying hard. I think Bangalore this quarter should have at least 3 to 4 launches. Mumbai should have 1, and similarly NCR may not happen this quarter, but for sure next quarter we'll have a couple of launches.
What would the GDV, or gross development value, of the entire launch pipeline this financial year be for you? And if you could also throw some light on collections, will that grow in line?
See, now the last quarter, even though the overall sales dipped, the collections went up. And last quarter, we had collections of 4,800 crores, which is pretty substantial. And I do believe as we keep launching, the collection also will go up. And there's quite a positive view on that. And our overall collection for the year should exceed more than 20,000 crores.
Collection should exceed more than 20,000 crores. And the GDV of the launch pipeline would be what, sir?
Around 60,000 crores is what we are looking to. And we have that inventory. It's just that the teams are working hard in various geographies to see that the planning is done and the approvals come in with the RERA so that we can bring it to the market. And as I said in the beginning, we don't hold back. As soon as the product is ready for launch, we just bring it in and we meet the success.
How much of this will be from NCR? You said next quarter, a couple of launches, sir, right?
Yes, we've got already planned and ready, which is, I mean, we've been working for some time, is that Prestige Bougainville in Sector 150. Now that is behind us. The master plan has been approved. We are just waiting for the building plans to come in, and that should be a big launch for us in Noida. And then the other one is we've got the Prestige Meadows in Sector 9. Also, I think it's work in progress in terms of getting the approvals, and I think that also should come in the next quarter.
I see. Lots of other players, right? I mean, you a couple of years back were relatively new in NCR. I mean, actually, you're still new in NCR. But there are others who've come after you as well. These are big players, right? With deep pockets and good brands. And a few years back, there used to be a premium for because of the big bust out which happened 10 years, 12 years, 15 years back. There weren't that many big, branded players except maybe a DLF, a Max, etc. But now there are many. Will that change the market in any sense? Pricing, what you're able to command, as more pile into that market?
I think price is a function of location. Price is a function of the type of product that you bring in, and also what the market can sort of support. And one thing that as a company, as a rule, we have not done is we've never undersold a product and not created a disruption. We believe that there has to be a level playing field, and we will price our product according to what the market demands. And there is belief that Prestige has the capacity to deliver, because I believe delivery is the key, and we keep delivering. Yes, there could be some blip here and there because of labor issues. Like in the last 2 quarters ago, we had a huge labor issue because of the elections in Assam and Bengal. And that actually had a sort of a big stress point for us for at least a quarter. But that's behind us. But that's part of real estate that goes on. And I think customers do understand a month here or two up or down. But the thing is, the delivery comes, and delivery comes as promised.
Right, take that point. Thanks a lot, Mr. Razak. Always a pleasure speaking with you. The first quarter obviously was soft given the nature of and the number of launches that happened, but you are projecting a strong performance in the remainder of this 9 months, make up for the shortfall in the first quarter, 60,000 crore worth gross development value to be launched over the next 9 months. No problems with regards to geography as well diversified. With that, we take a short break, come back. On the other side, the management of Sirma SGS joins in to discuss their first quarter numbers and the road ahead. Stay with us.
Welcome back. Well, let's get straight to the next management. Sirma SGS, it's buzzing in trade. Good set of numbers in the first quarter. Revenue beat, margins as well as profitability came ahead of expectations. To break down the numbers, what's the outlook? We're now joined by Mr. Gujral, the managing director at the company. Hi, Mr. Gujral. Good morning. Thanks a lot for joining in. Well, you've had a very, very strong start to the year, sir. 68% growth in terms of revenues, with which is much higher than the earlier guidance of around 30-35%. And your margins as well have improved a little bit because of better product mix. Could you help us out with 3 broad numbers? 1, what is the revised revenue growth target, if at all? What kind of export contribution will be you giving us in terms of absolute revenue and margin outlook? 3 broad numbers.
Okay. See, the Q1 has we started on a very strong note, as you said. And this gives us the confidence that we'll not only achieve what we have guided, but we'll be performing better than what we have guided. By what sort of percentage the performance will be better, I think let another quarter pass by. But we are very confident of exceeding our guidance on the revenue and other set of numbers. On the exports, I think it gives us a big satisfaction that while exports last year grew by about 40-odd%, this quarter they have registered a growth of 60%.
Okay.
And with this, we are well on track to achieve the guidance of 1,500 plus crores of export during the year.
Okay, so 1,500 crores, sir, of exports, revenue growth, you're sticking to 35%. You're not upping it, right?
I'm saying it will be better than that. By what percentage? I'm not committing the percentage by what it will be better.
And margins?
But we will be exceeding the guidance.
Margins
margin also, if my revenue growth goes up, my margins also in absolute numbers should go up.
But 10.5 to 11% is what you're guiding for, right?
Yeah, that's broadly what we are sticking to.
Okay, just one more question from my end. What about a QIP? You just raised money last year. Now again, you want to raise money. Could you tell us what is the rationale behind this? Why are you raising? Break it up for us.
See, this is an enabling resolution. When we had raised the QIP, we had another resolution in place. That resolution is having an expiry. So it's just an enabling resolution that should, in the coming year, in the coming quarters, there be an inorganic opportunity or a new greenfield project which necessitates a fund requirement, it would be triggered for that. For our existing set of businesses which we are into, I reaffirm that we don't require any fundraise. The operational cash flows will be enough to cater to the growth trajectory which we have charted out for ourselves.
Okay, let me squeeze in one final one. Working capital, that's moved up. Why? Could you tell us, what happened in the past quarter? The working capital days as well, I think, has gone up by around 5-8 days. What is the outlook? I believe you're preparing yourself in case things go wrong. You've stacked up some inventory as well. Where does this number stabilize at?
Okay. See, on the demand side, we are very bullish. We don't see any constraint on the demand side. On the supply side, because of the global geopolitical situation, the war, the petroleum refineries being hit in Saudi Arabia, which was a supplier of one of the critical raw materials which go into the PCB, the component lead times have gone up because, again, of shortage of the basic raw material. All this is sort of extending the delivery lead time of the inputs. Now, as a businessman or an industry, we have two choices. Either be lean and let the market suffer, the customer suffer, or take inventory as a strategic investment. Don't take inventory as a plain vanilla working capital figure. For the next 2 to 3 quarters, I think inventory should be viewed from the lens of a strategic investment. And I personally believe that across the industry, not specific to Sirma, across the industry, we will see inventory levels going up a tad bit. Whether they go up by 5 days or 4 days, I can't say today.
Okay, got it.
Right.
If it stabilizes, we have to stock to ensure to cater to the increased growth levels which we are targeting.
All right. Thanks a lot for joining in, sir. With that, we'll let you go. On that, let's go across to a rare television interview that we have. Rahul Bhatia, MD Interglobe Aviation, speaks exclusively to Shireen Ban, outlines Indigo's domestic and international expansion strategy, explains why India's aviation cost structure must become more competitive.
The industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines, has gone up. And this is, the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete. And in that mix also is ATF.
Right, with that, let's get into another earnings conversation. We do have Vinity Saraf Mutreja, Managing Director of Vinity Organics, joining in. The company's revenue in the first quarter grew by about 28%. The EBITDA, however, grew by just 7%. Margins compressed, and the net profit on the back of that grew by about 4.5%. Vinity, thank you so much for joining in. And that really is the first question, because you've guided for 26 to 27% margins for FY27. Now, despite the delay in pricing, or passing on the raw material price hike, are you confident of this 26 to 27% number? What kind of products will be margin drivers for you by the end of this year?
Hear me? Hello, good morning.
Yes, we can hear you.
Okay, great. No, so this quarter we saw an improvement in the revenue. A lot of that has to, a couple of factors have led to revenue growth. One is, of course, the rupee depreciation. 55% of our revenues do come from export. Also, one significant thing is that the raw material prices increased a lot owing to the Middle East conflict, especially starting in March, April, May, and that some of it we were able to pass on as price increase. So with that, the volume growth we saw in certain products such as antioxidants and certain other new products, and that is what led to the revenue growth. Now, consequently, the EBITDA margin did not grow by as much because most of it was just rupee depreciation as well as RMC increasing.
Right, which is why the question, you've guided for 26 to 27% margins by the end of this year, and you're confident of that, right?
Yeah, I think that we should be able to maintain even this quarter. I believe the EBITDA margin is in that range of around 26%. And that is taking into account our entire product mix of ADBS, antioxidants, butylphenols, as well as IBB and other derivatives.
And in the second half of this year, how much would ATBS contribute in terms of extended capacity? Because you've increased capacity from what, 20,000 tons per annum to about 60,000. That and even Viral Organics starts in October 2026. So the second half will have a lot of these new products coming in.
Yeah, so ADBS, we have expanded capacity from 30,000 to 50,000 of the high quality, if that is the metric. We do expect some demand recovery in ADBS starting October. Viral Organics, like I had mentioned, the plant is under re-engineering, which should get completed by December. And we expect more revenue coming in from January. So the second half should be better than the first half. And hence we expect overall, let's say, volume growth, or maybe, translating into revenue growth also of at least 15% this year. And consequently, margin EBITDA growth as well.
This particular financial year, how much would be the incremental revenue from the ATBS capacity, and Viral this year would do how much? Because on a steady state, you said could do about 120, 130 crores.
Yeah, so when Viral Organics, the full potential on a steady state at 70-80% capacity utilization will be close to 400-500 crores. But just this year, starting FY28, if I look at starting March 27, I would expect about 150 crores from Viral Organics itself.
Right.
Okay, all right. Hi, Vinity. Good to see you. Well, another debatable issue which some analysts have written about is about anisole. That's the key raw material for the new product line, I believe. And what they're saying is that it's cheaper when it's imported in comparison to when it's produced in India. Could you tell us what is your take on the situation?
See, yes, anisole we are going to make from phenol, and a lot of and it will always be a make or buy decision. If it is cheaper to import it and buy it, then we will not make it. We will import it, buy it, and then convert it into MEHQ as well as some other products that we are into. And if phenol prices remain low, then we will produce our own anisole. So I don't think that is any factor as such in revenue or EBITDA growth.
All right. Just a final question before we let you go. You've embarked upon a serious capex as well, which is currently still underway. So if you could give us a sense on what your ROCE could decline to once the capex is at its peak, and by when does it start turning, and what the peak could be, and by when?
So I think, we are presently at an ROCE of about 15 to 16%. I think once we achieve full capacity utilization of our capex, one can expect improvement in the ROCE, up to 20% after 2 years or 3 years. Having said that, we are making some new investments in downstream products, in some of our forward integration products, in butyl phenols, as well as MEHQ, as well as 4-methoxyacetophenone and a few isoamylene-based derivatives, as well as adding a few antioxidants to our kitty.
Antioxidants, you said, would be how much? And you said that you are also considering new capex. How much would that be roughly in value terms?
So actually, the marginal new capex in antioxidants will not be much. We will start, achieving full capacity. We are already running at a very good run rate. The AO market has improved quite a bit in the last 3 months, and we are seeing realization improvement as well. And at the marginal capex, we will be able to add some new antioxidants, and soon we will be reaching a 20%, 15 to 20% ROCE in the additives business itself.
Yep.
ROCE doesn't go below this 15-16% in the near term as new capacities come on stream before they start to contribute positively, right?
No, because actually most of the capex has already been done. So only thing now, the ROCE can only improve as the utilization increases.
Okay, all right. Thanks very much for joining us, Vinity. Appreciate your time here on CNBC TV 18, and good luck as you continue to execute. We've got 2 listings today, and both have settled. I think I saw one. It settled at a pretty strong premium to the IPO price. That is Indomim. It's an interesting company, and it's basically into metal injection-based manufacturing. It's a specialized way using die casts and injecting metal, taking the cast off, essentially for use for smaller, more complex products. I mean, they supply to aerospace companies, defense companies, and a wide range of end user industries. That's the one which is jumping up 44%. And look at the volumes on top of the IPO price, 700, by the way, on Indomim right now. That's very, very solid. I think we have some shots coming through from the exchanges as well. I don't know if we can cut across to it, take a look at what's happening there. Because the bell ringing, of course, happens in about 4 minutes' time. The other one is, yeah, there you go. That's the, I'm not sure that is Indomim or the other one.
That's Extranet.
Extranet, the other one, right? So let's just look at that as well, where Extranet is settled at the end of the pre-open. And we will look at, okay, so I think we did see something come up. Maybe look at the other exchange. And the other one, of course, is Lohia, which is also coming up. Yeah, those are the 3 listings. I think on Indomim, that's kind of a presentation or a promo which is going on. But from the exchange, Extranet, of course, you can see visuals, and Lohia Corp, which is coming up with this listing as well. So those are, I mean, it's a decent start, right? 8.5 on Lohia and about 44-45% on Indomim at this point. So, you will hear from the managements in terms of the forward guidance, etc., post-listing for the first time here on CNBC a little later, especially Indomim. Watch out for that conversation at 10:30. MTAR Tech, we want to just go back to it. Stock was up 5%. I think it's off the circuit now, but a one-way fall and some repair this morning. Ria is here. They reported numbers as well. Ria, take it away.
Well, yes, MTAR Tech today has been reacting positively to its Q1 numbers. Now, it has been a strong quarter for them, and it's a beat across the board this time around, and driven by strong execution across all business verticals as well. Now, in terms of the revenue, that is up 130% compared to the previous year versus expectations of nearly 100% rise. EBITDA also up by nearly 200%. Margin seeing a strong expansion of 540 basis points to 23.6% in this quarter. Even the net profit up sharply by 348% to nearly 50 crores in this quarter versus around 11 crores that we saw in Q1 of last year. So overall, it has been a strong performance for them. But what stands out here is the order book. Right now, the current order book is 5,143 crores, which means the company has already surpassed its FY27 order book guidance of 5,000 crores. So today in the earnings call, that will be key to watch whether the management will up the guidance for the full year and what the execution cycle will be as well. And in fact, there's been another update just this morning after the Q1 results were released that the company has has received an amended purchase order of nearly 3,000 odd crores. So the incremental order value that comes in from this order is around 820 crore rupees. This is from an existing customer. So this is an additional bump up to the strong order book that the company already has. Apart from this, they have retained their FY27 guidance as well. 80% revenue growth targeted for the year with 24% EBITDA margins. So strong numbers all around. Stock is seeing a gain of nearly 5% today after that 40% fall that we've seen over the last month and a half.
Right, Ria, thanks a lot for that. Up around 5% for that stock after seeing a big decline. With that, let's go across to Sudarshan. Top of the pops right now is Balkrishna Industries, up nearly 10% as we speak. Sudarshan, the street really like these numbers.
It has, and the main reason is the volume surprise that company has given 16% up move with and against an expectation in the range of 10 to 12%, and that has led to a sharp increase in the revenue. Both India and Europe segments have done well in Q1 FY27, and it has outperformed the peers by a huge margin. And the main reason is off-highway truck and off-highway tire, and that segment has been contributing, and it's one of the biggest contributors to the company. And total revenue has seen an increase of 24%. EBITDA has seen a jump of 7%, and despite a sharp increase in the material cost for the entire auto sector, this company margin has seen a dip, but the dip is less in comparison to the peer. Margin has come in at 20.6% versus 23.8%. Volumes, as I have told you, has seen an increase of 16% versus expectation of 10 to 12% increase, and OHT, that is off-highway tires, contributes 90%, and carbon black 10% to the total volumes. Now going forward, company is given a strong outlook for FY30 for off-highway tires and for even for other segments, and overall they are expecting an increase in the FY30. So on the back of strong set of earnings for Q1 FY27 and the strong outlook, you are seeing a big up move in the stock price.
All right, so thanks very much for that, Balkrishna, jumping up as we speak. Now the listings, all three on your screen. And Lohia lists at 461. It's a 10% premium. Indomim is at 705. That's a 44% listing. Those are visuals from Indomim. And Extranet is the other one, which is starting with a more flattish 2% kind of a pop on top of the listing price. So those are the three listings on your screens right now. So it's a busy primary market day. And more coming up, right? I mean, as soon as the market starts to do a little better, the IPO primary market tab starts. Manipal, for example, is the next big one, which of course is opens the subscription right now and will be listing shortly. So those are the three new listings this morning. As I said, you'll hear from some of these companies here a little later. We'll take a break. We are back. Manisha joins us with the focus on the commodities space. Stay tuned. Welcome back. Let's shift focus to the commodity space now. Oil is once again in focus. If it's not in focus for being down, it's in focus for being up, but it's in focus. Manisha, morning.
Oh, thank you so much for that. Well, absolutely. It continues to be very, very volatile, Prashant. If you look at the last many sessions, a 3 to 4% of a daily movement is becoming a norm for the crude oil prices. And yesterday, it moved nearly 8%. So we saw $90 a barrel on the higher side therein. And with that, when you look at the month of July so far, it's 24% up. For the year, it has gained by 47% as well. So multi-month highs is where we're trading right now. And the crude oil prices, after gaining so strongly overnight yesterday, have seen a bit of a profit taking coming in for the Asian markets right now. I'll tell you why that has happened. But first, the kind of supportive factors that we have seen in case of the crude oil prices. Well, US, for one, has pledged stronger response after attacks on US forces in Jordan. Tehran continues to insist that it wants to have or be the solely control of the Strait of Hormuz. And that is something that the Gulf countries, Oman, Iraq or US are not, it's not acceptable to them. And then it does feel like that the whole Middle East conflict now seems to be widening, because for the first time ever since this West Asia conflict began, you have Egypt reporting drone strikes on 2 natural gas vessels. They haven't done that before. And then the US crude inventories have declined quite sharply by 7 million barrels in the previous week. This is the largest draw since the month of June. And with this, the US crude inventory is now at the lowest since 2018. Also, when you look at this US strategic petroleum reserve, well, that has been declining as well. So the total inventories have continued to decline, and that stands at a 1983 low. We've seen 18 weeks of constant declines coming in for the strategic petroleum reserves therein. Markets also are looking at Iran-backed Houthi rebels in Yemen threatening to blockade Saudi Arabia. When you look at the overall numbers, well, Saudi Arabia right now seems to be seeking a coalition which they can work with in sense of stopping what's happening in Red Sea at Bab el-Mandeb as well. Market also are looking at the fact that more ships seems to be passing right now via Bab el-Mandeb. If you look at Strait of Hormuz, we have seen a single-digit ship passing therein. Bab el-Mandeb, in the meanwhile, for the month of July, has seen ships passing anywhere between 10 to 15 to 19. But yesterday was 39 ships passing via Bab el-Mandeb Strait, via the Red Sea. And that is what has brought the crude oil prices slightly lower in the Asian markets right now. I also want to quickly tell you about the gold and silver prices, because we've seen a bit of an uptick come in for this one. The US Fed, on expected lines, has left the rates unchanged for a 5th meeting at 3.5 to 3.75%. So you've seen gold prices before the Fed meeting went to below 4,000, but then they went to 4,080 as well. So it has been $100 of a move before and after the Fed in gold. Silver prices similar, $55.50 an ounce is what we saw as a low in the month of July. We are holding at 58 or thereabout right now. $60 an ounce continues to be a stiff resistance when it comes to the silver prices therein as well. And finally, while the US Fed has delivered, the Bank of England and European Central Bank monetary policies meetings in this week is what the street will watch out for.
Okay, all right. Thanks very much, Manisha, for that. So a bunch of cues, what's happening and some of what is lined up. Well, Sensex derivatives, what's happening there this hour? Nigel, take us through it.
Well, that's right. Let's do a quick check then on the derivatives action then. And since it's Sensex is weekly expiry that will play out, let's pull up a couple of strikes. Pull up 2 indices first. Both, you have the auto index as well as the tech index, or the BSE ones. Both of them are doing fairly well in today's trading session, and that's the reason why the Nifty is not falling apart. So both those two up 1% and close to around 2% or thereabouts. Moving to the options data, there is some put writing that we're seeing. So even though the markets, opened up a little bit lower, we are seeing a fair bit of action added on the 77,500 put as well as the 78,000 put. We're holding it around 77,700, but the premium on both of them are down. On the 77,500 put, the premium's down to around 430 rupees. It started the day at around 460 rupees. Similar is the case with around the 78,000 put, because out there the premium has moved down by close to around 40 rupees. The last I checked, it was around 680 rupees or thereabouts. So given that there is put writing, I'll tell you where are the support levels. Going by the options data, it's ballpark around 77,100 or thereabouts. And the 20 DMA is the first pit stop. That's at around 77,250. The screen is telling you maybe this trend is still up, but volatility will pick up in the final hour of trade since it's weekly expiry as well. So watch out for that. For the time being, though, we'll slip into a short break. But on the other side, our special segment, it's the economy. Lata will be discussing what the Fed did overnight and what's the trajectory ahead. Stay tuned.
Well, the big story for the economy is the Fed's pause. The Fed's pause actually did not surprise the equity markets or the bond markets. What really led to the huge equity sell-off and the big jump in yields in the bond markets was the Fed chair Kevin Warsh's press conference. To understand the press conference better, I have with me the undoubted expert of economy, US economy and global economy, Jahangir Aziz, co-head macroeconomics research at JP Morgan. Jahangir, thank you very much indeed for staying up so late for us. We have had this much awaited, historic press conference, if you may say, from Kevin Warsh. What was your takeaway from that press conference, and how many hikes do you see after that chat?
As far as the statement is concerned, it was more or less the same as the previous statement. The only difference was that there were 3 dissent, and the market had 2 dissent in mind. I think Neel Kashkari was the surprise element. So I think as far as the statement is concerned, it wasn't that much of a difference from what the market was anticipating. And if you look at what was happening to the 10-year at that point in time, it was very well behaved. I think what happened was the press conference. I think in the press conference, Kevin Warsh wasn't able to convince or have a credible view, on what is it that the Fed could do to bring down inflation, number one. Number two, even on the question of on the 2% inflation target, he did not really give us a sense that the 2% inflation target based on the PCE will continue to be the target. All he said was that, well, that's what has been happening in the past, and that's what we have at this point in time. And then he immediately pivoted to the 5 different working groups, and therefore the inference that the market got was that despite all the talk about keeping price stability, etc., 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 he didn't really have a very concrete way of articulating what he would do, what would be the target. And even when he was, given, pretty easy questions as to, if inflation keeps going up, don't you think the interest rate hike would be the, necessary instrument? He sort of backed off from it. So I think by the time the press conference ended, there was a lot of confusion as to what exactly is Kevin Warsh's views about inflation, views about monetary policy, where he wants to go with it. And you could see that in the market pricing, right? I mean, just before the press conference, the market was sort of pricing for September, was sort of pricing almost 75% of at least 1 hike, maybe 2 hikes, and a very 25% of people believe that it was going to hold. By the time the press conference ended, the number of people and the percentage of people on hold went from around 25% to about 45%, and the number of people who thought that it was going to be a hike went down from around 70% to 55%. So I think, and of course you saw the 10-year steepen, almost 12, 15 basis points.
Yeah, Warsh also said that he will watch the markets. He asked the Fed to watch the markets. So how do you think this 30-year yield going to 5.12, the highest since 2007, impact the Fed? How many rate hikes do you see, for instance?
I think what happened today makes us believe that, look, parts of the FOMC will start to think about bringing the hike closer. And as you know, FOMC is not one person's committee. It is a committee where the majority view actually holds. And I think that our view is that, look, by December, the majority of the FOMC will move towards a hike. And so we do have a hike in December. Is there a September hike, right? And that's where really the question is. And I think if you get a bad inflation number, now remember the last inflation number, because of what happened to energy prices, was actually very, very soft. more importantly, the core inflation was soft. Now that could very easily reverse. So if we do get a nasty inflation number between now and then, I think even September is a live meeting. But right now we are looking at December hike probably is where most of the FOMC will push the rate hike to.
Okay. Let me move to the equity markets now. As we all know, the chip stocks have fallen very sharply. And markets are also worried about the huge loans and guarantees raised by the LLM companies, AI companies. Do you think there can be defaults or something very disruptive in the credit market or the equity market?
I don't think that this idea that these hyperscalers and the entire AI complex will need to continue to have very large investments is the one that is driving it. I think what is driving is that we all said, I'm using the word collective we, that we all said that, look, you don't really need to worry about the valuations of these companies because look at the forward Ps. That the forward Ps justify these valuations. So on a forward P basis, they were not looking overvalued. The question that was asked and has been increasingly asked is the forward earnings being overestimated. And that's where I think the questions are being raised, that look, we really require the users of AI to continue to spend significant amount of resources and pay higher fees and higher token charges in order for this entire thing to be justified. And that brings you to the big question that, users will pay that provided they see reasonable productivity gains. At this point in time, we haven't really seen those productivity gains. We believe that there will be productivity gains. It's like no one wants to kill the goose that will lay the golden eggs, right? So that's what we're all afraid of. And I think that's where the question is, that you require significant. So we wrote a note, not we, JP Morgan wrote a note, I think about a month back, about what is the amount of revenue that the AI complex needs to generate in order to get a rate of a 10% ROI. And it turns out to be about $800 billion. Now, you really have to think hard as to where that $800 billion of revenue will come. And I think that's where the question is.
Fair point. Okay, now let me come to India. If the Fed hikes in September or in December, as you say, doesn't the interest rate differential argument become very strong? Then does the RBI MPC have to raise rates?
Look, I think the interest rate differential hedged is actually a negative carry at this point, and then it has been a negative carry for a while. So I don't think that the interest rate differential argument is anything new, right? That 25 basis points of rate hike by the Fed is really going to do very much. If you look at the 10-year has already moved more than 25 basis points over the last month or so, yes. Right? So the interest rate differential, the negative carry has worsened because, the forward, the future price, INR, dollar INR rates haven't moved that much. So you're already negative carry. I think the question is, does the RBI look at the rise in the 10-year rate or the expectation of market pricing of Fed rate hikes and look at the impact of that on financial conditions in India and then react to it? Now, in the past, the RBI has tried really hard not to tie the two things up, and more than concerns about the depreciation pressures on the exchange rate, they have really tried very hard to de-link India rate hikes with that of the Fed, and to a large extent they have been successful in de-linking the two of them, right? So the question then becomes is that as the 10-year moves up, do we see pressures on the dollar? Does the dollar strengthen? And does the strengthening of the dollar then spill over into pressures on the exchange rate? And does the RBI react to it? Reaction of the RBI through an interest rate hike to defend the exchange rate will be seen as going back against what they have always said, that they do not use the interest rate to defend the currency. They have been very, very they've tried their best to make that argument. Now, there is an argument, there is a hope, and then there's reality.
Okay.
My guess is that if the dollar does not strengthen disruptively, and if, let's say, it's not combined with another spike in oil prices, the current account remains broadly, where it is right now, I don't think the pressure will be such that they will be forced to use interest rate as a defense mechanism. And I think that's how we are looking at it, right? That, it is probably going to be the last instrument that they use, something like in 2013.
Yeah.
They'll probably exhaust other instruments before they use interest rate to defend the currency.
Okay. All right. The Fed's rate hikes will not influence the RBI MPC so much, but the dollar will. Do you see the dollar strengthening if the Fed were to hike? At the moment it's at 101, the dollar DXY, I mean. Suppose it goes to 105. Do you see it going there?
No, we do see some dollar strengthening taking place, but if the concerns again rise on policy making and institutions within the U.S., this time around, it isn't that people are from the White House are raising concerns about the independence of the Fed. This is Fed basically creating its own problems by making statements that question its own credibility. Then obviously the dollar isn't going to move up. But broadly, we do see some dollar strength going forward, nothing that would be disruptive, and most of that is on the back of a very strident private sector and an equity market drawing a lot of capital.
Okay, what is your take on whether India growth story can surprise on the upside? I'm asking because there is this huge capex cycle in Asia, and in fact, world over, it is having an impact on India's exports. For instance, April-May exports were up 15%. That's Q1. So do you think, how does India growth story pan out for you?
So let me start with 2Q, right? Look, 2Q is going to be a disappointment. Whether that disappointment is real or a result of a statistical methodology, but we don't know. If CSO continues to use the same methodology that is used since 2012, then simply because oil prices moved up, wholesale prices will move up, and therefore that will have a large negative impact on 2Q GDP number. Now, is that real, or will it really be felt on the ground? Look, oil prices at the consumer level did not move up. We know that the government actually put a ceiling on it. Gas prices moved up only marginally. So I think that the actual impact of the oil price increases is largely been felt in the current account and the rupee. It wasn't really felt at the level of households or corporates, etc. India did not see the kind of shortages that people were afraid of that they would see shortages. So I don't think that the real economy actually has been that damaged. The damage has been on the exchange rate and on the fiscal front. Now, because of the methodology, you'll probably see it in headline GDP numbers, right? So it's hard to say that. Now, turning back to your actual question, is there a spillover that is taking place from the Asian capex cycle onto India? I doubt that. If you look at the capex cycle in Asia, whether you're looking at Taiwan or you're looking at Singapore or you're looking at Korea, it is primarily a tech cycle. It is, and in some instances, like in Thailand, etc., there is some amount of that taking place through the build out of data centers. I don't really think that the amount of data centers that are being planned in India, etc., is really going to spark an actual investment cycle. We go back to the old problem. The problem that has plagued India since 2011 is that corporate investment, sometimes shows signs of life, but it's very, very brief, and that sign of life very, very quickly goes away. It hasn't really moved out of that band. And again, I think there are other reasons rather than cyclical reasons such as a tech cycle boom or exports going up here and there. reforms in GST or the banking sector problem that we have thrown at is really the problem behind why corporate investment has flatlined.
Okay, I get it. Not very, very optimistic on a big India growth number. Thank you very much, Jahangir Aziz, for joining us and for staying up so late for us. Thanks a lot. We have to wrap up on Bazaar. Market still a little bit under the weather, in fact, off the highs. We will wrap up on Bazaar. Chartbusters will take the action forward.
Dabur falls after volume growth disappoints. Domestic volume growth of 5% misses street estimates of 6 to 8%. The company cautions that raw material inflation could keep volumes under pressure.
Margin pressure weighs on Waaree Energies. Revenue jumps close to around 80%, but margins miss estimates, contracting to 18% from around 22.5%. Sequential profit more than halves. The stock skids in early trade.
Hexaware tumbles following a guidance cut. Q2 CY26 results in line with estimates. However, deal wrap-up delays and macro uncertainty forces the company to lower its CY26 revenue guidance to 6 to 7% from 7.6%.
MTAR delivers a standout quarter. Strong execution drives an earnings beat across the board. The order book tops FY27 target of around 5,000 crore rupees in the first quarter itself. The company eyes 80% revenue growth in FY27. The stock is locked 5% higher.
And biologics setback hits Syngene. First quarter results swings to a loss after client lost dense growth. Company guides for a single-digit revenue decline and mid-20 margin in FY27.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me today is Ekta. Hey Ekta, good to have you in. Markets more or less flattish kickstart trade, but some kind of consolidation after the kind of run we saw yesterday. I guess it's par for the course.
Hi, Nigel. Yes, absolutely. Just about holding at around 24,200 at this point in time for the Nifty, which is just about flat with a cut of around 24 odd points. The mid caps are underperforming a tad bit. So we have the mid cap index, which is down around 0.5% as we speak, and the bank Nifty, which is down around 0.7% as well. The advanced decline ratio, let's see whether there's any kind of improvement on the advanced decline ratio as we go along. So currently at around 1,400 stocks advancing to around 2,000 stocks declining at this point in time. IT has been resilient in the past couple of trading sessions. So let's see whether that kind of resilience continues into today's trading session as the day goes along. As of now, we do have Wipro, Infosys, TechM, all of these stocks up anywhere between 2 to 3.5%.
All right, well, let's get to the new kid on the block. Indo-MIM lists at a massive 40% premium. The shares of the precision engineering components maker list at a closer around 700 rupees. And those that got allocated around 485, well, they'll be as happy as the team that's ringing that bell out there. Well, let's welcome Mr. Krishna, the whole-time director and chief executive officer on the show. Hi, sir. Good morning. Congratulations to you, the team, the little kids out there. They're getting that opportunity of ringing the bell. It was a very, very happy looking screen. But with this sort of listing comes great responsibility. So let's get straight to a couple of details. I recall when we had a chat the last time around, you were telling us that you can even scale revenues towards around 7,000 crores or thereabouts without too much of capex, which is phenomenal, so that you've got a good growth pathway. Help us out. Now you're at the liberty of giving us some guidance. So what kind of revenue growth are you looking at from here on? How do you see the segment contribution pan out in the coming years as well? Please go ahead.
I think we'll be in line with what we posted in the DRHP. I think in terms of, where the growth is going to come from, I think I'd rather focus on what our strategies are, because that's really what's gotten us where we are today. And I think that's going to be what propels us and continues to drive growth in the company going forward. And I think for us as a group, it continues to be aerospace, whether it's, machining, metal injection molding, defense, land-based gas turbines, medical components, all of these areas have strong tailwinds in the market, and we expect growth in them to be very strong over the future. And I think we're very, very well aligned to take advantage of the growth in these segments over the next 4 to 5 years.
Okay. Mr. Krishna, thanks very much for joining in and congratulations on what has been a great listing for you all. Just wanted to actually narrow down on the segments that you spoke about. While you are qualitatively very optimistic in terms of the growth coming in from these segments, give us some sort of numbers that we could probably work with. Which are the segments which would lead this growth? Which are the segments which are probably seeing the maximum amount of traction in terms of order inflow at this point in time? And what would you probably be most bullish on going forward in terms of growth?
I would say in terms of strength right now, defense, medical, aerospace, and then land-based gas turbines. All are experiencing very, very heavy demand, and we expect that to continue into the future. In terms of, the criticality or the size of some of these segments, I mean, the defense segment in general is very broad and all-encompassing. Hard to really put a number on it, but it's quite large. When you talk about land-based gas turbines and jet engines, I mean, you're talking about a segment that, collectively is easily somewhere in the $50 to $60 billion range in terms of components and manufacturing technologies. So these are very, very, very large segments with a lot of upside and a lot of ability for our company to explore them, both in terms of the types of parts and the number of applications that we can get on. So very, very, very ripe for growth for the future.
Okay. All right. Taking the liberty of calling you KC, as you refer to by your team. 7,000 crores odd is what you could go
KJ
to?
is actually better. KC is my dad.
Okay, so you are?
KJ.
KJ. All right.
KJ.
KJ, 7,000 crores possible by FY29. Could that be a rough estimate you're working with? Because I'm looking at it in the past, you've grown by at least 25%. So even if you compound at around 20%, you'll still get to that more than 7,000 crores of revenues. Do you think that would be the outlook, say by FY29
that is
you
correct.
get to around 7,000 crores? Or do you think that I'm being conservative and you could actually do it in FY28?
I think that, you know, what we have in the DRHAP is about, for next year, is 10%. I think that, you know, achieving those types of numbers is definitely very possible. But obviously, you know, it's something that we've got to focus on. I don't think I can really say like what exact numbers we achieve when at this point. But over the 5-year, yes. I mean, we believe 10 to 15% growth is what we're going to be doing. We try to be a little bit conservative so that we overperform. But I think that, you know, what you're talking about is something reasonable.
And margins will hold in the high 20s. You know, you've been doing around 20 to 30% odd. So you stick to that guidance?
I think we'll do well. I think there's a lot of operational leverage in the company that can be unlocked, which gives a lot of stability in terms of the long-term profitability, because, you know, obviously there will be a significant operational leverage as capacities fill. But, you know, the exact operating margins are going to be depending on, you know, what type of business we bring in. And, you know, that's something that's a little bit difficult to forecast. But we think that, you know, what we're doing right now should be in line with what we're doing over the 5-year.
Okay, all right. Just quickly, Mr. Krishna, you know, if you could just touch upon what's taking place in terms of the global markets at this point in time. How much do you get from exports? Is that facing any kind of headwind because of the kind of geopolitical scenario that we're facing at this point in time? As well as China plus one. Is that an opportunity for you, and is that in any way showing in your numbers?
So first, I think the geopolitical situation, obviously it's something that I, you know, have had, and we, the management of the company, have had our eye on. You know, but what we don't see any major reductions in demand in any of our markets as a result of what's been going on in the Middle East. You know, in terms of where, you know, shipments and things like that, we haven't really had any logistics disruptions, although definitely it's been something that our logistics team has been keeping an eye on. So going forward, yeah, I mean, I think so far for this year, despite the energy shock, I mean, the outlook on the world economy looks pretty good. Although, you know, what happens in the Middle East could change that, but so far so good. Demand is holding up. I'm sorry, what was the second question?
China plus one. Is that in any way an
question? China plus one. Absolutely. You know, we do compete with China on precision components for a variety of applications. So OEMs moving from China to India and establishing operations is definitely an opportunity. And we've seen some of that happening, you know, where there are more programs, more willingness to source from India as either a China plus one or in some cases a substitution for what they were doing in China. But yes, China plus one or substitution. This has been something that's been gathering some steam since I think about 2022, and we expect it to continue in the future. And it's definitely you can see it in our numbers and in terms of the types of programs we're doing and the type of business that we're now doing in India.
Okay, all right, KJ, have a great day. All the best in the time to come, but enjoy the day. It's a big listing. You, your team, family, and the little ones as well.
Thank you so much.
Have a blast today. Well, time to slip into a short break. Come back, we'll get chatting with another management, that of Equus, who had reported their numbers. Stay tuned.
Welcome back. Well, you're watching Chartbusters on CNBC TV 18 this morning. Let's get talking to another company. Equus delivered strong revenue growth in Q1. Profitability, however, came under pressure amid investments across businesses. Aerospace continues to be the key growth driver with a $1 billion order book in hand. We have with us Arvind Melligeri, who's the Executive Chairman and CEO of the company, joining in. Mr. Arvind, thank you very much for taking the time out. Well, you know, aerospace remains your key growth engine. It's really driving your numbers and continues to do so. So just give us a sense in terms of what went right this quarter for you within the aerospace segment, and what is your guidance in hitting that $1 billion mark when it comes to the order book in aerospace?
Yeah, just thanks for having me. Look, I mean, both aerospace and consumer had a good quarter. I mean, we grew like 40% in aerospace year on year, and sequentially also we grew quarter over quarter, and our consumer grew year on year by 190%. So we had a great both top line growth, and consumer also is a key driver for us apart from aerospace. Aerospace has performed well, and we are on target to get our 20% EBITDA level, and also the operating EBITDA, and also we are growing our ROCs, and ROCs are in line with 20+% what we have committed, and our order book first time in the history has been $1 billion, crossed $1 billion. So a big milestone for us, and it continues to grow. It grew more than 10% quarter over quarter, our order book. And we have laid out a 5-year roadmap of how we are going to grow this business 4 to 6 times over 26 numbers. And we are on path to do that. On the consumer side also, it's encouraging to see that not only top line growth happened on sequentially, and also we have reduced our losses sequentially. So that is the trend what we are committed to be a break-even EBITDA by Q4 of this year on the consumer, and we're on path to do that.
Okay. Hi, Mr. Melligeri, and thanks a lot for joining in. Congratulations on this $1 billion order book in the aerospace. Give us a few details, though. Would you need to put on additional capex, additional capacity to service this sort of an order book, if you could help us out? And broadly for the company, what should the capex number look like for FY27 as well as FY28? Please go ahead.
Yeah, if you really, we laid out about 660 crore of capex for the current year. We are not finalized our capex next year, but overall, over the next 5 years, we are committed capex about $400 million US dollar investment between consumer and aerospace. And this year, we are split about 660 crore. We will end up most likely accelerating our capex on the aerospace side, looking at the momentum what we have done, have gotten on the aerospace order book and the consumer. But total, we might moderate between the consumer and aerospace may be more than the consumer. So, but overall, our capex will be within the range what we are committed, about 660 crore this year.
Okay. Just coming to the consumer revenue segment, where, sir, you said that you're quite bullish about the performance that of the segment in the quarter gone by. 19% of revenue contribution, how much do you expect it to possibly go to maybe a year from now? And when you talk about the margins and the profitability of the segment, what can you guide on?
Yeah, I mean, the long-term outlook, what we have laid out in our investor day was, our goal is to most likely to get to 40% level consumer as overall by 2031 in the business, whereas aerospace continues to grow, and our consumer margin targets are similar 18 to 20% EBITDA levels, and similar ROC levels what we are talking about. So I think we are in consumer side, consumer electronics, mechanical, enclosures are key areas of our growth, and that's where we are investing. That's high precision activity, and that's very similar to what we see in our aerospace margins in the long run.
Okay. Your longer term target for 2031 is 4 to 6 times revenue growth, 18 to 22% EBITDA margins. Just tell us how exactly are you planning to get to those levels, and what would be the key drivers, and what might be the key risks as well, if you could highlight that?
Yeah, I mean, that's a range what we are given aerospace side. Our growth, if you look at our order book, it's almost like 9 year of our current year run rate So obviously that acceleration is going to come because of that. And this typically, our order books are typically executed in 4 to 7 years. So if you really look at it, that translates to a significant growth in front of us already, with our order book. And obviously the risk is, today is a geopolitical is a big risk on the supply chain side we see. And we have been able to manage through all the West Asia crisis and various other issues what we have seen through. And although there was some impact of the working capital last quarter, but we are fine back into normal working capital range. That's one of the big things. Tariff, luckily, aerospace seems to be able always been historically been, not having any kind of a tariff because it's really a global trade. We buy aircraft from somewhere else, and they buy from components and equipment from all over the world. So it works in that fashion, and generally accepted practice in the industry is there's not any tariff on this, especially for the manufacturing side of it, OEM side of it, and it has worked out well. And we feel very good about where we see right now and the order book and our customer order books they're booked for 10 years. If you really look at it. So there is we don't see any market perspective risk. It's more from supply chain side of risk. We have seen through Russia-Ukraine war, that impacting titanium. And then, the Red Sea issues, we've seen all sorts of issues. But we are able to overcome and continue to support the demand what is required in the market.
Got it. Just a quick word. The CapEx guidance for this year is how much? 1,660 or 660?
660 crores.
660 crores, right? And the defense foray, what is the CapEx that you're lined out for that?
That's not very significant because it's a joint venture.
Okay.
So the joint venture we are doing Ajna joint venture. So that's we are putting initially a small token investment right now, and that's going to get evolved over a period of time.
All right. And in terms of scale, in 2030, how much revenue can you get from this particular joint venture, defense joint venture?
We're not split that. That's considered as part of aerospace and defense. Actually, that revenue itself is not factored into the business because it's a one-third equity JV.
All right, Mr. Meliguri, I think the street is hearing what you had to say as we speak. The stock has recovered from the low point of the day. Wish you and the team all the very best, and we catch up as this quarter progresses. For the time being, we slip into a short break, come back, continue our focus on markets. Stay tuned. Welcome back. You're tuned into Chartbusters. As promised, let's turn our attention to our special segment, Money Control Pro. Anubhav Sahu joins us to tell us about a stock that is tracking closely. Anubhav?
Well, talking about Himadri Specialty, which posted a strong Q1 and indicates that company can reach the 1100 CR profit milestone earlier than the guidance for fiscal 28. Now, growth levers for fiscal 27 largely rest on ramp up of facilities for specialty carbon black and Birla tires. Himadri had added 70,000 ton capacity for specialty carbon black earlier, which increases the overall carbon black capacity of 40% and doubles the capacity for specialty carbon black. Other key driver for the valuation is the battery components business. We believe it is still early to assign a value contribution to our estimates, given the huge capacities in China and a reasonable gestation period with respect to client approvals. This is true for both anode and cathode components. Now, anode material is undergoing sample validation cycle and expects client approval in 12 to 18 months. Similarly, demo capacity for cathode active material is expected to get commissioned by Q3 of fiscal 27. Now, this would be followed by client approvals, wherein fiscal 29 is targeted as the year for full phase 1 operations. Now, with this context and also the case that stock has already run up by 80% since March of this year and currently trading at 28 times EV by EBITDA for fiscal 28, we think it is prudent to take some profit off the table.
All right, Anubhav, thanks very much for joining in. And on that note, it's also a wrap from Nigel, myself, and the entire Chartbusters team. Thanks very much for watching. Trading Hour up next.
Morning, you're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormaz and Ritu as always. The market absolutely flat right now, and I would take that as a win, largely because, we've avoided an accident. The Nifty Bank is down by about 0.6%. The IT index is doing well. The broader markets are seeing a big decline as well. We have nearly 1,700 stocks which are declining for about 1,200 stocks which are advancing. And amidst everything else, crude prices, crude oil, has now inched back to levels near $91 per barrel. It could have been much worse for our frontline indices, but that's not the case. So maybe we've avoided an accident, and a flat move is actually not necessarily bad, Ritu.
It's not bad at all, and we're staying above that 24,200 mark. That's also very, important and good that we're doing that. It's the IT pack that's really helping, despite pretty much everything in the red. You have names like Infosys, HCL Tech, Wipro, all of them doing well in trade. In fact, you also have Reliance, which is adding heft, to the up move for the Nifty. That's why you're not seeing it in the red. M&M, HDFC Bank, all of that on the plus side. But of course, that's countering some of the negative that's coming in from the realty space. All these interest rate sensitives, the financial services, of course, metals, all of that pretty much in the red. But like you said, the broader markets are also seeing pain. The bank Nifty is seeing cuts, and, the market breadth shows you more stocks are declining than the ones that are advancing. So let's get in the list of specific names to keep on our radar. And Hormaz has walked over to the wall with that list. Good morning, Hormaz.
Morning, Ritu. And, well, you can call it a good morning because of the fact that considering how Wall Street sold off, with the way Asia has turned negative again, we are still managing to hold about on the flat line, and we would take that with both hands, at least as of now in the first couple of hours. The Sensex monthly expiry as well today, holding on to 24,200, 24,250. It's just been a 50-point range in which the Nifty has been meandering all along. And the Nifty Bank, again, has been the principal culprit as to why the gains are under check. The Nifty Bank has been an underperformer all through last week and this one. So another 350 points knocked off on the Nifty Bank. And well, credit to the fact that IT, after 3 days of gains, is adding on to that. So another 1.5% on IT, although the index is slightly off the highs of the day. But still, even after the way Wall Street sold off yesterday, a lot of the IT names were still higher. You take a look at the earnings reactions. It was a very busy day yesterday in terms of results. It is a very busy day in terms of results today as well. Reddington is the top gainer on the Nifty 500, 10.5% higher. Balkrishna Industries is slightly off the highs. That too was up 10% at one point. And Moil continues to build on to those gains, now 9% higher after its results. On the flip side, the negative earnings reactions are far more compared to the positive ones today. Syngene is slightly off the lows. Still down around 6%. Hexaware, after its cut, after the guidance cut, is also down around 7%. Vari was down 6, now down 4.5%, and Prestige Estates too down around 3% after its results. The one stock that was the highlight of yesterday's session, at least in the afternoon, was KPIT Tech. The stock went up as much as 10%, cooled off slightly from those levels, and now is down around 7%. Axis Capital has downgraded the stock, is projecting another 27% downside even after the stock has collapsed more than 50% this year. So KPIT Tech, another accident that's taking place today, and some profit booking from some high-flying names after their results yesterday. PCBL Chemicals was up 16% after its results, is down 7% today, and J&K Bank is seeing some cuts as well, was up around 13% after its results yesterday. Look at the listings of today. 3 companies made their stock market debut. The highlight comes from Indomim, 47% higher on the stock today on its listing, more than its issue price. The Loya Corp too, a 17% premium now to its issue price, and Extranet still holding on to some gains on the trading debut. And lastly, stocks at 52-week highs. Look at SML Mahindra, was up 20% yesterday, up almost 20% today as well. Karnataka Bank is up 3.5%. Sona BLW2 up around 3%. All of them trading at 52-week highs, Ritu.
All right, Hormaz, thanks very much for running us through that exhaustive list. Let's invite our first management for the day on the show. Team Lee Services has reported a steady set of first quarter earnings, revenues, profits. After tax, they rose on a year-on-year basis. Specialized staffing also continued to see strong momentum, even as general staffing that was impacted by BFSI headwinds and softer hiring trends. Joining us now to discuss the performance is Ramani Dati, the CFO of Team Lee Services. Mr. Dati, thanks very much for joining us here on CNBC TV 18. Before we get into any of the numbers, just a broader trend on what you're seeing on hiring. I mean, whether that's IT, BFSI, across the board, we're seeing cuts. Is the second half of the year shaping up to be any better?
Yeah, good morning. Let me start with IT hiring trends first, because now we are seeing very positive trend even within IT services, which has been lagging for almost over 3 years now. In addition to GCC hiring, which has been consistently strong over the years, now IT service industry also started hiring, especially more on cutting edge technologies, niche skill set talent is where we are seeing higher preference, like AI, cybersecurity, ML. So these are some of the skill sets that companies are looking for. So on IT front, we are seeing a very strong trajectory. Coming to non-IT, about a quarter back, we sense that there'll be a steady growth of about 8 to 10% in overall volume growth, which now looks little softer, especially because of BFSI little dip in their hiring, overall hiring trends, which is one of the largest contributor for formalized employment. And also retail, FMCG, FMCD, because of weaker monsoon, the early trends are little soft. So from that perspective, we believe that the overall hiring trend in non-IT this year can be 1 or 2 points lower than what it was last year.
Ramani, you've called out BFSI as a soft vertical because of the retail, unsecured retail credit correction. Based on the trends that you are witnessing currently, is that hitting a bottom, or do you believe that this caution will percolate into the second quarter and even possibly in the second half of this year?
For one more quarter, for sure, it looks like, because typically we get a 90-day advance trend in terms of where the open positions are, which industry is looking for new hirings. So from that perspective, at this stage, Q2 is still looking little weak, especially from BFSI perspective. But having said that, Q3 and Q4, based on the early discussions that we are having with our clients, we are positive that there is a recovery that we can expect in second half of this year.
Right. This morning we were speaking with the management of Quest Corp as well. They did indicate that the kind of jobs that are still fairly active in the software side of things does not give them, does not worry them about the influx of artificial intelligence. And I'm sure a lot of people ask you this as well. Is the GCC demand pipeline still strong enough? And what kind of software professionals are being sought after by companies right now?
No, that's a very good question, because of AI, we are seeing a significant impact on coding and testing jobs, the traditional IT software related jobs. There has been an impact. In fact, over the last 4 or 5 quarters, we've been consistently seeing a reduction in overall number in terms of these traditional roles. Having said that, since our specialized staffing has strength around mainly the new age technologies, be it AI, ML, cybersecurity, data analysts, project management, cloud management, for these kind of skills, we are seeing higher demand, not just from GCCs or IT services, even any industry, like any company right now, almost all large enterprises are investing in their digital transformation and AI transformation journey, for which they are looking for these niche skill set talent. So that's why we are seeing a very good demand, especially at mid and senior level, not so much at the entry level.
Got that. I just wanted to understand what's happening with your non-core businesses. I mean, for instance, you've divested 30% of your stake in Crystal HR. What really happened there? What was the concern that led you to divest this? And would there be more from your non-core portfolio?
It's not like a concern, because we did the acquisition about 18 months back. And as part of our investment agreement, we have this provision to exit our investment, depending on how our portfolio mix changes and how the outlook on HR tech as an industry looks like. So the board has taken a very deliberate decision in view of the overall capital allocation and portfolio rationalization to exit this particular investment, because in terms of size, it's a very smaller business unit, and the management bandwidth that is needed in terms of integration and overall management time to be spent on the deal, we felt that from overall rationalization perspective, it is better that we exit wallet. Having said that, we are continuing the commercial partnership with wallet. So we are going to have some joint sale pitches to prospects between TeamLease and wallet, especially for HR tech and payroll management services.
How much did you invest in this, Ramani? You mentioned you did it 18 months back. Did you make a substantial return on this before your disinvestment? And is there a timeline that you have set out to divest the remaining portion as well?
We have fully exited. We don't have any balance sheet. Yeah. So we have acquired 30% stake in the company at about 10.12 crore of cost of investment, and we recovered the full cost of investment and exited the entire 30%. And the board may continue to look for more portfolio rationalization, because we are also looking for some very strong high margin M&A pipeline. So for our capital allocation for newer areas where we need to build capabilities, we may have to rationalize one or two smaller business units that we currently have in our non-core verticals.
All right, take that point. Ramani, thanks a lot for that. Wish you good luck for the remainder of this year, and may the momentum continue. With that, we take a short break, come back. On the other side, we get you more on the markets, a lot of stock-specific action. In fact, we also focus on the bond market action with Manisha Gupta.
Welcome back. As promised, let's focus on the bond market, and Manisha Gupta joins in with all of the action there. Manisha, a bit of an inch up there in the yields today. What's happening?
Oh, well, absolutely. The market's absolutely reacting to the U.S. Fed meeting yesterday, the kind of statements that we've seen. And as the U.S. yields edge up, exactly what we saw in the opening trade for the 10-year bond yields for the Indian markets as well. Well, it's tracking the spike in the U.S. Treasuries after the Fed rate pause therein on anticipated lines there. But it's interesting with the kind of numbers that we have, or the list that we have for the private bond issuances therein. I have a long list. Yesterday was a good day as well. 105 or 103 billion rupees rupees of private issuances were done yesterday, and you have a stronger lineup today as well. To begin with, you have Share India Securities. They are planning to raise nearly 1.5 billion, and they are doing it via issuances of August 2028 bonds maturing. Tata Projects should come in on your screens as well. They are doing 4 billions, and they are looking to reissue 3-year bonds maturing on 2029. You also have NIF Infrastructure Finance Limited. They also are looking to raise 5.5 billion, and they're doing it via bonds which are maturing in 2031. Nifty Sensex is on your screens as well, and 1.7 billion is what they're looking at as well. They're also doing it via reissuing bonds which are maturing in 2028. Northern Arc is on your screens. 1.5 billion is what they're looking for in sense of bids. They're trying to raise that money with bonds which are maturing in 2028 as well. Geo Credit should come in on your screens. It's a wholly owned subsidy from Geo Financial Services. They're looking to raise something like 20 billion, and they are doing it via issuances of bonds which have different maturities in last 5 or 7 years. Hero FinCorp also is looking to raise up to nearly 5 billion, and they're doing it via issuances of 2-year bonds which are maturing in 2028. But the largest chunk or the biggest bond issuance today clearly comes in from Ultratech Cement, which is planning to raise nearly 50 billion, and they're doing it via issuances of 3 bonds with different maturities. As it goes through, this would be Ultratech's biggest rupee bond funding that they are looking at, something that the street will watch out for today. So big companies today and larger issuances coming in as well.
Manisha, thank you for that update there. The market's looking to take a bit of a leg up now. 24,280 is where the index currently stands. So moving, or slowly but surely, trying to move higher towards the higher end of today's trading range, which has been nothing less than 60 points. Now, from a low-cost airline to now a dominant force in the Indian skies, Indigo's 20-year journey is one of resilience and cost efficiency. Now, in an exclusive conversation with Shireen Bhan, Rahul Bhatia reflects on the December fiasco and the corrective measures taken by the airline. Listen.
This badgering, the fear of a monopoly, the fear of this emerging as a national vulnerability has only started post what happened in December, which was a debacle. There's no other way to sort of put it. That's where I wanted to push you a little bit. Are there limits to this lean, mean machine that you've operated for 20 years? And were those limits really tested in December?
No, I mean, I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet a couple of days before that. There was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption in Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some carriers larger than Indigo that have been through issues like that. Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is it something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
So what is the pilot ratio, in terms of buffers that you put in place, given the fact that optimization was held up as one of the problems?
I'm not close enough to what are the buffer ratios, pilot ratios, and the buffer we keep in the company. But what we know is that in terms of cockpit availability, we are good for the foreseeable future. And our only appeal to the government has been that when you look at FDTL regulations, look at it from 2 lenses. One, that we must do what is best in class on a global basis, right? Look at regulations around the world and figure out what's the right thing to do. But if we put in regulations in place which actually, in the garb of being safe, make the industry as a whole uncompetitive,
But from the time we started the show, the Nifty's actually put on about 20 points, and a large part of that could be attributed to not only the IT pack, but a couple of these auto names which are doing extremely well as well. Hero MotoCorp is now up around 3.5%. We are seeing some traction build on Maruti as well as M&M as well. And, Nestle, it's an outlier in the otherwise FMCG pack today, which is seeing a bit of a decline. So if the director pulls up both the FMCG index and Nestle, you would know that the stock has been a rank outperformer. The FMCG index largely in the red, currently at the low point of trade, whereas Nestle is the one which is higher because obviously in terms of numbers as well, despite the valuations, the company has been outperforming street expectations for the last many quarters. But let's go across to Ekta now. Syngene is the one which is lower today on the back of a weak showing in the first quarter. In fact, let's go across to her to take stock of what the commentary was from their earnings call. Ekta.
Well, yes, definitely a disappointing quarter which came in for Syngene this time. The revenue declined around 16%. Margins came in at around 12%, which was a multi-quarter low. And they recorded a net loss of around 9 crores this quarter. Now, one of the key reasons, and this is from the conference call, is also that there was a loss of client Zoetis in the biologics business, which impacted the Q1 numbers. So basically, that Zoetis business was around $50 million of the total sales, or in terms of a total client value. And they do still service the client, but the inventory build-up is enough that it is slowing a little bit at this point in time. Now, guidance is that they expect single-digit revenue decline in FY27 in rupee terms. The business momentum is expected to return in the second half. The company is looking to return to sustainable double-digit revenue growth in FY28, and they're holding on to their guidance of 20% margins in FY27. The margins, according to them, should be aided by cost optimization, and even the Biosecure Act could be one of the triggers for Syngene going forward. Kiran Mazumdar-Shaw, who is now going to take on the role as executive chairperson, has said that FY27 is a transition year and course correction for Syngene. They have taken a hard look at the business in the past couple of months and need to move away from more commercial, lower margin business. CDMO is going to be the primary engine of long-term growth, and integrating AI will be one of the priorities across the workflow, according to the management as well. So yes, Zoetis, the business dwindling from that particular client is one of the key reasons why this quarter was impacted, and they are looking at FY27 as a year of course correction.
All right, Ekta, thanks very much. Have the Syngene stock down almost 5.5% as we speak. But take a break. When we return, we'll get you an exclusive conversation with the management of Dabur India. Mohit Malhotra will join us on the quarter gone by and the road ahead. Stay tuned.
Welcome back. We're speaking about the FMCG numbers, and let's go across to an exclusive interview that we've lined up with the management of Dabur on the quarter gone by and the road ahead. Remember, the company reported a near double-digit revenue growth, near double-digit EBITDA growth as well, with near 5% volume growth in the first quarter. The stock mildly lower right now, but remember, the revenue growth has been the highest that we've seen in the last many quarters. Mohit Malhotra was the MD and CEO, the global CEO of the company, joining in right now. Thanks a lot, Mohit, for joining in. Congratulations, it's a good set. Does indicate some improvement in demand. And for you in particular, you've said rural outperformed urban for the 8th consecutive quarter. My question to you is, you've said that you're targeting double-digit revenue growth in FY27, with pricing being a little more than volumes. Could you get a little more specific? Are we looking at low double digits? Are we aspiring for teens sort of growth this year? And when it comes to volumes, you said there could be some pressure because of inflation. So does this mean that 5-6% volume is what the expected range should be, with the rest coming in from pricing? Mohit? All right, we'll try and repatch that connection with Mohit in just a bit. I'm not sure we can hear him or he can hear us. Mohit, can you hear us? All right, so we'll just try and repatch that connection. But in the meanwhile, if you look at Dabur's numbers as well, the revenue came in at 3,764 crores. The poll was 3,771 crores, so pretty much in line. We had the EBITDA margins just shy of that 20% mark as well, with a net profit at around 586 crores versus expectations of 573 crores. The stock's marginally lower right now, and that's because of a couple of factors. One, the volume growth that came in at 5% versus a poll of 6 to 8%, so there's a marginal miss. And if you looked at the move yesterday, it was up by about 2.5% in line with what the other FMCG peers were doing. So it's pretty much the template that is playing out. A marginal miss has actually led to the stock declining right now. I believe we do have the connection back with us. Mohit, you can hear us, right?
Yeah, hi Mangalam, I can hear you, yeah.
Perfect. So, just to repeat the first question, you said that you're targeting double-digit revenue growth in this year, with a large part of that coming in from value as against volume. So I just wanted to understand if you could get a little more specific in what the double-digit means. Would it be low double-digit? Are you looking at teens? And volumes, do they cap out at this 5 to 6% mark with the incremental coming in from volume? Or do we see an incremental volume growth coming in the second half as well?
Yeah, so like we had guided before, Mangalam, we are targeting a double-digit growth. The mix of volume and value is changing. We want to protect our market shares, which are more volume-driven. So it's a good thing in the FMCG market. It has to be a balanced mix between the price and also volume. So only volume also becomes a pressure. So a part volume and a part price, I think actually works in the favor of any FMCG market. It also helps us bolster the double-digit growth. At this point in time, with the war happening, I can't tell you whether it's going to be a high teen growth or but double-digit growth, definitely. That's the target that we've taken, and we'll protect our volume market shares going forward also. So it will be a mix of a volume and the price, both put together. And we don't want to compromise our volume market share. So we'll be driving volume through rural, we'll be driving volume through our premiumization, through e-commerce, through modern trade, etc. So while there will be a price increase and some near-term pressure on the volume, but over a period of time by investments under brands, I think it just gets covered up in a month or so. And one thing working in our favor is that due to GST, the prices have actually come down. So even post-price increase also, the prices in the market are lower than the pre-GST levels. So that is helping us buffer the impact of prices because of the GST increases in price. Yeah.
You ended last year with margins of around 18.5%. The first quarter has moved to about 20%. Could you give us a sense on what you are expecting for the full year on the gross margin and the EBITDA margin front, largely because obviously the input costs are fairly volatile, and a share of products sales coming in from premium, because that grew at twice the average growth of the company, right? So what's the current proportion and how much is that likely to be by the end of this year?
Yeah, so premiumization is at 2x, and the extent of premiumization is more than around 20%, is ahead of the targets that we've taken, around 18%. So that's chugging on well for us. That is leading to around 200 to 300 bips of margin expansion for us due to the premium portfolio. Along with that, the price increases is helping us completely buffer the impact of the material inflation which is coming because of the war. So we expect the margins to improve vis-a-vis the last year in the current year. But so overall, profitable growth is what one is looking at. And the growth in operating margin should be higher than the growth in the top line growth. And also the profit growth should be higher than the top line growth. That's what we've guided the market and that's what we'll maintain.
Mohit, even though the rural market continues to outperform your urban ones for 8 quarters now, these concerns about El Nino, monsoon deficiency, all of that, is it beginning to temper demand there? What are you seeing on the ground and how do you expect this portfolio to behave in the second half of the year?
See, as far as urban and rural is concerned, as far as the market data from a Nielsen standpoint is concerned, it's 170 bips. Rural is trending ahead of urban. So there is no problem. And in terms of our data, if I look at my primary, secondary or tertiary data also, it's 550 basis points ahead of urban. So the situation on ground is that rural is firing on all cylinders and so is urban on back of e-commerce. So the economy is pretty resilient on ground. But El Nino impact and the paper news and media releases are saying that it might impact. Now that I can't tell upon because even the monsoon deficiency has actually got covered up. It's only to the tune of around 10 to 15%, which doesn't impact the Kharif crop also. Plus, to top it up, government has also increased the MSPs. So I think all this should help actually to have a balanced growth between urban and rural. And both urban and rural are doing well and I think should continue to do well going forward. And as far as we are concerned, we are pretty much more reliant on rural and the expansion possibilities are huge in rural for us. We are only reaching out to around 1.3 lakh villages and there are 6 lakh villages. Huge headroom to grow in rural. Plus, we've created LUP, low unit price point bundles, which will only, leverage our rural distribution. So I'm really not concerned as of now between what's happening. Yeah.
Mohit, your international business is around about a third of your top line, and with the current developments that you're witnessing in West Asia with the recent flare-up yet again, was there an impact firstly during that quarter of this, and do you see any further impact? What are your growth plans for the international business?
Yeah, so international business is around 30%, and international business in the current quarter has grown by 15.5% for us. And, one thing which is helping international business while Middle East, which has got impacted by the war, is only around 10% of the total international business for us. 10% would mean overall business is only around 3%. That has got impacted by the war. Despite the war and the related issues which came with the war, which is inflation, which is freight, which is Strait of Hormuz, etc. So that also the growth has been around 9% for us in the Middle East. But rest of all the geographies have grown by high double digits for us. It's 20-25% growth. Like Sub-Sahara Africa has grown by around 23% for us. Turkey business at 28%. Egypt at 25%. America-based business, which has also grown by around 17-18% for us. And to top it up, because the Indian currency depreciated, the translation gains have been huge for us. So there also, that's why you see around 15.5% growth. Now, inflation impact is there because of the petroleum prices actually moving up, for which we've taken price increases. And we expect a double-digit growth in international business going forward for the full year.
All right, no slowdown, rural or international. Mohit, take that. Thanks very much for joining us here, on your first quarter performance, and we hope to have you back, sometime later, after this quarter as well. For now, we slip into a short break, but when we return, we'll be joined by SM Lakshmanan of Thangamayil Jewelry to discuss their quarter one numbers, so stay tuned.
Welcome back. FMCG numbers flowing in thick and fast. We have Gillette, which is up around 11% in revenue. We have EBITDA, which has grown slower than revenue, which indicates margin compression. And that is explaining why the stock is down about 2.5%. Remember, the stock's been a big mover. Margin compression would largely be on account of higher raw material prices, in particular for the raw materials that Gillette uses, which are either crude linked or metal linked as well. But for them, the overall opportunity at large in the female products is increasing, and that's exactly why the stock had seen a big move earlier in the past as well, moving beyond Gillette and premiumization to the Venus range of products. So as of now, on these numbers, on account of margin compression, the stock sold off. But let's see what the management has to guide for in terms of demand. But speaking about management guidance and that having an impact on stock prices, let's look at Thangamile. Today, the stock is down 10%. Yesterday, it was down 10%. And prior to that, this entire year, the stock has nearly doubled. In the last 12 months, it's moved about 3.5 times. Every time we spoke to the management out here, they were fairly sanguine on growth prospects, barring yesterday post-earnings, where Mr. S.M. Lakshmanan and the management of the company did indicate some sluggishness in demand quarter on quarter and no visible uptick even in the second quarter so far, which explains why the stock has sold off the way it has. So let's take this discussion further with Mr. S.M. Lakshmanan himself. Thanks a lot, Mr. Lakshmanan, for joining in. And, thank you for being so candid about the sluggish nature of demand right now, because while there has been increase year on year, then there was no doubt about that. Quarter on quarter, there has been moderation. And you've said that so far in the first half, in the second quarter, you haven't seen any visible uptick either. So what does this entail in terms of your first half revenue prognosis? And how much of that are you likely to recover in the second half? And as a result of which, what does this make your annual guidance to?
Good morning, Mangalam. Thank you for the opportunity. Thangamile Jewellery Limited has achieved a turnover of 2,662 crore rupees for the first quarter of this financial year 26-27, registering a retail revenue growth of 67%. In terms of volume, gold increases by 9% and diamond increases by 23% year on year. Yes, as far as going forward is concerned, Q2 has started on a moderate note. This is due to primarily two factors. One is the continuing West Asia war uncertainty, and the second one is expectations on the part of the customers that the gold price might moderately fall further. Anyhow, the company is at the same time hopeful of getting back this postponed demand in the remaining months of the financial year, more particularly in the second half of this financial year 26-27.
So what does this mean for your full year guidance, sir, when it comes to revenue? And if you could break that up in terms of same-store sales growth, value and volume as well?
Mangalam, not trying to share the revenue guidance numbers at the moment. Certainly, the company is hopeful of getting back this postponed demand in the remaining months of the financial year, more particularly in the second half of this financial year, as the remaining months are going to be having a period of continuous festive seasons and wedding seasons. To answer your question about the same-store sales, yes, for the first quarter, the company has done 44.40% SSS revenue growth.
Mr. Lakshmanan, are you seeing this sluggish performance in the first few days of this quarter across your stores, or is it divided, whether it be in Chennai or in the non-metro centers, or is it across the board? What are the kind of trends that you are seeing?
Yeah, probably, Hormaz, the feeling could be a general one across the showrooms. But to answer your question about the Chennai showrooms, yes, the Chennai revenue composition is 20+% for the first quarter, and the Chennai showrooms have been satisfactorily doing well.
Mr. Lakshmanan, gold, of course, dominates the business. You've spoken a bit on that. The non-gold part of the business, how's that holding up? Diamond, you said, is doing pretty strong year-on-year growth you're seeing. How do you expect this to evolve in the coming few years? If you could give us some targets on how the non-gold portfolio is growing.
Yeah, non-gold revenue keeps increasing at 88% year-on-year during the first quarter. And a product like a diamond seems to be doing wonders in the company. And these non-gold revenue sales should be able to increase the bottom line also as far as the company is concerned.
Since you're speaking about the bottom line, I wanted your thoughts on the margin as well. Because, the first quarter, your margins moderated by about 220 basis points quarter on quarter. And this, despite the, I'm supposing that there could have been an inventory gain coming in on account of the increase in customs duty as well, from 6% to 15%. You would have been left with some inventory on your books which was 6% paid. So there could have been that one-time gain, which basically means that, the margins would have been actually a lot lower than what you've reported as well. So what's your full year margin target? You've typically spoken about 6%. Last few quarters, you've gone above 6%, 7% as well. But now the first quarter, it's closer to 5%.
Yes, Mangalam, as far as the margin is concerned, EBITDA stands at 5.76% for the first quarter on the retail revenue, maintaining more or less the same level as compared to the previous year's first quarter of 5.78%. And yes, the company would like to retain or maintain the EBITDA margin target at 6%.
Pleasure having you as always, Mr. Lakshmanan. Thank you for sparing time and talking to us. Wish you good luck for the rest of the year as well. The management of Thangamal Jewelry there down, locked in 10%, a lower circuit, a similar trend emerging yesterday as well. Get you more on the macros and the markets on the other side of this very short break. The markets continue to remain where they are at the start of the show. Welcome back. A couple of numbers have already been reported in what is a busy earnings day. The big result of the day, one of the big results for the day, Mahindra & Mahindra reports the numbers will be out in a short while from now. Let's get in Sudarshan to find out what the street is working with. Sudarshan.
In next 1 hour, we'll have numbers from Mahindra & Mahindra for Q1 FY27's two parts, revenue and margin. So on the revenue part, because of the strong volume growth that both auto and tractor segments have seen, there can be an increase of more than 20% in the revenue, while margin can see a dip of almost 200 basis points because of increased EV mix and also because of increased raw material costs that the entire auto sector has seen in Q1 FY27. So talking about the headline numbers, profit may increase by 4%, revenue, as I told you, by 23%, EBITDA can see a jump of 8%, and margin can come down to 12.6% versus 14.3% in the same quarter last year. Realization, main number, one of the important parameters, can be up 1% YY, but on sequential basis, it can slip 1.5%. Total volumes were up 21%, auto volumes had increased by 23%, and tractor by 17%. In the commentary, we'll be watching out for SUV and tractor outlook for FY27, and also if company talks about the new launches, especially on EV front.
All right. Thanks very much, Sudarshan, for bringing us that update. Before we close, let's get you a quick cue on what's happening on the macro front with our macro signals. For the markets, of course, it remains flat, 24,255 as we speak. Look at the oil prices. It's been so volatile today. I mean, there was a sharp jump yesterday, some cooling off today, and now again, we started the show with oil prices just below 91. Now they're about 92.5 a barrel. So, very volatile movements on the oil. Of course, that Trump's hit hard rhetoric is causing some price spike. Then, of course, we saw some downward movement, because of what happened. And now it's inching back up again. The rupee, meanwhile, that's hovering about 95.73 against the dollar. It's higher by about 0.09% as we speak. There's been some aggressive dollar selling by RBI, which has anchored market sentiment. But, we continue to see pressure. And that's, of course, on the back of that spike in oil prices. The 10-year benchmark GSEC yields also opened slightly higher today. Now they're trading at around 6.81 or so as we speak, compared to yesterday's close, which was 6.79. So there's a minor uptick, primarily because of, domestic bonds also tracking that rise in U.S. Treasury yields. The 10-year there, by the way, has climbed past 4.7 following the Federal Reserve's decision to hold interest rates steady. So all of that is impacting sentiments here in India as well. But on that note, we will wrap up this edition of Trading Hour. Hormaz, Mangalam and I take your leave, but stay with us. Halftime report will take all the action forward.
After a strong open, indices slip into the red. A number of declining stocks stop advances ahead of the F&O expiry on BSE. IT and energy gains, while industrials and financials drag.
Eicher Motors posts a stronger than expected Q1 with volumes driving an over 30% growth in revenues, even as cost bumps hit margins despite some cushion from price hikes. Analysts see the strong show mostly priced in.
And Syngene takes a beating following a loss in Q1 on losing a client, while Wari Energy slides as its realizations come under pressure, but Balkrishna Industries surges on volumes growing ahead of expectations.
And the stock of Indium lists at a heady premium of 44% to its IPO offer price of rupees 485. The public issue of shares of the global metal injection modeling leader saw subscription of 72 times.
Indigo MD Rahul Bhatia says India needs a global airline of scale. He also defends Indigo's dominant market share, saying it is because the airline flies on routes no one else does.
Hello and welcome to our Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a day which is mixed for the market. So we have the frontline indices which are consolidating at this point in time, but not so much for the mid caps at this point. So underperforming for the mid cap index with a weak advanced decline ratio, and the Bank Nifty which is down around 0.6%. The market continues to be peppered with a lot of earning reactions, and that seems to be top of mind. Hi, girls.
Hey girls, good afternoon. Earnings continue to be in focus, but we do have that stellar move coming in from the IT space. So the IT index, another day running the top gainer, 1.4% there. Markets have been quite volatile today, but now we have seen markets come off sharply from the highs, but it's a power-packed show today, Vinny.
Absolutely, a power-packed show that we're talking about today. And first up, we'll connect with the management of Asian Paints. Then we'll have Sterlite Tech Management as well as Sharda Cropchem also talking to us about the outlook of the company going forward after their Q1 FY27 numbers. Manisha Gupta will connect with Amina Bakar of Kepler to talk to her about the outlook of crude oil, West Asia conflict, what is happening on that front, and we'll connect exclusively with the conversation that we had with Rahul Bhatia, the MD of Interglobe Aviation. We'll take you all through some of those highlights from that conversation as well. But first up, Vivek is here to take us through the stocks that are moving around in the trading session. Afternoon, Vivek.
Well, good afternoon. Again, a session where we're seeing significant volatility, mainly stock-based moves on the back of earnings reaction. First on the list of stocks has to be Hero MotoCorp. Again, very strong volume-based activity seen, one of the top gainers as far as the entire auto space is concerned today. Redington, can't really look past this particular name in terms of a positive earnings reaction, almost 10% higher on a very strong Q1. Look at the entire IT pack. The rally continues for consecutive sessions. Wipro, Persistence, Coforge, all of these names under higher in the session today on good volumes as well. Balkrishna Industries, you alluded to it earlier, higher volumes, very good beat as far as Q1 is concerned, almost 8% higher on this particular name. And standalone refiners, both MRPL as well as Chennai Petro, today doing very well. Both of these stocks higher by over 2.5 to 4% today. On the other hand, quite a few laggards as well. Can't look past Wari Energies, again, very weak margins, especially on a sequential basis. That particular stock down over 4%. KPIT Tech, yesterday, immediately post the results. You saw a very sharp rally. But today, post the conference call, once again, the stock is down almost 8% lower than yesterday's close as well. Eris Life Sciences, a bit of a downgrade coming in as far as the guidance to the export business is concerned. That particular stock down on very high volumes today. Syngene, again, very weak quarter coming in. Degrowth is what the management is expecting for FY27. That stock low by 6%. And again, Dabur is the other name from the FMCG pack. Stock saw a bit of rally going into Q1, but today seeing a bit of a sell-off down over 2%.
Okay. All right, Vivek, we're going to leave it on that note. Thanks very much for joining in and giving us some of that perspective. Well, in terms of a couple of stocks which are managing to hold up, we have Thyrocare, which is in fact up around 2.8% in today's trading session. And that stock has done very well from the diagnostic space. It's up around 33% on a year-to-date basis. Alchem is also doing well today. So that stock is up around 2.5% and should come up for you. It's gained around 5.5% this year. So it's not all too bad in terms of the pharmaceutical stocks, some of them managing to hold up. But let's talk about the FMCG space. Asian Paints is the first management on the show. The company reported a good good set of numbers. Overall numbers beat estimates. The revenue growth came in at 16-quarter high. In fact, Mangalam did catch up with the management of Asian Paints and began by asking about the good performance. Listen in.
Overall, it's been a good quarter, and that is reflected with respect to one, across businesses. It's not one business which has done well. Second, what we see is that the volume growths are also fairly resilient in terms of what we have got. Because the price increase impact in terms of what we see has basically upped the value in terms of what you say. But I think the volume is largely driven from the point of view of demand, which we have been seeing. And the demand has been also very good from the rural geographies to that extent. Even the B2B market has done very well from a point of view of some of the urban markets in terms of what is see. The industrial markets have done very, very well overall in terms of the growths, in terms of what is see. So I think it is a growth which is all across, and I would say that yes, price increase has given us some buffer in terms of looking at the value growths in terms of what we have got. But overall, I think a fairly resilient quarter.
You know, if I go back a couple of quarters, you did say that demand was fairly sluggish, and maybe the demand for decorative painting, the frequency itself may have come down because people are now investing a lot more in experiential spends. But what has flipped according to you over the last 2 quarters?
So I don't think so that there is anything flipping from a point of view of the maintenance cycles in terms of what is really happening. What we see is that overall, I think what we saw in Q4 also, if you see there were no price increases and so on and so forth in terms of that quarter, we had seen definitely a good volume surge, kind of reflecting the possibly a good market sentiment, given the fact that paint is discretionary. I think today what we are seeing is that possibly there is still a more propensity which is coming from a maintenance cycles. We are also seeing that there is impending wedding season which kind of really also kind of supplements it. But more than that, I think the B2B market, which I have been maintaining throughout, has been doing stupendously well overall in terms of what we see, whether it is private capex, whether it is government spending, whether it is from the point of view of overall construction. I think that has also led the game quite brilliantly.
All right, that's interesting to know because you have been speaking about this and that's actually come about. Let's talk about the overall outlook that you have for the year. You've alluded to 8 to 10% volume growth, and 7.5% is the kind of price hike that you saw in the first quarter. Second quarter, maybe another high single digits as well. So does that mean as we end this year, you would be between 18 to 20% in terms of revenue growth with 18 to 20% in the margins that you had guided for earlier?
No, I don't think so. That I think is the right way to kind of look at it, because for the entire year, I think the overall volumes is something which would really matter in terms of how we are able to grow, because some of the value will get kind of really vitiated from a point of view of what price increases, and there could be price decreases which could kind of take in the second half depending on how the volatility of the raw materials and the inflationary environment is going to that extent. So I think what is really good to watch out is that if we look at the volume growth, I think that should be, I think, in the range of about 8 to 10%, as we have said. And therefore, the consequent margins, I think the guidance of 18 to 20% should hold.
And on a weighted average basis, about 5% value growth cannot be ruled out, right? Because first half will be high single digits, and second half, even if there are decreases, it could amount to mid-teen sort of revenue growth this time around.
So what we see is that, the conventional volume value gap, which we used to see in terms of saying that the volume being higher than the value, I think that is getting a little bit disrupted given the price increases in terms of what we are seeing. So as we go ahead, possibly, I think the gap between the volume and value would kind of reduce and the value would be higher than that 8 to 10%.
All right. What about margins? You've said it'll be between 18 to 20%, but given the sort of price hikes that you've taken, then you have the backward integration VAM plant coming in as well, which will give you about 300 to 400 basis points headroom. Do you think that you will maintain margins at the higher end of this 18 to 20% band? Or because of increased volume salience and increasing demand, you will pass on all the savings and keep your margins closer to the 18% mark?
So there are 2-3 things in terms of which we must watch out, because typically we have seen some variation in terms of margins across quarters as well. Q2, the product mix is typically definitely on a lower side, and therefore the margins get a little bit suppressed in terms of what we see. And therefore, I think the margins vary from quarter to quarter, depending in terms of possibly today how price increases and decreases would pan out in terms of what we would see. I think the work which is happening on backward integration and a lot of other cost resilience work on formulation, sourcing, and so on and so forth is continuing to give us a treasure chest to kind of really look at saying what we can do in the market with respect to our branding and marketing spends and so on and so forth. And not to kind of say that the competitive scenario still continues to be very, very high to that extent. So therefore, I would say that possibly I think it is still good to maintain that overall guidance of 18 to 20% for the full year.
All right. And you're not giving us a direction whether it'll stay closer to 18 or 20?
It's very difficult to say, honestly, because given the volatility which we see in the market, I think it is really very difficult to say because we have to really watch out for the second half in terms of how it pans out.
All right. You did allude to competitive intensity being high. I just wanted to understand, because of the price hikes that everyone else has taken, the price intensity when it comes to competition has now flattened out. There is no one player who's at a discount to the others. So what kind of competitive intensity are you seeing on the ground beyond price? And in the first quarter, did you grow ahead of the market? What's your updated market share, if you could give us a sense?
So overall, when you look at from a pricing angle, it is very clear that everyone kind of really adjusts their pricing as per the price increase, what has been taken across. So typically, the prices across competitors would appear the same to that extent. But largely, the difference comes in where people look at discounting. And today we feel that the discounting is still at a very, very high level in terms of what is taking, which creates a differential in terms of possibly the pricing to the consumer to that extent. So I think that intensity of competition is what I'm referring to, I think, which will continue to kind of look at. Our strategy has been more from a point of view of looking at, innovation, looking at the brand, looking at the marketing initiatives, new propositions to excite the market and the consumer. And therefore, we feel that, that trajectory continues. And we believe that in the first quarter, we should have grown higher than the market.
Okay, you believe that you would have grown higher than the market. Just a final question, smaller part of your business, still under a wee bit of pressure, that's the home decor, home improvement segment. What are the call-outs that you have here before we wrap up?
So I think, yes, that has been something which we have been kind of honestly struggling with for some time. But I think this year, the bright spark is that the kitchen and the weather seal business have done well. White teak and bath have not done that well to that extent. But I think today we are convinced that it is a very strong part of our strategy from a point of view of owning consumer homes. And that is why possibly I think that is something which we will keep on pursuing strongly.
Take that point. Always a pleasure speaking with you, Amit. Thank you for joining in. Good luck for the remainder of this year.
Thank you so much.
Okay, that's the conversation Mangalam had with the management of Asian Paints. Believe the company grew faster than the industry and gained market share in Q1. So that's interesting there. As of now, the stock has recovered from the day's low, but still down almost 1% in the trading session. On that note, we're going to sip into a very short break. We'll come back and discuss with the management of STL their Q1 FY27 numbers as well as the road ahead. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. Very volatile for the markets. At the headline level, we are absolutely flat with some positive bias. In the broader markets, though, while the mid-cap index is underperforming, we do have some stocks which are reacting to their earnings. Reddington, for instance, is up around 10% as we speak. Moil is the other one which is doing well in trade today. That one is up around 7%. We do have Sirma SGS Tech, the other stock which is doing well from the EMS space. That's up 6%. And Avalon Tech is the other one in the same space which is higher in trade. But we do have some corporate conversations which are lined up as well. Sterlite Technologies is the management on our radar now. Company reported a good set. Margin guidance has been raised to 23% as well. Ankit Agrawal, the MD of the company, is joining us now to make us understand the reason for this margin upgrade that has come by and the outlook going forward. Ankit, good afternoon. Thank you so much for joining us. Well, first up, the margins have improved from 15 to 20%. What led to that? And what makes you confident of that 23% margin guidance? What will the contributors be on that 23% margin mark that you are guiding for FY27?
Yeah, thank you for having me on the show. So I think the big focus for us has been in terms of continuing our growth, particularly with the data center segment. I think as we have shared and we've in fact increased our guidance, that overall our data center and enterprise sales for this year was originally planned for 30%, and we've increased that towards 50% for the year overall. So that's a big area. We've also secured good orders from the data center companies, including one large order of more than $1 billion, which is over the next 3 years. So this gives us a good confidence in terms of the high margin opportunities that we see. And clearly, when you look at our order book, open order book, it's almost 18,000 crores. So we see good visibility in terms of the product portfolio that we're building, particularly for data center, which is our Neuralis portfolio. That's something that's getting a lot of traction in the market. And as we continue to increase our sales, both on data center and telecom segment, largely in the US market and Europe market, we do see our margins improving towards that 23%.
Hi, Ankit. Good afternoon. You mentioned data center as the big reason for this, right? So is that 200-300 basis point expansion or the rise in guidance that you've given mainly because of data center itself, and most of it will come only through data center? And also on data center, you said that big order that came in, right? $1.1 billion contract. Are there other customers who are in the pipeline as well, similar such orders?
So we are already supplying to other data center companies, and that's something we're very proud of. We're in fact also working with many customers to co-develop some new products for them for their future requirements. In terms of our margins, to your question, I think it's going to be a combination of both a larger percentage of product mix going towards data center customers, which are higher margins. But at the same time, as we are able to solve for some of our raw material and sourcing, we will look at improving our factory utilization. And as that also improves, that will further add to our bottom line.
Okay, interesting. Ankit, so that's on the data center opportunity, that's on the margins. But you haven't managed to give revenue guidance this quarter. What are you estimating in terms of sales going forward? Is this kind of a run rate on a sequential basis, which you've reported in Q1, probably going to continue? Is that what the street can extrapolate?
So we are not giving revenue guidance. What we've broadly clearly shown is the order book north of 18,000 crores. We're inching towards from this 1,900 crores, 1,900 crores revenue run rate. We have also shown in terms of order book that's executable in the coming quarter is almost 2,200 crores. So while that's not a specific guidance for revenue, it just gives a direction of already the orders that we have in hand. Overall, I would say that the company is just focused on the execution side. We do see strong opportunities in terms of the orders, both from telecom as well as data center segment. And we've also talked about investing close to 500 crores this year. And over the next total 3 years, about 1,500 crores. So we are also looking at making investments to make sure that we can execute on our customer commitments.
So on this capex and the data center bit, Ankit, you mentioned 1,500 crore rupees over the next 3 years. Is this largely for debottlenecking, equipment upgrades, or will you actually, see addition in capacity as well? What is the current utilization? And just on the data center bit, since you did get a big order, how much higher are the margins in the data center business versus the other businesses?
Yeah, so in terms of the data center side, typically if we see EBITDA margins of 20% for the telecom sector, the EBITDA margins for the data center segment can be anywhere between 25 to 30%. One part of this is also the connectivity portfolio that we're looking to scale up, and we've shared some guidance that will also move towards 23 to 25%. For this year going forward. So both of these elements help us to improve our margins. In terms of the investment of the 1,500 crores, that's largely based on our debottlenecking. We've been in this business almost 30 years. So there are areas that we believe that we can improve our capacities and also debottleneck. We also do need to upgrade our equipment so that we can serve some of these amazing opportunities better as we move forward. So that's largely what we've focused on. As we continue to secure more orders in our conversations with these customers, we could look at further capacity or capex investments from here.
Okay. And Ankit, just in terms for overall the geography mix also I want to understand, right? North America, okay, obviously a significant increase in terms of the mix that has come in here. Europe, you said about an opportunity as well. So talk to us about client conversions here, furthermore, specifically for Europe. What are you looking at? And also client conversions apart from the AI data center opportunity. How is that moving?
Yeah, so I think at the core of all of this is, a lot of focus on our R&D. So we're probably going to be spending north of 100 crores of R&D this year and look to further increase that. We are hitting now close to 800 patents in our product portfolio. So a lot of focus on working with our customers in US, Europe, and now also in India a lot to really make sure that we're building future-proof networks for them. Clearly, the demand for fiber, both for serving the high capacity requirements, the racks, and moving from 400 gig to 800 gig is very real. If you just follow the data center announcements by Meta, by Google, even Microsoft in the last few days, they're actually looking to increase their capex, and the overall capex spent by the hyperscalers is about $800 billion this year, moving towards $1 trillion, right? So I think that's something that is very, very exciting for us. It's truly once in a life opportunity to be part of this. And as an Indian company, we're very, very proud that we are manufacturing high technology products and supplying them globally. So I think that's something that we're focused on. While we've talked about the US, equally in Europe, I think it's still in early stages. There are challenges with execution and power transmission and other parts. But we do believe that Europe also will pick up over the next 2 to 3 years. And India as well, I think will jump from about 1.5 gigawatts to at least 7-8 gigawatts in the coming 3 to 4 years. And again, their brand new fiber networks will get built, both outside data centers and a lot of fiber within the campus and inside data centers. So that's something we're looking at, plus projects like BharatNet, etc., which we are already part of. We're working very, very closely with the government, with BSNL and various stakeholders to make sure that we are supplying our fiber for these projects.
Okay, quickly, Ankit, net cash balance stands at around little less than 500 odd crores, 483 odd crores. What is the utilization plan, and would you need to probably take on some debt in order to fund your capex?
I think we're quite well placed now. Very proud of our team's effort in executing this fundraise. We've raised 1,500 crores, and we've just shown in our results we're almost close to 500 crores net cash. So I think we're well placed when we look at what our capacity investments are right now, the cash that will get generated from the business. I think we are quite well placed. In fact, I think we have a very strong balance sheet now.
At that point, Ankit, thank you so much for joining us today with your take on the outlook for the business going forward. So strong commentary, good numbers. That's the word coming in from Sterlite Tech. The stock, though, lower by 2%, but has recovered from the lows of the day. We'll slip into a short break now. Up next, we'll focus on the F&O setup at noon. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Nifty as of now 24,260 levels is what the Nifty is trading at, up just 14 points in the trading session as of now. A bit of a volatility that we've seen between the red and the green for the markets today, but a few stocks that have run up in the trade in the last 1 hour from the broader end of the market. Piramal Pharma pulled that up. It's up 2% specifically in the last 30 odd minutes is what we could say. So yes, we're seeing that up move coming in for Piramal Pharma. We're seeing Eris Life Sciences. That's also seen a bit of a pickup of 2% uptick in the last 30 odd minutes. And all of these are trading at the day's highest point. So will be interesting to see where these stocks are going to be headed in the trading session. But let's keep it going and talk about what's happening in the world of F&O this afternoon. Mangalam is here to take us through those details. Mangalam, afternoon.
Afternoon. You said, let's keep it going, and that's something that the bulls would keep saying to the markets as well. The reason why I say that is because, we're up around 13 points, but that amounts for a lot right now, largely because we have easily averted an accident, given the sort of volatility that we've seen in the crude prices overnight and the spike that we're seeing even right now. The IT index is the one which has been the bedrock of support for the Nifty for the last week or so, in absence of a big performance coming in from the Nifty Bank. So they're basically a bit of a tug-of-war between the IT index and the Nifty Bank, which has left the Nifty slightly flattish in today's trading session. But the macros from yesterday have worsened a bit. Yesterday when we closed trade, Brent was at around $87, and now as we speak, it's moved to $93 per barrel. So we need to keep an eye out on how that performs as we move forward, because that has a direct bearing on the rupee, which has also weakened towards 95.7 right now against the dollar. And it is with this setup that option writers believe that the market would be pretty much in this range that we're talking about. So 24,200 put, premium for almost 91 rupees, telling you that around 24,100 there would be support. But call writers are equally active at the 24,300 level, and that call comes up for you. You'll see a premium of almost 85 rupees, telling you as we move towards that 24,350 to 24,400 mark, there would be a lot of support, there would be a lot of supply coming in. So basically, range that you're looking on the Nifty is 24,100 to about 24,400, and 24,100 ties in perfectly with the 20-day moving average. The only two things that I'll be watching out for the Nifty Bank and the IT index from here is, one, Nifty Bank's inability to cross past the 200-day moving average after having broken it sometime last week. So whether it crosses and closes above that or not will tell you whether, there is some momentum in the Nifty Bank. And secondly, we have the Nifty IT index, which after having run up fairly well and is above the 50, 100 and 20-day moving average, just 1,000, 1,200 points from here on, we have the 200-day moving average. So will the Nifty IT index face supply out there or not is the big question, because these two are big components of the market near their technical resistances. In terms of stocks, auto stocks are doing well today, so a lot of long positions added on both Hero as well as Sona BLW. But we've seen a lot of shorts added in a lot of these renewable names on the back of poor numbers. So Wari and Premier Energies actually stand out from a shorting activity.
Okay, take that point. Mangalam, thank you so much for joining us. So that is the F&O setup at noon. And with that, it's time for a short break now. When we come back, we'll be joined by Manisha Gupta with Amina Bakru, who's the head of Middle East and OPEC Plus Insights at Kepler. Stay tuned.
Welcome back, and joining us on the show now is Amina Bakr. She is the head of Middle East and OPEC Plus Insights at Kepler. Amina, hi, thank you so much for joining in. There's just so much happening when it comes to the crude oil prices, but when it comes to India's energy security, and especially with the West Asian supply chain squeezed, and now the US Senate passing the Russia bill as well, what does it really mean for a major consumer like India?
Listen, I think India is an example really of how the government dealt with this crisis in the best way possible. They, I mean, from the start, I mean, India had a very strong stance just generally against, I mean, when the US from the very beginning chose to sanction Russian barrels, India continued to buy from Russia, not really paying attention to that because they prioritize their population. They prioritize their energy security, rightfully so. So I think India will continue that strategy of looking for supplies from diverse customers across the globe. We also understand that India has secured quite a number of cargoes from the UAE that are able to pass from the Strait of Hormuz. So I think, I mean, of course, everybody's energy security is at risk at the moment, including big importers such as India. But the government has been very flexible and very, let's say, pragmatic in dealing with this crisis.
I mean, I also want to talk about the crude oil prices. Would you say that the current prices accurately reflect the ongoing physical disruptions, or is it the market underestimating the geopolitical risk premium due to macro recession fears?
I've been quite surprised with the movement of oil prices, to be frank with you, Manisha, and I've been surprised as well as, I mean, how immune oil prices have become to geopolitical risk and supply disruptions. At one point last week, we had, I mean, the disruption ongoing in Hormuz, the risk in Bab el-Mandeb. We had Ukrainian attacks on Russian infrastructure, and then the oil prices not really reacting. So something is, you know, there is something to question here, investigate. Maybe things are going to become clearer, in hindsight. But obviously, I mean, I think it's just a matter of time where, as well, that all of these fundamentals, once they are cleared up and we have a better picture of where we are on the demand side, that perhaps this is going to catch up with reality and reflect better in prices.
I mean, also, do you see prices holding around these current $90 level marks? And how much dent can it really have on India's fiscal math and fuel domestic retail inflation?
Listen, Manisha, I think it all depends kind of on the political situation and what I'm seeing right now, despite, I mean, this pause that we are seeing in some of the attacks. And we understand that, yes, backdoor diplomacy is working, but the positions of the US and Iran are still kind of very far apart. So there is a political rift there. So it means that this conflict is continuing and there isn't a political solution per se. So having that, I mean, we're just going to be experiencing this kind of on-off conflict, periods of a pause. Maybe some cargoes are going to be, you know, let out of the strait or out of Bab el-Mandeb and so on. But it's not consistent. And I think we're going to continue to see volatility. And for now, I mean, it's very difficult to predict how prices will react in this very unique situation. But I would say, yeah, roughly staying around $90 seems, you know, a reasonable guess for now.
A final question then, Amina. And what is your sense or numbers that you can share with us in sense of traffic via Hormuz or Bab el-Mandeb, Red Sea, etc.?
Well, Hormuz is still, I mean, we're back in single digits. Maybe the UAE is the only country that's able to export, let's say, meaningful volumes at this point in time, maybe around 8 million barrels. And that's, you know, something that's been kind of reported in the press. It's difficult to kind of put a finger on it right now because a lot of them also are dark cargoes. There is a delay delay in the information. But with Bab el-Mandeb, I mean, we did see a decline in the vessels going through Bab el-Mandeb given the risks, and Houthis explicitly saying that they're going to be targeting any vessel carrying Saudi cargo or any Saudi vessel. So there has been reluctance of vessels entering through Bab el-Mandeb. So we have been seeing rerouting happening through the Suez Canal, and as you mentioned, going through the Cape of Good Hope, and that's around a 25 to 30-day delay if they're going to Asia. And you're absolutely right with countries in the region being at a place right now where they are no longer 100% confident that we are going to have pre-war, these pre-war routes being 100% restored. So therefore, they are accelerating plans of additional pipelines, ports, ways to bypass all of these, traditional channels. So I think overall trade from the region is going to look very different a couple of years from now.
Okay, Amina, thank you so much for joining us with your take on the latest developments. Manisha, thank you for taking us through this conversation. With that, we'll do one thing. We'll slip into a short break. Up next, we'll connect with the management of Sharda Cropchem to discuss their Q1 numbers and the road ahead. Stay tuned.
Welcome back. Well, like we've been pointing out, it is a day for a lot of stocks and a lot of earnings. One particular stock which also stands out is Piramal Pharma, which is up around 2.3%. And this spike up has actually taken place after the conference call that took place earlier this morning at around 9:30 a.m. So when the stock opened, it was absolutely flat. But the company has said in the conference call that the requests for proposals have been quite robust this time. And they are quite confident in terms of the margins that going forward for their business segments, especially the CDMO space. So that's the reason why you're seeing that sort of up move come in. But nonetheless, let's talk about Sharda Cropchem, which is the next management on the show. They reported what was a mixed set. The revenue was in line with estimates. EBITDA and net profit missed due to lower forex gains. To discuss this and the road ahead, we have Mr. R.V. Bubna, who's the chairman and the MD of Sharda Cropchem, joining in. Mr. Bubna, thank you very much for taking the time out. Well, it's around a 450 basis points reduction that we've seen in terms of the margins this time, which have come in at around 17%. Just tell us what were the pressures that you saw operationally this time?
There is no particular reason. I think it's a global situation.
If you could elaborate a little more on that, as you know, in terms of what you could see when it comes to guidance on margins going forward, the current situation that you're also dealing with.
As far as Sharda Cropchem is concerned, the business has been very normal. It has not been impacted by any of these global phenomena in Middle East and other places. The demand is steady and the prices are also improving.
Okay. Mr. Bubna, your agrochemical volumes degrew by 0.6% in Q1. You did indicate in your presentation as well that Europe, which is largest and historically the highest margin market, did witness temporary demand moderation after FY26. What exactly happened in Europe, if you can give us a sense of that? Is it an ongoing issue because we have been talking about heat waves as well, and this is an important market for you?
It is a very important market for us, and you have rightly answered your question. It's mainly because of the heat wave. The weather has been very strange and very warm. But now that is also getting normalized step by step.
So it is getting normalized. So you have reiterated your guidance of 10 to 15% in terms of revenues. So you think Europe will come back to normal and the levels that we saw in FY26 could continue in FY27 as well for Europe?
Yes, madam.
Okay, all right.
Okay. Mr. Bubna, good afternoon. So in terms for your agrochemical volumes, right, that's seeing a slight bit of a decline there, and this is despite a 9% revenue growth. Could you help us understand what is the pricing there in the current scenario, product mix, and outlook in terms of volumes for this segment?
We could put this thing on the product mix.
Okay.
Product mix, yeah.
So mainly you're saying this is because of the product mix which has changed. So do we expect that to continue going forward as well then? What is your product mix right now? Like, will we see this impact in Q2, Q3 also?
It's going to change for the better. It's going to improve.
Okay. Sure. So when you say for the better, what are you saying in terms of volume growth? 0.6% decline right now. Do you expect a volume growth in FY27 overall?
It will also grow to the tune of about 10% plus.
That's in terms of volumes, Mr. Bubna. That's what you're guiding for?
Yes, please.
Okay, so you're expecting volume growth of around 10% going forward. What can you guide more specifically on geographies such as Latin America, which has done very well for you this quarter? It was up around 52%. Are you expecting that kind of momentum to continue? Which would be the lead geography for you for the remaining part of the fiscal?
The remaining part of the fiscal, we feel that Europe is going to improve and Europe is going to help us.
So by how much? What are you targeting? Can you give us a specific number for how much Europe would grow? Can you give us a specific number in terms of what you're expecting from other geographies such as Latin America?
Madam, we have had a very good performance in Europe in the last financial year, and the base is quite good. We are going to grow over and above that base that was achieved in the financial year ending March 26.
Okay. Take that point, Mr. Bubna. Always a pleasure speaking with you. Thank you so much for joining us today and outlining the outlook on the business going forward. So Europe did see a decline because of heat waves, but they expect it to return back to normalcy, and they are maintaining their 10 to 15% revenue growth guidance as well. That's Sharda Cropchem. By the way, Excite just reported numbers. Net profit is up 28% on a YOY basis. Even their revenue growth has been decent at around 18%. The stock is up 2% in a market where the mid-caps are not doing so well. So keep an eye out on that one. For now, we'll slip into a short break. And when we come back, we'll get you an exclusive conversation with Rahul Bhatia, who's the MD of Interglobe Aviation. Indigo completes 20 years. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Just a few minutes ago, we did see a bit of a spike up coming in for the market as well. 24,300, about that mark is what the Nifty went up to, and then again came down from those levels. And we'll watch out for what's going to be happening in the second half of the trading session. Nifty Bank now trading with cuts of 0.2% as well, and IT is something that is holding on to gains this full week as well. But on that note, we're going to wrap up this edition of Halftime Report. But before we wrap up here, we're bringing you a conversation that Shireen had with Rahul Bhatia, MD of Interglobe Aviation, speaking exclusively to CNBC TV 18, talking and outlining about Indigo's domestic as well as international expansion strategy, explaining why India's aviation cost structure must become more competitive, and shares his vision of making India global aviation hub.
The industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines. Has gone up, and this is the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete. And in that mix also is ATF.
After a strong open, indices slip into the red. The number of declining stocks top advances ahead of F&O expiry on BSE. IT and energy gain while industrials and financials drag. Eicher Motors posted stronger than expected Q1 with volumes driving in over 30% growth in revenues even as cost bumps hit margins despite some cushion from price hikes. Analysts see the strong show mostly priced in. Syngene takes a beating following a loss in Q1 on losing a client while Waaree Energy slides as its realizations come under pressure. But Balkrishna Industries surges on volumes growing ahead of expectations. The stock of Indo MIM lists at a healthy premium of 44% to its IPO offer price of 485 rupees. The public issue of shares of the global metal injection molding leader was subscribed 72 times. Indigo MD Rahul Bhatia says India needs a global airline of scale. He also defends Indigo's dominant market share, saying it is because the airline flies on routes no one else does. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Harmaz Patakia. Good afternoon, Harmaz. You know, a mixed day for the markets, but we've got M&M's numbers flashing on our screens. Revenues at 41,959 crore rupees, beating in line with the poll, beating the poll by a small margin. We've got the other numbers there. EBITDA at 5,150 crore rupees, slightly below the estimates of 5,281 crore rupees. Margins doing better than our poll. Slightly in line with our poll.
Largely in line with what you can say. The revenue numbers are slightly higher as well. Net profit growth of 6.8%. The revenue growth, of course, that is going to be the one, because the 41,959 crore, that turns out to be higher than what the poll was anticipating. Last year's figures were 34,000 crore as well. So a strong number on the top line front. The EBITDA number is, well, largely in line, if you can call it that, and the margin figure too, just 30 bips lower than what the street was anticipating. On the year-on-year basis, the margin figure is down about 200 basis points, so around 12.3%. Last year was 14.3%, so yeah, it was 200 basis points lower. But the stock is doing well for itself. The internals, the management commentary, just get Sudarshan in a bit for the numbers, but the stock reacting to it positively. Volume growth during the quarter stood at 21%. The automotive volumes also were up 23% from last year, so both of them contributing to growth in the of course the top line, the overall top line. And the farm, if you can say, the farm equipment business, the revenues have grown from 9,100 crore to almost 11,000 crores this time around. The automotive revenue has grown from almost 25,000 crores to well over 31,000 crores. The segment EBIT as well, the automotive segment EBIT remains largely flat, but the farm equipment EBIT has seen improvement from around 1,800 crores to well over 2,000 crore rupees. The stock now at the highest point of the day, 3% higher now on Mahindra & Mahindra. So a strong show, at least by what the street is SML Mahindra, which is also their unit. So it was a related party transaction, and since then SML Mahindra has been on a tear. SML Mahindra is up around 20% today, was up 20% yesterday as well. That is reacting to it very sharply. For now, prima facie, Mahindra & Mahindra's numbers, well, largely in line with expectations, 12.2% on the margin front, so 40 bips lower than what the expectations were. But we'll take that on face value for now, 3% higher on Mahindra & Mahindra. We'll get you more details, of course, during the course of the day. But for the markets, though, well, there was a brief period when the index had surged past the 24,300 mark, and that was led by a recovery in the Nifty Bank. But that appears, as of now, that it's getting sold into the Sensex monthly expiry as well today. Need to take that into account as well.
Absolutely. And if you look at the sectors that are doing well, right, we've got those IT names that are leading from the front. It's another day of gains for that sector, right? Infosys up over 1%, Tech Mahindra and Coforge up over 2%. The other sector that's doing really well on the back of earnings today is that auto pack, right? Those auto names doing well in trade today. That index is up about, 0.5%. It'll come up on your screen. The auto stocks there, Hero Motor Corp, TVS Motor, Eicher Motors, all of them 2% higher in trade. But on the downside, we've got those realty names 1.5% lower, and they've been the laggards through the week, right? And we've got DLF and Godrej down 1%, and private banks also not doing very well in trade today. ICICI Bank and all of those stocks in the red today. So
set of earnings, we'll have to look at the internals once the presentation is out, considering all the details about the market share and about the outlook. But by the first look, all the headline numbers exactly, if you talk about the profit, has come in around 3,700 crore, higher than our expectation around 3,570 crore. Similar with revenue, 41,920 crore. Here also our expectation was around 41,760 crore. Talk about the EBITDA and margin, like all the other auto companies, we were expecting a dip in the margin, and that's what company has reported. Margin has dipped to 12.2%. Our expectation was around 12.3 to 4%, and that's largely in line with our expectations. Talk about the volumes. You know that both the auto volumes as well as the tractor volumes had seen a sharp increase, and tractor volumes had increased both on a sequential basis as well as YOY, and that have aided to the overall revenue, because normally on the tractor front, it's a high margin product, and that normally aids margin overall. Talking about the auto segment, because of the higher or increased EV mix, we were expecting that it will weigh on the margin front, and it has done that. But on the growth part, both on the tractor as well as on the auto part, company has seen a healthy revenue growth. We'll look for the internals, but as of now, largely looking in line set of earnings.
All right, largely looking in line there. All right, Sudarshan, many thanks for those details on the stock, now 2.3% higher. We've got Dharmesh Kant, Head Research at Chola Securities, joining us. Now, Dharmesh, you know, if you look at the numbers, they're largely in line. What do you make of it?
I mean, the numbers are actually good. They are largely in line, but the numbers appears to be better because the margin dip has not been that much as the expectation was. I was expecting 11.9 to 11.75% kind of a margin, but it has done better than those kind of a number. And the latest update about like July numbers were excellent for M&M. If you look at the SUV bookings, there have been 3 to 6 months kind of a delay has been there. So that's the order backlog they are witnessing. And monsoons, which was a big fear for M&M. Now the deficit is only 15% on the pan-India basis. So as it is progressing well, so we expect that this run rate of 20% kind of growth on a blended basis, be it automobiles or the EV vehicles, along with the tractor segment, the farm equipment segment, likely to do well. Most of the OEMs have taken a price hike, so the benefit of that will start trickling in from Q2 onwards, where the input prices will largely get negated and the break-even will be realized. So our sense is that into second half of this year, financial year FY 27, you will see a better margins than what they have reported Q1, and Q1 should be the bottom of the margins.
Dharmesh, what are you wanting to hear from the management of Mahindra & Mahindra? Because if you go into the internals, the automotive EBIT is largely flat, but the farm equipment EBIT has seen a significant improvement from last year. What is it that you would await more clarity on? Because yesterday itself, they announced that they are going to be divesting their trucks and bus portfolio to SML Mahindra. So do you expect that this would also lead to more clarity on them focusing on their core business and further divesting the non-core areas?
Definitely, yes. I mean, their divestment of the CV is very much in line because if you look at M&M per se in CV space, they have not been able to make that kind of a traction or the market share gain as say Ashok Leyland has gained. So still Tata Motors and Ashok Leyland continues to be the dominant player out there. So I mean, primarily it is more of their PV segment which has been doing well along with the farm equipment segment, and for M&M to focus primarily on that does augur well. What I would be particularly looking forward to is the margin guidance, how they are guiding for Q2 and Q3 and what they are seeing with the margin volatility in place and what kind of a price hikes can we expect in future. So will it be enough to take care of the margin depletion, I mean, because of the input price hike? Secondly is how they are seeing the farm equipment segment, because that is very critical reading into how the monsoon effect has been there. So I think these two clarity and the steps have already been taken. They have divested their CV side, which has been a drag on M&M for quite a while. So a better focus will be there. As far as the rollout of electric vehicles is concerned, I think they would be talking more about them, the aggression and the way, I mean, they're gaining market share, though it appears to be a bit of a cannibalization, but that's the case with the entire industry. EV and ICE will be competing against each other as long as overall the market share gain is there. So more on that, and our sense is the SUV segment, particularly on the EV side, is doing fairly well. So they are better ahead of you if you look at Tata Motors on the SUV side as far as EV is concerned. So more light on that is what would be desirable.
All right, Dharmesh, thank you so much for taking time out and being here with us on Business Lunch. You know, M&M coming out with their numbers there, largely in line. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned.
Welcome back. Even as the markets are quiet, the primary market activity is no short of action. Look at Indomim. That was one of the 3 listings that took place today. The stock listed at a 44% premium and has now extended its gains to 54% in comparison to its IPO price. Earlier, we spoke to Krishna Chivukula, who is the whole-time director and CEO of the company, where he spoke about the company's plans, the growth plans, of course, and the road ahead. Take a look.
We'll be in line with what we posted in the DRHP. I think in terms of where the growth is going to come from, I think I'd rather focus on what our strategies are, because that's really what's gotten us where we are today, and I think that's going to be what propels us and continues to drive growth in the company going forward. And I think for us as a group, it continues to be aerospace, whether it's machining, metal injection molding, defense. Land-based gas turbines, medical components, all of these areas have strong tailwinds in the market. When you talk about land-based gas turbines and jet engines, I mean, you're talking about a segment that, collectively is easily somewhere in the $50 to $60 billion range. With a 5-year, yes. I mean, we believe 10 to 15% growth is what we're going to be doing. We try to be a little bit conservative. The exact operating margins are going to be depending on, what type of business we bring in. That's something that's a little bit difficult to forecast. But we think that, what we're doing right now should be in line with what we're doing over the 5-year.
One of India's largest renewable independent power producer, Juniper Green Energy, gets ready for its stock market debut. The company aims to raise 1,800 crore rupees via its IPO, which is open for subscription today. Let's go across to Vivek Iyer to know more about the issue and the company. Vivek?
Well, that's right. So Juniper Green Energy opens for subscription today. They're looking to raise close to 1,800 crore rupees entirely via a fresh issue of shares and no OFS component or no offer for sale component. Our price band is at 214 to 225 rupees a share, and this implies that the post-listing market cap at the upper end of the price range will work out to a little over 12,800 crores. Now, when you're talking about the company itself, it's one of the top 10 largest renewable IPPs in India, and the total capacity that the company has is now a little over 7.9 gigawatt. When you're talking about the objects of the issue, well, the main object, of course, is to go ahead and repay debt. Number one is debt repayment of 680 crore in the main company, and also a little over 700 crore of money will be used to go ahead and repay debt in some of the subsidiaries of the company. Remember, our colleague Rima did do an in-depth conversation with the management a couple of days ago, and this is what the management had to say. They said that 84% of the portfolio is wind, solar, hybrid, as well as FDRE, which stands for Firm Dispatch Renewable Energy. They expect capacity to go ahead and reach, operational capacity to reach 6 gigawatt by FY28 end and a little over 10 gigawatt by FY30 end. They're talking about tariffs. Tariffs in the night time are quite high, especially as far as renewable players are concerned. And net debt, one of the key reasons why the company is going to go ahead and raise, funds from the IPO will reduce, but the current net debt is at a little over 9,400 crore. In terms of the financials, well, profitability or profit margins have been under a bit of pressure, but when you're talking about the revenues have been scaling up quite impressively. Revenues, have jumped up to 720 crore in FY26 from just around 390 crore in FY24. EBITDA margins continue to hover above the 85% mark. Now, in terms of one of the key risks, off-taker concentration, there are 2 major clients that the company has with both Gujarat-based discoms. So GUVNL and MSEDCL are the companies that that Juniper supplies to. In terms of valuations, FY26 price to earnings, trades at almost 271 times, almost similar to NTPC Green, which too trades at a high valuation of over 148 times. This is on FY26 valuations. Of course, growth projections, debt reduction, finance costs will all aid the earnings going forward.
Vivek, thank you for summarizing that for us. Another IPO opening for subscription today. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. On to the latest updates on the West Asia conflict. The U.S. military has said that it completed a heavy wave of strikes against Iran in retaliation for Tehran targeting American bases in Jordan. The new strikes were launched hours after Donald Trump vowed to hit Iran very hard. CNBC's Dan Murphy gets us the latest updates from West Asia.
The U.S. has launched a major wave of strikes against Iranian targets after Tehran fired ballistic missiles at U.S. forces in Jordan earlier this week. U.S. Central Command saying this morning American forces in the last couple of hours have hit dozens of sites, including military command centers, missiles and drone facilities, and coastal defense positions, as well as maritime assets. President Trump called the operation a, quote, powerful response, and vowing the U.S. would hit Iran very hard after that Jordan attack.
It's going to be straightening out. It's going to be straightening out. In the meantime, we're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but, they tried shooting it last night. So we had 5 rockets shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement at some point, but we're going to hit them very hard.
President Trump there. The escalation also comes after diplomatic efforts to ease tensions and secure shipping through the Strait of Hormuz collapsed this week after Iran rejected an Omani proposal to share control of the strait. Saudi Arabia's defense minister, Prince Khalid bin Salman, has held an urgent meeting with President Donald Trump at the White House, according to Axios. The meeting comes just days after joint U.S. and Saudi strikes targeted pro-Iranian militia in Iraq, following a wave of drone attacks against Saudi infrastructure. Sources telling Axios Prince Khalid delivered a message from the Crown Prince, Mohammed bin Salman, his brother, stressing that Riyadh supports de-escalation with Iran despite taking military action to defend its security interests. The Saudi side also warning that attacks by Iran-backed militias had crossed a red line, while also arguing that diplomacy remains the most effective path for regional stability. Saudi Arabia is reportedly working to build an international coalition to protect shipping in the Red Sea from Houthi attacks, according to Reuters. Sources say Riyadh is currently holding discussions with dozens of countries, though the final composition of the coalition has yet to be decided. The Iran-backed Houthis announced a Saudi naval blockade in the Red Sea earlier this month and have targeted Saudi vessels. Riyadh has responded with airstrikes against Houthi military facilities at Yemen's Hodeidah port. The developments underscore growing security concerns along some of the world's most critical shipping routes.
Shifting focus now to the U.S. economy, the Federal Reserve left rates unchanged for the 5th straight meeting between 3.5% to 3.75%, with a 9-3 vote that revealed growing dissent among policymakers. Steve Leisman of CNBC is here with the highlights.
Neither the long end of the bond market nor the stock market reacted favorably to the Fed's decision today or the comments made by Fed Chairman Kevin Warsh, some suggesting the market reaction was a thumbs down on his commitment to fighting inflation. The long end taking a hard hit with the 30-year yield surging 10 basis points and the price dropping at 5.22. It hit the highest yield since 2007. The spread between the 2 and the 10-year bonds, as investor Jeff Gunlock pointed out, steepened, which undid the flattening from the last press conference. Markets now expect a hike in September, but there's a 69% probability on a hike, a 31% probability on a hold. We're subtly hinting that a Fed hike could be coming.
It's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make.
And the 9-3 vote included dissents from Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas. Sometimes those dissents tell you where the Fed is going eventually. But the question is why the rate hike didn't happen at this meeting, with the chair constantly promising price stability and getting back to the 2% target. Mark Spindell from Potomac River Fund telling me the reaction of the long end of inflation expectations of gold all during the press conference reveals a market questioning the chairman's resolve. He said 2 opportunities to raise rates and hasn't, even as the market builds in expectations for rate hikes. So a hike may be coming from the Federal Reserve, but the problem is Warsh's failure to answer basic questions about what he's thinking and why, and makes it difficult to predict, and at some point raises the question about whether he will act and why. Steve Leisman, CNBC Business News.
And with that, it is a wrap on this edition of Business Lunch from Hermaz and me. Goodbye and many thanks for watching. Midcap Radar will take all the market action forward.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. 22 points higher on the Nifty, but it's been quite volatile since the word go. We did see a sharp fall, then a recovery. Continue to be above the 24,200 mark for now. Midcaps are underperforming the benchmarks, but IT, it's a one-way up and away.
Especially large cap IT doing very, very well. A bit of a downtick as far as mid cap IT is concerned today. After a while, that's been the outperformers. But like you mentioned, it's been an extremely volatile trading session. Mid caps, small caps underperforming quite significantly. But we have a lot lined up on the show. A very important manager as well that we will be conversing with to get their outlook as far as FY27 is concerned. So let's start off with the top headlines. Markets continue to trade mixed. The Nifty holds about 24,250 levels, led by gains in IT, auto and realty, while financials wane on the index. The broader market underperforms, with mid-caps lagging.
Margin pressure weighs on Vari Energies. Revenue jumps nearly 80%, but EBITDA margin misses estimates, contracting to 18% from 22.5% a year ago. Sequential profit more than half. Stock off the day's low, but still in the red.
Redington rallies on record Q1 profit. A 50 basis point expansion in margins coupled with improving capital efficiency aids growth in the June quarter.
Tire maker Balakrishna outpaces peers in the June quarter. Volume growth of 16% tops estimates of 10 to 12% and lifts revenues. Margin, albeit in line with estimates, contracts to 20% versus nearly 24% same time last year. Stock upbeat at lunch hour.
Biologic setback hit Syngene. First quarter results swing to a loss after client losses dent growth. Company guides for single-digit revenue decline and mid-20% margins in FY27.
Okay, all right. Those are the top headlines that we have, and markets continue to be on our radar, but a lot of action in the broader markets. We do have two listings as well today, and the stocks did really well, and the debut has been quite strong as well. But before we talk about some individual names, let's talk about MTAR Technologies. That is the stock which is buzzing in trade after reporting what was a strong set of quarter one numbers. Revenues, EBITDA, margins and net profit beat estimates driven by strong execution across business verticals. To discuss this and the road ahead, let's welcome Srinivas Reddy, who is the Managing Director of the company, joining us now. Mr. Reddy, good afternoon. Thank you so much for joining us. Well, the street is enthused by your numbers. The stock is locked in upper circuit, and the numbers have been quite strong as well. You've already surpassed your FY27 order book guidance. Give us a sense of what are the kind of orders that you received in quarter one. Now, what is the target for FY27, since you've already surpassed what you had anticipated earlier? And yes, some outlook on that particular bit.
Yeah, well, the order book, we've already surpassed the number, but we'll see how it goes. We're going to get a lot more orders in all the sectors over the next 3 quarters. I just want to talk about it right now, but it'll be on the upside in any case. But let's see how it goes. But we are expecting the order pipeline is also very strong in all the segments that we're working with. So let's see how it goes, and we'll take it from there.
What is the breakup of this order book? If you can give us a sense of it right now, where did you receive the most amount of orders from in quarter one?
We have received from various sectors, mainly from clean energy, then from aerospace sector and the defense sector as well. And we're expecting more orders coming from nuclear division as well during the current quarter. And we will also receive orders. We have received few orders from the other customers in aerospace as well. So it's a combination of everything.
Okay, Mr. Reddy, a couple of days ago, one of your major clients, Bloom Energy, actually went ahead and upgraded their guidance as far as the rest of the year is concerned. We do understand that there could be incremental order flow coming in from there. What is the opportunity that you're seeing over there? And the second part of the question is, there have been significant concerns, especially as far as, some of the data centers that they are building out. So has there been any slowdown as far as building out of some of the projects that Bloom Energy is currently working on?
No, I just want to clearly clarify this unwanted noise coming from everywhere. It's not required at all. We are definitely on track and even doing better than what we're going to do better than what we have guided for. We didn't want to change our guidance details as of today, but we are pretty confident with our guidance, what we have given, and probably will do even better than that. And as far as the noise on the data centers is really unwanted and unnecessary, and which you can see as a clear reflection in what we are doing now and how we have performed and how we are going to perform better and better quarter-on-quarter basis.
So there is no concern regarding Bloom Energy and the data center business that they have. Just understanding again, since you're saying you'll continue to grow or even surpass what you had guided for earlier, how much is clean energy contributing to overall order book or revenues for now? What kind of growth are you anticipating there? If you can give us a breakup of the revenue guidance you've already given. So just trying to understand how much will clean energy contribute to that?
See, clean energy is growing at a very fast pace. So it's really growing faster, but all the other verticals are also doing well for us. And probably it will be around close to about 70% of revenues coming in from there, because it's growing at a rapid pace. But that doesn't mean that the absolute numbers of the other segments are also doing pretty well right now for the kind of work we have done over the past.
Margins also higher in this particular segment, Mr. Reddy?
Yes, definitely. And with the higher revenues and the operating leverage kicking in, more and more moving forward, I think the margins will also improve quarter-on-quarter basis as well.
Okay, Mr. Reddy, in a hygiene check at this point of time, you've not exactly gone ahead and upgraded your guidance. FY27, 80% revenue growth, plus minus 100 basis points. 24% is the EBITDA margin that you have guided for. What is the kind of upside that you could probably see? You've not given a formal guidance as yet.
Yeah, I thought it is too premature to give any guidance. As I said, we'll relook at it end of Q2. As I said, our second half is going to be much stronger than the first half with the kind of expansion plans and ramp up what we are doing right now. So I thought it's more appropriate to relook at the guidance by end of Q2. But definitely, we would do better than what guidance we have given earlier, for sure.
Okay, Mr. Reddy, the other concern that the street has is, is it imperative that the phase 3 capacity expansion, which is a bit of a worry in terms of being a bottleneck for executing the 3,100 crore order book, or do you have any other supply chain, or do you have customer dependencies? Are all projects on track?
See, every project is on track. There is nothing to worry about anything. See, we have a phase 2 operations coming in. We have completed our phase 1 expansion successfully, and it's fully under production right now. The phase 2 is going to get into place in September, October, and phase 3 by March end. So I don't see there is any kind of worry on that aspect of it. And we are going as per our plan and focusing more on the execution. And every plan is being followed up, and the capacity expansion will be in place based on the timelines what we have set for the team.
Take that point. When a company does have a lot of orders, and here you have surpassed your FY27 order guidance already, the stress, or at least there is some impact on balance sheet as well. But your working capital days, they are down to 59 versus 172. As we go along in the fiscal, what is the timeline, or what is the outlook on working capital days? How will the balance sheet look?
See, the working capital days, we have been negotiating better terms with our customers because we are in a position to do that right now. We realize that fact very clearly. That's why you have seen a reduced working capital days in this quarter. But if you look at the entire year, we should definitely be below 100 days, which is a very good number if you can ask me for this kind of a segment. And we are focusing on that, and we'll be right up there.
Okay.
When you say you are in a better position to discuss those terms with your customers, is it also coming at better price negotiation as well, just not on working capital days or receivables or payables? If you can give us a sense of that as well.
See, we don't negotiate the price. We quote a price which is reasonable to the customers and also maintaining our margins. And we do that across all the segments. It's not, we don't underquote anything or do at a price which is not, doesn't have reasonable margins for the company. And we also have a reasonable amount of operating leverage going forward as well. So we have kept everything in mind in terms of fixing the prices, which also helps the customers as well to build the volume. So that's the long-term game, and also not sacrificing our margins in the process. We always maintain that stance.
Okay. Mr. Reddy, the other thing which we want to ask you is, apart from the LCA MK1A actuator opportunity that you have, which are the other defense programs that you believe can contribute meaningfully to your order book going forward? And also going forward, up till FY28, FY29, what will be the proportion of contribution to the top line from both the aerospace as well as the defense space?
See, look, coming to the aerospace segment, as you see, we have done a lot of work in the last couple of years in terms of developing the first articles, building the infrastructure, getting certified. So you're seeing the numbers right now, not only in aerospace, but also in the products division as well. So these numbers are going to go higher and higher. You are seeing the numbers coming in right now. And it's a continuous process in MTAR to innovate and to develop new products. And defense, we are only involved in very niche areas where we think that our contribution is required in the defense area for Government of India. We have done this for the last 40 years. We continue to do that. The number of projects we are working on, not necessarily one, but we are looking at projects which are meaningful for MTAR moving forward because we are involved in multiple segments, so we don't want to get into the run-of-the-mill projects at this time.
So in case you're not getting into the run-of-the-mill projects, ideally the question will be going forward, with the current EBITDA margin guidance band of 24% plus minus 100 basis points. Going forward, you are looking at fuel cells, you're supplying to data centers, aerospace, defense, and you've also spoken about nuclear reactors. Going forward, what will be the ideal top-line mix for you, and where can you scale up margins to?
See, we can scale up margins in every segment we have, like aerospace, oil and gas is also the one which is going to come up in a big way in the second half. We're going to start our production. So in every segment, once we gear up on the volumes after developing the first articles, some margin improvements will definitely be there in every of these segments, including the fuel cells as well, because of the kind of volumes that we're going to work upon. And the asset turn ratios are also very, looking at 6 to 7 times in terms of fuel cell as well. So they're all the positive points. We have been working on this for the last 2-3 years, and you'll see a progressive improvement quarter-on-quarter basis in all these areas.
Okay, all right. A lot more questions, Mr. Reddy, but thank you so much for your time and patiently answering all those questions. The street likes your numbers, and most importantly, the management says that they might exceed their guidance, but they will take a look at it again at the end of Q2. That's the word from MTAR Tech. But let's go across to a quick programming note now. Convenience is no longer just about getting things delivered faster. It has become a powerful economic force reshaping consumer behavior, business models, and the way modern India lives. CNBC TV 18 brings you a special documentary series, Built for Bharat, Time Back, examining the rise of India's convenience economy, the technology, innovation, logistics behind it, and the invisible systems transforming everyday life. Watch this special series on 31st July at 5:30 p.m. Welcome back. Well, M&M has surged to the day's high. The company just reported numbers a while back. In fact, we do have the management of the company addressing the press. So let's cut across to that communication.
Something we've been talking about for a while, and you've seen the momentum in Growth Gems. We now see a 3x profit growth for Growth Gems, and that really brings multiple businesses, all our engines firing on all cylinders. Revenue across the consolidated results up 28%. Profit after tax up to 5,455 crores, up 34%. As we look at performance by business, Growth Gems are driven essentially by real estate or life spaces, by Excello, by logistics, up 3x. Mahindra Finance, as I mentioned earlier, up 78%, and TechM 28%, Auto and Farm 21% and 15% respectively, and investments up 2x as well. Let's look at each of these businesses. Auto has been driven by an SUV volume growth of 15%. We continue to be the number one SUV player from a revenue market share standpoint. E-SUV penetration's at 12% now, a very healthy number and a very rapid growth over the last year. And we spoke about commodity inflation that the business has been able to navigate despite the challenges that it has brought with us. From a future standpoint, the new IQ platform will result in multiple models and give us a much stronger foothold in the less than 4 meter segment.
Well, that was the management of M&M talking about the earnings that just went by and the outlook ahead. We will keep getting you updates from that particular press conference, especially given the fact that there has been a consolidation of some of the heavy-duty businesses that the company was running into SML Mahindra. Well, in terms of individual stocks and individual sectors, M&M, in fact, has seen quite a bit of an uptick post the results. The numbers were largely in line with what the street was anticipating in the CNBC TV18 poll. So that particular stock doing quite well. Have a look at some of the IT companies. The mid-cap IT has suddenly weakened quite significantly. KPIT Tech from the mid-cap IT space has seen quite a bit of a downtick, and along with that, it's taken down persistent with well. But this is our special segment, Mid-Cap Movers. Ria is standing by the big wall to take us through all of the mid-caps that are moving around in the session.
Well, yes, let's start off with the gainers first. We have Reddington as well as Balkrishna Industries, both reacting to their Q1 numbers. MTAR Technologies also reacting to strong Q1 numbers. Today, the stock is locked in an upper circuit of 5%. And this is after the 40% correction that we have seen in the stock over the last 1.5 months. Syrma SGS also reacting to good numbers, and this stock has doubled on a year-to-date basis. And apart from this, Alchem Laboratories is also performing well in today's trading session. And on the flip side, looking at some of the losers today, we have PCBL Chemical as well as Hexaware Technologies, both reacting to a weak set of numbers. Syngene also reacting to its Q1 numbers, and the stock has been declining over the last few months, down nearly 40% on a year-to-date basis. Chem India Projects also reacting to its Q1 numbers today, but this stock has doubled in the last 6 months. Today, seeing a big cut in the market today, and Chalet Hotels also taking a cut today. And also looking at the top sectoral loser today, which is the Realty Index, down nearly 1.5%. We have Prestige Estates, DLF as well as Godrej Properties, all on that list today.
Okay, all right. So some of these names which are buzzing in the broader markets. Thank you so much, Ria, for joining us as always. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll talk more about markets, get you some stock-specific action as well after this very short break.
Welcome back to Mid-Cap Radar. Well, have a look at what exactly is transpiring as far as the sectoral indices and the sectoral heat map is concerned. The Nifty Auto Index buoyed by quite an uptick that you're seeing across most of the two-wheeler names. Hero Moto, TVS doing very well. That particular sector is the sector that is up over 1%. And when you see the other set of stocks, especially the mid-cap IT space, those are stocks that are seeing quite a bit of selling pressure. If you could pull up the intraday chart of TVS Motor, that particular stock has spiked to the high point of the day. Even a name like Apollo Hospitals, that particular stock too, in the last 20 minutes or so has surged to the day's highest point. Select realty companies are seeing quite a bit of selling pressure. Look at names like Lodha, that particular name under quite a bit of stress. And Maruti, that particular stock, remember the company will declare its results tomorrow. Maruti has jumped up to the high point of the day. And all of this on the back of the results that you've seen from Mahindra & Mahindra just a while ago. In terms of individual stocks that have seen a bit of a bounce back from yesterday's trading session, Bosch, remember, yesterday at one point of time in the trade was down almost 4.5%. That particular stock today is up over 1% in the session. And Adani Ports is one particular name that's seeing quite a bit of selling pressure. But with that, it's all the time we have on this edition of Mid-Cap Radar. MF Corner when we return.
Hello, good afternoon. You're tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Gutra as always. Sonal, good afternoon. And one more day of MF Corner amidst earnings season, but a lot of updates coming from the world of mutual funds as well.
There are, and you spoke about it on Tuesday as well, how we do have a dedicated fund now for REITs and real estate. So commercial real estate is now getting its own dedicated mutual fund. But is this the right time to invest with interest rates, REIT valuations, and the real estate cycle all in focus? Do REITs deserve a bigger role in your portfolio? To help us understand that and more, we are now joined by Sanchita Mukherjee, who is the managing partner at Talk the Walk. Sanchita, good afternoon. Thank you so much for joining us. Edelweiss is coming with the first kind of REIT-focused one. Does it really make sense to have a fund like that? Doesn't it really become sectoral and then comes with its own risks and falls in that particular category?
Thank you so much, Sonal, for having me here. It's always a pleasure to be on your show. Let's understand. So what I'd be talking about is mostly for educational purposes. It's a very generic discussion. I'm not advising on any product or any namesake per se. But what we really need to understand is what exactly is a REIT and what is this new fund. REIT is essentially a listed trust which owns income-generating commercial assets like commercial offices, grade A offices, malls, warehouses, hotels, for example. And investors can buy units of REITs with expectations of getting a share in the rental income, with getting a share of the capital appreciation of the properties in the REIT without having to hold a physical commercial real estate, which can be quite a big amount, right? So that is essentially a REIT. Now, what this fund is all about is a REIT reality index fund. So it is a combination of a mutual fund holding REITs in combination, not one specific REIT, but REITs in combination, as well as listed developer stocks. And the benchmark for this fund would be the Nifty REIT and Realty Index. So that is the first. So it is a breakthrough. It's an innovative product for sure, but investors need to understand the design of this product, what it entails, what the underlying is to go forward with it.
Okay, Sanchita, point taken there, a new fund category, at least focusing on REITs and realty kind of a fund, and that's what the comparator will be. Nifty REIT and Nifty Realty Index is the underlying that we take in. Sanchita, specifically for REITs as an asset class, how are you seeing that, after it being allowed to make in those investments for funds? How is the traction now? Are fund houses looking at this category actively? What have you seen?
Yes, absolutely. So REITs are classified as an alternate investment class. They're somewhere in between equity and debt. And why so? Because in fact, in India, REITs have done very well in the last couple of years. There are 5 REITs in India in the listed space, and they typically have close to 187 plus million square feet of commercial office space, and globally commercial office space is doing well in India with the absorption, with the renters. The average rental is close to 85-90%. So REITs work like a steady rental income flow for investors with a quarterly payout. People track occupancy rates, people track the dividend yield. And within the mutual fund industry, of course, I mean, if one were to see the market capitalization of all the combined REITs put together, it's close to gross asset value of 2.7 lakh crores. But the mutual fund industry, which in itself is 82 lakh crore as of today, does invest into REITs in the multi-asset funds and certain funds. They use it as a bridge between equity and debt for an income, stable income producing kind of an asset.
Okay. So, Sanchita, since it is first of a kind which has REITs in the fund, and this is coming after SEBI now allows, this to be classified as an equity and not a hybrid fund, where it is actually a hybrid category of an asset class, wouldn't it be better to buy a REIT share than invest in the entire fund? Isn't that a better strategy for any investor?
See, there are pros and cons to it. And again, no investment advice over here. All viewers are advised to go to the registered investment advisor to analyze the risk profile and the portfolio for an allocation. So definitely this is an educational conversation. But having said that, in a mutual fund structure, the pros would be that it offers diversification, right? When you have a fund, which is a combination of REITs, plus it has real estate developer stocks as well. It is an equity kind of a thematic sectoral kind of a bet, right? You do have diversification. SIPs are allowed. So a lot of retail investors might find entry levels easy. It has an index. It has a benchmark index which can be tracked. And moreover, it's easier to invest through the fund structure because then you do not have the concentration risk of investing in a single REIT or a single developer stock. But having said that, again, one must understand these are very different from owning a single REIT. A single REIT, for example, would entail like a complete listed equity stock, right? Though the idea is to buy units into the REIT with a share of the rental income, with a share of the property appreciation. But having said that, it is trading on the index, a single REIT, like an equity share.
Sanchita, this fund is coming at such a time, right, when we're seeing the realty cycle is almost, seems like at its peak, right? So how do you make, or what would one make of the realty stocks and the timing as well of this fund?
This is the biggest question, and I'm so glad you asked this. This is important because let's understand, whilst REITs have been doing really well and India's office space demand, given that GCCs constitute almost 40% of the office demand and REITs are giving a very healthy rental. I mean, till date, I think they've returned close to 31,400 kind of crores back to investors. But having said that, interest rates are high. What would actually happen is in this kind of a fund, it also invests into the realty stocks, which is the developer stocks. Now, these are very, very contingent to the interest rate cycles, right? When the interest rates go up higher, then borrowing costs increase for developers. Capital appreciation actually might suffer, it might come down. When interest rates come down, it's the other way around, property appreciation happens. Also, what has happened is, especially for the developer stocks, residential real estate is right now trading quite high in terms of valuations. If one were to look at pan-India, the absorption of residential, which in itself is at a high valuation. So definitely this fund needs to come in with a bit of caution because that component, which is the real estate developer stocks, adds to it the volatility, the cyclicality which comes with the real estate sector in residential.
Okay, all right. Take that point. In fact, before we get into a break, let's just quickly take a look at this Edelweiss Realty Fund that is coming. We're talking about it because, REITs have been around 1% of the total AUM of the industry, which is a really low amount, around 23,000 crore rupees is what we are seeing. So Edelweiss Mutual Fund is set to launch India's first REIT-oriented index fund. It will be a passive fund, of course, but it will have realty stocks as well. So it's just not REITs because we just have 5 listed REITs. That is not it for this index. It'll have other realty names as well. The NFO period is between August 5th to 19th, and we have the fund managers Bharat Lahuti and Mansi Jalgaonkar. It will mirror returns of Nifty REITs and Realty Total Return Index. Now remember, Realty Index has been one of the biggest outperformers this year. After that sharp fall that we saw at the start of the year, it made that quick recovery. And we did have a comment coming in from the CEO of Edelweiss Mutual Fund as well, where Radhika Gupta did indicate REIT is an equity instrument, InvIT is hybrid. A combined fund is no longer an equity index fund, but it is actually a hybrid index fund. That's exactly what I was saying earlier, that it becomes a hybrid category, not an equity category so much. Hybrid index funds do not allow such a construct. They are built for pure equity and debt instruments. This is how current SEBI regulations for passive funds work. So it's an interesting one. We'll understand whether it's the right fund for you or not, because REITs are also picking up now. But before we do that conversation and get into further details with REITs, let's take a quick break and we'll continue our discussion on the other side.
Welcome back to MF Corner on CNBC TV 18. Today we are discussing REITs versus REITs Fund, the Edelweiss REIT Fund, which is going to be coming up as well and opening up. The NFO will open up as well. But we're discussing all of this with Sanchita Mukherjee, Managing Partner at Talk the Walk, to understand whether it is something that you should be looking at to invest in as well. What should you watch out for in this category? Sanchita, taking the conversation forward, what are the biggest misconceptions that retail investors have about REITs, and what are the risks also that are sometimes and often underestimated by retail investors as well? Both the sides, if you could tell us that first.
Yes, so some of the biggest misconception is REITs, it's like buying a property, right? No, you're not buying a physical property, you're buying units of a commercial income stream. So that's myth number one. Myth number two is REITs never fall. That is also not true because they're listed and they trade just like equities, so the can go negative. And the third misconception would be that REITs are very high dividend yielding. However, so they must be very, very safe. However, when you're evaluating REITs, the basic investment principle, which is extremely textbookish, but however needs to be followed, is that you do not actually monitor the stock prices. You have to look at a whole variable of factors like occupancy, tenants ratio, not that it's not concentrated on a single star tenant, debt to asset ratio, then something known as WALE, which is weighted average lease expiry. The longer the WALE, the higher is the stability of the income. So a whole host of things are considered when you're looking at REITs. So it's not that just because they're high dividend yielding, it is a safe quality of an asset class. One needs to be cognizant of all of these factors, and especially when you're developing this into a fund, which is a combination of a REIT and a real estate fund, real estate stocks combination. The NAV also matters. What happens to the NAV growth? For example, in developed markets, we've often seen even in REITs, the NAV actually can be trading even negative. I mean, the REIT might be having stellar, fabulous buildings in its portfolios, but the NAV growth, because of the interest rate regime in that economy, financing, bad office demand market, NAVs can be trading negative. This has happened in developed markets. We have seen that. In India, it's very solid right now because the office demand is really good and institutional investors are pumping money into GCCs and all of that. But
income, you'll have dividend, you'll have interest. Some of it will be tax-free as well, and that is something which will give you maybe a return anywhere between 13 to 15%, considering the capital appreciation part of it as well. But as you said, there can be negative NAVs. There are other aspects. If it is not a grade A asset, though we do have grade A asset REITs only for now, but if that is not the case, maybe the rental income will not grow the way that you are anticipating it to, and it might not convert into distribution, the kind of distribution that any investor is promised as of now. So Sanchita, for someone building a long-term portfolio today, where do REITs fit alongside equities? There's fixed income, gold, there's physical real estate as well. Is this a must that you should have some exposure to REITs, considering the way we're seeing this big interest come by?
So to be honest, Sonal, again, no investment advice. One must look at their own specific risk profile. I mean, we've just had this long conversation in which we understood that this is not a simplistic fund, right? The way it's designed, the way the product is manufactured, the way it's rolled out, the index itself is a REIT and a reality index, right? So the benchmark is there. So it's a complicated product. It is definitely for very savvy investors. The way REITs have traditionally been used into mutual funds is through multi-asset funds. Multi-asset funds have actually actively used REIT, gold as an allocation along with equity, along with fixed income to give a flavor in multi-asset investing to the retail Indian investors. So they traditionally that has been used. Definitely this is an innovation because previously if an investor wanted to have a real estate as an exposure, what would one do? One would directly buy real estate stocks, or one would directly buy one REIT, or one would directly invest into, say, an international fund of fund, but to get an exposure to real estate, but they also have the certain caps and issues in investing. So this is definitely an interesting option in which a combination of REITs along with real estate stocks is there as a fund with a benchmark to go by as an option for retail investors.
Sanchita, I just want to understand one thing, that what if someone who already owns, as an investor, maybe is directly invested in these REIT options, REIT units as well already, then would it merit maybe looking at the fund, or it's better to avoid because then there will be an overlap, right?
Yes, completely. Again, I think a registered investment advisor would be better able to talk about this. But having said that, one has to look at your own risk profile, the allocations you're doing into equity, the amount you have in fixed income, the amount you have in metals or in gold or silver, the amount you have in land as a portion of your portfolio, the amount you have already in real estate, the amount you'd already have in one REIT per se. So all of that goes into understanding a portfolio allocation and an asset allocation and the risk profile for an investor. So it's best to advise that one takes a call with a registered investment advisor on this aspect.
It's very specific to personal needs, risks, your goal, your time frame for investment as well. So it's best taken as at an individual level. But you did touch upon NAVs, Sanchita. I want to come back on that because they trade at varying premiums and discounts to NAV. How much importance should investors give to NAV at par with their NAV, the valuations that we are seeing right now? Because there is discount that we see despite strong operating performance. Why does that happen? If you can make us understand how to look at that particular aspect of REIT investing.
Yes, that's a very good question because like I mentioned, a lot of stellar performing REITs in developed markets currently, there have been cases of REITs going bankrupt in developed markets, of trading with negative NAVs. In India, whilst I said that the office environment and the demand is really good, for example, 2025, there was an absorption of 90 plus million square feet real estate, commercial real estate, which is one of the highest globally. So the demand is strong, but real estate REITs come with their own challenges in terms of one has to monitor and one has to, that's why I'm saying an investor has to really, really understand how these things work. One has to look at the occupancy, the tenancy, the refinancing costs, the debt to asset ratio, the management, if there's any governance issues, if there are any cost, variable cost, which is not showing up. All of that goes into understanding what constitutes an NAV, and these things need to be monitored.
Okay, all right. So NAVs are something that you should keep on your radar. In fact, not just for REITs, we actually have to look at that from a real estate stocks perspective as well, because the net asset value is something how you value all these names. Thank you, Sanchita, for joining us today and giving us a sense of how these REITs would work and at least an explainer on what an investor should look at while looking at this fund maybe or individual REITs as well. Thank you so much for joining us with your thoughts today.
Thank you so much.
Okay, all right. Before we wrap, I just wanted to take a look at some of the fund performances, Winnie, because while we are talking about hybrids, and hybrids are the one which have both InvITs and REITs for now, the REITs are again an equity category despite having both the elements in its overall fundamentals. We've seen so far arbitrage being one of the best performers, which has seen a return this year of around 3.35%. We do have income plus arbitrage, which is up around 3.28%. Conservative hybrid is up around 1.55%. This is this year so far as on 29th of July. Multi-asset allocation has done gains of around 1.5%. Equity at around 1.46%. Balanced hybrid has been flat, but it is still a positive number. But look at aggressive hybrid. In a time when market has fallen so much, we've seen a fall of around 0.2%, where the other categories has done really well. We have dynamic asset allocation, which is down even further, 0.36% gone there. So yes, not big swings is what we have seen. Hybrid has, at least in comparison, done not so bad. Let's put it that way. But important to keep that on your radar as well, that these are some of the categories, how they have performed in this year so far. We've been talking about some of these arbitrage funds doing really well. So we do have Quant MF, which has seen gains of around 7.57%. White Oak Capital Arbitrage Fund has seen gains of 7.1%. And Motilal Oswal Arbitrage Fund has seen gain of 7.06%. With arbitrage, they also have equity taxation versus a liquid fund, and hence they do get a taxation benefit when it comes to parking your short-term funds. And this is something you discussed on Tuesday as well.
Absolutely. And this is a category where it comes in, you get that benefit from the short fund side as well. That time also they spoke about how, arbitrage can be used as a way to park your money here, and that does give you some bit of a benefit. So that is interesting because it's a mix of equity, debt, all of that comes in here. And hybrid as a category, Sonal mentioned the returns that we're seeing coming in just on the YTD basis as well. So interesting to keep, this on your radar as well. But, just that this whole category, whether it's hybrids, flexi, multi-asset allocation, REITs, InvITs, all of them are picking up. And that is what is important to see, that how these funds also start making the investment, especially in all of this. Today we have Edelweiss that will be launching these REITs, sort of a mutual fund, and NFO. Whether others also follow suit will be key to watch out for. But with that, we're absolutely out of time on this edition of MF Corner. Thank you so much for tuning in. Up next, your closing bell.
On market headlines, to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Where the uncertainty has increased, and that is why when you look at Asian markets, they've opened up a bit mixed as well.
We're hitting them very hard because it's our turn to hit them.
Even with recent shocks, the trends are positive.
Oil's back near 90, 89.4, and the Fed's kept rates unchanged.
Just telling you, at lower levels, the bulls will want to come in to fight.
The reason we are able to do what we do is because of the cost structure, we are able to experiment.
Nifty Bank is down 0.4%, 56,900.
We now think that the risk reward for the markets are more balanced.
Take advantage of the growth in these segments over the next 4 to 5 years.
The Nifty Bank is down by about 0.6%. The IT index is doing well.
I think the overall volumes is something which would really matter in terms of how we are able to grow.
22 points are on the Nifty, but it's been quite volatile since the word go. We did see a sharp fall, then a recovery.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as we speak, Mangalam, the markets have virtually not moved at all. We're holding at around that 24,240, which is the mark from where we started as well.
Yep, and it's very interesting. We keep speaking about the uncertainty within a range. Look at the high and the low today on the Nifty. The low was closer to around 24,187 thereabouts. The high was upwards of 24,330 thereabouts. We're right in the middle of that range. We've traversed that near 150 point. It's a very narrow band where we're at. It's just the broader markets which are a little bit of a worry. 2 stocks declining for every stock which is advancing. And it's surprising given the sort of, numbers that have come by so far as well. None of them have been howlers, so to say. I guess it's just the uncertainty around the macros which is impacting us.
Well, that's right, Mangalam. To wake up to cues when you have the 10-year yield that has spiked up, and you also had, the crude oil prices as well that had moved up. So in that sort of a backdrop, if you're going to go home more or less flattish, the bulls will take it, though the broader markets today are under some pressure. Vedanta Aluminium's numbers actually were flashing for you at the bottom of your screen. Remember, the street is quite bullish on this part of the business, and bulk of the value that came out of the demerged entity is attributed to Vedanta Aluminium. The problem is aluminium prices itself have corrected. In the last 2 months or so, from a peak of $3,800, it corrected around $3,100 per ton. So yes, these numbers look impressive. 10,000 crores of an EBITDA number is what they done, which is very, very impressive for Vedanta Aluminium. However, what the street will look forward to is what kind of a run rate can they do from here? Because in all probability, the first quarter could be peak earnings, given that they had the benefit of higher prices and input cost will follow with a bit of a lag. So they're focused on the cost side, yes, but that's something that you should keep an eye out on with regard to Vedanta Aluminium. That's why you're not getting that reaction on the stock, though it's come off a little bit from the lows of the day. Listed at around 535 rupees, and now it's holding at around 435 odd.
Yep, that's about Vedanta Aluminium. Just keeping an eye out on a couple of these other buzzers as well. An hour ago, we got the numbers from Mahanagar Gas. That stock's now moved to the high point of trade, sitting at the gain of almost 5%. From the word go, we've seen traction on Balkrishna Industries, so that stock continues to hold well. But today's day, if there was to be a sector, it has to be the auto sector. Today's day belongs to that. We've seen good moves coming in on Eicher Motors, obviously because of the numbers. But now look at Hero MotoCorp, look at TVS Motors, or even something like a Sona BLW or auto-related plays, which are a buzz in today's session. So let's tell you what's lined up on the show today. The stocks are off lows, though the Nifty is flat, inches towards the 24,250 mark right now. The broader markets, consistent underperformers of the day. Autos and IT stocks are the ones which are in the green, while financials and real estate stocks under pressure. M&M delivers an inline show to in the April to June quarter. Market share gains continue for them. Core earnings remain healthy. A deep dive into what worked for them coming up on Closing Bell. Alongside that, we speak about Exide Industries that reported a healthy first quarter numbers. We saw double-digit growth across segments, a detailed earnings fine print coming up in just a bit as well. And the start of the day, MTAR Tech locked in 5% upper circuit following stellar first quarter results, and this after a big fall that it saw all of last month. So what's worked, what hasn't, we'll get the assessment up for you as well. Also the expectations from big earnings tomorrow. We have Tata Steel, ITC and Maruti, 3 major Nifty companies.
Well, how do you position yourself though in the final hour of trade? We have Mitesh Thakur who joins us to help us out with the strategies. Mitesh, what would you do? We're almost at the same point as we are at around 9:10 when we spoke earlier today. What's your take? Would you say that the markets actually have been quite resilient, given the fact that we had a big run yesterday and we woke up to a little bit of gloomy cues? First the index and then stocks.
Resilient, yes, definitely, Nigel. But I also maintain that the index, will give you a breakout once it sees it closing about 24,400. I think till then we are just in a sideways consolidation. The good thing is that every time we have declined, we've kind of bounced back nicely. But yet, I think the stronger up move will happen once we are above 24,400 and on a closing basis. So till then, I think trading on a stock-specific basis looks to be the logical way forward. I have a buy on APL Apollo with a stop at 1870 for targets of 1935. And Nuvama, I think after a long time, is showing first signs of profit booking. If it starts trading below the range of 1800 to about 1795, then take a short with a stop at 1827. Look for target of 1735.
All right, so there's Nuvama, and you had another call as well. Take that point. Let's talk about M&M. In fact, before we come to you once again on the auto pack, Mitesh, that's the one which is gaining in trade after posting an inline set of numbers. Sudarshan joins in with all the number crunching. Sudarshan, they continue to gain market share.
That's true. And overall, if you talk about the earnings were largely in line, continues to maintain a healthy revenue growth. But on the margin front, it has taken a dip, mainly because of the raw material cost increase that we have been seeing over the last few months. And companies talked about in the meet that in the auto segment, if company had not taken any measures, in the auto segment, margin would have been impacted in the range of 400 to 500 basis points. And in the tractor segment, impact could have been in the range of 300 to 400 basis points. But due to the measures taken, the impact was a bit lesser than that. So talking about the headline numbers, profit has seen an increase of 7%. Revenue was higher by 23%. EBITDA increased by 5%. And margin has come at 12.3% against our expectation of 12.6%. Realization for both tractor and the auto segment has an increase of 1 to 1.5% if you take a look at YOY. And total volumes for both the auto and tractor segment were higher. Auto 23% YOY, tractor segment up 17% YOY. Now in the press conference, company has talked about the tractor segment outlook for FY27. In the first half, they have seen a healthy growth. They believe that H2 can be a bit weaker, and that's the reason they have maintained mid-single-digit growth. But that can also be taken very positively, because some of the expectations are of the flat growth for FY27 as far as the tractor segment is concerned, but maintaining mid-single-digit growth for the industry is positive, announced by Mahindra & Mahindra. For the auto segment, revenue has seen an increase of 24%. Overall EBIT margin has come at 7.1%, but this includes e-SUV manufacturing. If you exclude that, then the EBIT margin increases to 8.3% and realization was up 1%. For the tractor segment, revenue has increased by 19%. EBIT margin has come at 18.5%, but core tractor PBT margin was at 19.2%. Here also realization has increased by 1.1%. You are talking about the market share. Company continues to gain market share on a sequential basis. In SUV, they have gained market share by 50 basis points and total volumes were up 15%. In LCVs, market share was up 150 basis points on a sequential basis. Even tractor market share remains healthy at 44.9%. So overall, earnings were largely in line. But if you look at the internals, they are looking strong.
All right, sir, thanks a lot for that. I think the street is coming to terms with, the fact that the stock has been strong. As Sud said, the internals are very, very strong. It slipped a little bit from the top. I'm just looking at some commentary on the wires where they're saying that, the executives that are talking at that conference, they're saying that the second half of the year may not be as strong as the first half of the year, because the second half of the year will be on a higher base as well. So maybe that's caused the stock to slip a little bit from the highs that we saw. Intraday chart should come up for you on the screen. Dilip Bhatt joins us on the show. Hi, Dilip. Good to see you win. What's your take, Dilip, with regard to Mahindra & Mahindra? It's been a rank outperformer. But at these prices, do you think the good news is in the price, or do you believe that this could still be a steady compounder?
Thank you so much, Nigel. It's such a pleasure to be with you all. I think M&M results, I would say that more or less are in line, because if you see, even the valuations are not cheap. They continue to do pretty well without any doubt. I think some margin here and there can make a difference, but I think the growth in SUV and even in LCVs augurs well for the company on an overall profitability basis. Now, coming to the overall, I think the second half, as what we all know, largely due to the GST cut being given by the Modi government, gave a great boost to the entire auto industry. So almost all the auto companies will have a higher second half base, and more so the fourth quarter. So I think that will weigh definitely when we compare the second half of almost all the auto companies. Having said that, I would say that one did not be in a hurry to invest in M&M. I will still wait on the side. Let's look if I can get a better price. But from the current level, I would not look at M&M as an investment for the time being.
Okay. All right. You won't look at M&M as an investment, though. As we speak, there are numbers flowing in thick and fast. This one's from Ajanta Pharma, up around 21% on the company's EBITDA. Margins have seen a slight moderation, which implies that the revenue growth has been slightly higher, but nevertheless, 25% EBITDA growth to nearly 25% revenue growth, 20% EBITDA growth, and the net profit comes up for you as well. The stock's taken a smidge of a spike right now. Net profit is up 31% on low base, so we'll get more details on that one. As of now, the stock high by about 2%. But another stock which is doing extremely well is Exide Industries. Posted a healthy set of first quarter earnings with all segments seeing a double-digit growth. Sudarshan, you've been a busy man today. Batteries now after cars.
All the segments, as I said, have registered a double-digit growth for Exide Industry, and that's reflecting the stock price. If you talk about the headline numbers here also, profit has increased by almost 30%, revenue has seen an increase of almost 18%, and EBITDA has seen a jump of 16%. And despite higher raw material prices, EBITDA margin company has managed to hold on to levels above 11%. It has come at 11.2% versus 11.5% in the same quarter last year. As I've told you, all the segments have seen double-digit growth. So automotive segment growth was of more than 25%. Two-wheeler and four-wheeler replacement business has seen double-digit growth. Industrial business too, excluding the telecom segment, has seen a double-digit growth, and inverters business growth was more than 20%. Even export segment has seen a growth of 20%. If you talk about Exide Energy Solution, they have made another infusion of rupees 100 crore, and now total infusion in that company has increased to 4,900 crore. And from the Bangalore plant where they had set up the facility, from that plant, they believe that it will start contributing to revenue in this fiscal, that is of FY27. So overall, earnings are strong. Even on the commentary part, it's looking strong outlook for FY27.
Got it. Okay. All right. Sir, thanks a lot for that. Time to charge your batteries over the weekend, maybe, sir. Thanks for joining in and giving us that quick analysis, both on Mahindra & Mahindra as well as Exide. By the way, the stock that Mangalam just spotted, Ajanta Pharma, looks like that one's got a good amount of momentum going. The street likes these numbers. Profitably up by more than 30%. That number, in fact, is taking the stock higher. They've declared a first interim dividend as well of around 32 rupees. And I think the top line growth as well was quite strong. Let's pull up the margin performance, because for the time being, that's bursting away as we speak. Ajanta Pharma getting a thumbs up. Let me get in Dilip Bhatt. Dilip, you heard what Sud had to say on Exide. What's your view on the stock? And if you have a view on Ajanta Pharma from the pharmaceutical pack?
So as far as Exide is concerned, I think they've always been a very well-managed company, and the current results really prove that they are moving with the times and they are investing a good amount of their free cash into the business, which is what they're doing very rightly so. And I think the new businesses have also started giving a reasonably very good returns. So I think all in all, I would say that Exide certainly merits a look, though it has moved up quite a bit in the last 1.5 to 2 months. I would still say that even from the current level, it holds a promise of at least another 20-25% on a longer term basis. Because if you go to see the new businesses and the investment that they have made, I think the returns will really overall flatter the ROEs and ROCs in the times to come. So I would look at this particular thing because they're generating a very good, healthy cash flows. And even the basic growth, whether OEM, replacement, you call all of them, they all seem to be reasonably very good and promises to be good even for the next 1.5 to 2 years.
Got it. Okay. All right. Thanks a lot for that, Dilip. Just stay with us. Let's do a quick check on the F&O markets. You woke up today, you saw crude oil prices spike up a little bit. The global news piece itself wasn't very, very great, with the Fed chair sounding a little bit more hawkish than what people anticipated. Most factoring in that, yes, by the end of this year, we get a rate hike. And crude oil prices, after cooling off to sub $90 per barrel, they've spiked up a little bit yet again. So given that sort of a backdrop, if we have a more or less flattish screen, I think that's okay. The bulls will take that. And if you look at the options data as well, it's quite encouraging still, because you'll have to say that the put writing continues in today's trading session. 24,200 put, fair bit of open interest built up out there. And, the premium has come down to sub 90 rupees from around 115 rupees earlier today. Now, the 24,300, beg your pardon, 24,300 call, the premium out there as well has come down to 80 bucks from around 100 rupees. Remember, even when the Nifty was up 50 points, still that premium wasn't moving up. So that's telling you the writers are at play. So in the near term, it appears we're in a broad range. On the upside, it'll be around 24,500. On the downside, it's around 24,000. But if you want to look at the technical, the simple daily moving averages, the 20 DMA becomes the first reference mark, which is very close to today's low, 24,100 approximately. Around the upside, once you get past the 24,500, then all eyes are going to be on that 200 DMA. So that's the important resistance mark that we're looking at. I think if the Nifty needs to move up, the next leg of the up move, Reliance Industries will have to participate. So if you pull up Reliance Industries with the 20 DMA, it's very, very close to that mark. In fact, it's just hit that mark as we speak. So it's showing signs that at around the 1250, 1260 odd mark, there is a good amount of interest. And if we can get past these technical levels, then maybe the stock will be good for more. But the short point is if Nifty needs to get past that earlier resistance mark of 24,500, Reliance Industries is going to be the stock. There is a good amount of delivery-based buying and there's some fresh long build-up as well. The other one I'm looking at is, Union Bank. That's another stock that's done absolutely nothing for the last, 1 month or so. If you pull up a 1 month chart, and I'm looking at the open interest build-up, it's quite substantial actually on that sort of a base. So Union Bank is the other one that you're looking at. Last 1 month, as flat as can be, the Nifty Bank has bounced back. And now you're seeing some fresh buying as well. Reliance Industries and Union Bank to track. On the Nifty, it appears we're in a bit of a range. That said, the actions in the broader markets. MTAR Tech, 1 day up, 1 day down. Today it's up. Remember, Bloom Energy came out with a set of numbers and they upped their guidance. And MTAR Tech itself, the execution looks quite good. Let's get in Ria to help us out with a quick analysis. Ria?
Well, yes, today MTAR Technologies is reacting to a strong set of earnings in Q1 of FY27. It's been a strong quarter all around with the revenue, EBITDA, margins, net profit, all seeing a beat on estimates on all fronts. And this is driven by strong execution across business verticals of the company. The revenue has seen a growth of nearly 130%, EBITDA up by 200% compared to the previous year. Margins also seeing a very strong expansion of 540 basis points this quarter. And the net profit also seeing a significant bump up by 348% to nearly 50 crores in this quarter. So it has been a strong quarter all around for them. Now, what stands out is the order book. The order book has crossed 5,143 crores in this quarter, which has already surpassed the FY27 guidance that the company had given. And in fact, today, the company has also received another incremental order of nearly 820 crores. So that is also another further bump up to the orders. In terms of the guidance, the company has retained its FY27 guidance. The revenue growth guidance is at 80% for the year, with EBITDA margins expected to be at 24%. And today, in an interview, the management also said that they expect to surpass this guidance that they have laid out for FY27, and they've said that they will be revisiting this guidance at the end of Q2, and H2 of FY27 is expected to be stronger than the first half. And further, they've also said that they are looking at scaling margins in every segment of the company. The order pipeline also looks very promising for them. In fact, the clean energy segment, which is 70% of the revenue of the company, is also growing at a very fast pace. And in fact, in terms of the concerns surrounding Bloom Energy and their data center projects, the company has said that these are unwanted worries and there is no impact on the operations of the company as of now. So overall, strong set of numbers for the company, strong commentary as well. And today we are seeing the stock hitting an upper circuit of 5% after the near 40% correction that we saw over the last month and a half.
Take that point. Thanks a lot for that, Ria. Meanwhile, for the market, just keep an eye out on the IT pack now. It's been a strong supporter of the frontline index, but now coming off the highs. Currently, the IT index is at the low point of today's trading session so far. We have Infosys, which has moved lower, and alongside that, we have TCS as well. So both the IT heavyweights come up for you. The IT index actually has given up nearly all its gains. Remember, it's been a rank outperformer over the last week and a half, maybe almost a month as well, but not beyond that. Before that was an underperformer, but now it's coming in for some profit taking. Continue our conversation with Dilip. Dilip, your thoughts on MTAR Tech, and also, would you bite into this mild correction from the highs that we're seeing in the IT pack, given the sort of momentum that we're at?
A couple of things over here, Mangalam, that one is certainly the IT pack has moved into one of those typical sectors like the FMCGs and the chemical sector, where we will see momentum happening at certain points of time, whether it is for certain news that comes in for the industry or some development abroad. So I think whether there is going to be a very secular, sustainable move, obviously not. Even you're asking whether you're going to bite into it on a short-term basis. Maybe that would be the right strategy, but since I don't really understand the short-term movements, I prefer to stay away. But otherwise, as what I would say, this entire pack continues to be very good because we have once again seen all these companies are very well managed companies. They look very attractive. But the question is, the sheen has really gone off the entire software companies in India because no more India is the USP in terms on an overall basis in the world. And certainly, as what we know, that the international peers are trading at a much more attractive valuations than India. So maybe short term, it could still be a buy and it could provide plenty of such opportunities all throughout the years. But otherwise, I would prefer to stay away from tech for the time being.
If someone had bought and they're sitting on either a flattish number or maybe some gains, would you advise them to sell?
You mean the IT?
Yes.
So well, what I would say is that as a slightly providing some resilience to the portfolio, maybe I would say that even if you're holding 100, at least you must retain 50 because the growth on a sustainable basis is very difficult to come by for IT in terms of the stock prices. Maybe it could provide some resilience because some of them would become attractive from a dividend point of view, dividend yield point of view. And that, as what we always say, the cash flows are very good. The conversion from operating profit into cash has always been one of the best for these companies. And as it is, they're very well managed. So
Okay.
a certain portion you have to retain to give defense and resilience to your portfolio.
All right. Defense, hang on to what you got, but maybe buying fresh, you could wait some time. Thanks a lot, Dilip, for joining in and giving us your quick take on all the stocks that we discussed. Time to take a short break. On the other side, we have our Alpha Manager of the Day, Ajay Tyagi of UTI Asset Management, will be joining in. Stay tuned.
Welcome back. We're talking about, the market now bouncing back a little bit. It's up 25 points. When we started the show, it was down about 13 points. So it's been volatile in that range. And now the mid-cap index as well. A large part of the up move can actually be attributed in the last few minutes to Maruti Suzuki. That's the one which has moved to the high point of trade. Reports its numbers tomorrow. A big surge is what we're seeing on that counter, up from the lows. And there you have it, zooming ahead. But another stock which has been doing well is MGL. Reported a good set of numbers just a couple of hours ago, and despite the ongoing West Asia crisis, the stock is now holding up with a gain of almost 1%. At one point, was up about 5%. Sonal joins in with the details of these numbers. Sonal.
Well, the stock has come up from the highs, but it was a good set. There are no two ways about it. On a sequential basis, it was a decent recovery. Revenues up 15.5%. We did see an EBITDA growth of 32% on a quarter-on-quarter basis to come in at 343 crore rupees. The margins have improved as well, 200 basis points. This is at a time when gas costs had increased substantially on a quarter-on-quarter basis, and there were gas availability issues as well. Profits were up 49% to come in at around 193 crore rupees. Despite all the issues and the fact that there were gas curbs, the volumes have remained flat sequentially, and they're up 2% on a YOY basis to come in at 4.7 MMSCMD. The stock outperformance today at least came because it has not done much this year so far. It has been absolutely flat. This week so far, the stock is up 5.5%. Valuation-wise, this is one of the cheapest in the city gas distribution space. So yes, good numbers despite what we saw in terms of gas crisis during the West Asia crisis, and that's why the stock is reacting positively to earnings.
Got it. Okay. All right. Thanks a lot for that, Sonal. Stock has actually come off, as Sonal mentioned, but at one point of time was bursting away with a gain of around 5%. Let's get in Ajay Tyagi, President and Head of Equity, UTI Asset Management Company, who joins us on the show. Hi, Ajay. Good to have you on the show. Thanks a lot for joining in. How are you feeling about the Indian markets? It seems to be a split verdict. One saying that we are getting ready to give up this underperformance, but the other fear is, can we have the rupee as well as crude at 100 mark for longer than expected? And that will clearly ruffle the bulls. Which camp are you in?
Sure. So since your question is around the direction of the markets, particularly in light of what's happening in West Asia, let's look at the history of crude and how Indian markets, particularly the Indian rupee, also have behaved over the last decade or decade and a half. So if you recollect, around 2012 to 2015, when we had a war in Libya, crude was somewhere between $100 to $110 for about, I would say, at least 3 years, and if my memory serves me right, closer to 4 years. Of course, the first knee-jerk reaction was that rupee fell precipitously by about 15-20%, and that's why we had the first set of FCNRB deposits under the swap window by RBI, and we collected a huge amount, post which rupee stabilized. If I were to just draw an analogy here, I would say that we are in a very similar environment. Perhaps crude could remain around $100 because we know that the Iran war is facing a start-stop situation. I mean, sometimes it feels that there is a ceasefire, and then we once again see those, firing happening between the two parties. So let's even assume that crude remains around $100. At least historical context tells us that post the initial knee-jerk reaction, rupee does stabilize. And by the way, while we don't know what the final number would be, but there are initial signs that possibly by the end of September, the time frame till which this FCNRB window is open, we could collect something around $60 to $70 billion. That's good enough ammunition and firepower, for the RBI to defend. Yeah.
All right, take that point. So that's your view on the market at large. What about sectors? I mean, how are you feeling about the earnings season so far? Not been particularly bad. In fact, this morning itself, we had Amish who joined in from BofA said that so far from their universe, the earnings growth has been 12%, which is tracking much ahead of their expectations for the full year. And this has been in the middle of the crisis. So obviously things are likely to, if not improve further, even if they stabilize here, this year double-digit earnings growth isn't too far or too far-fetched as an assumption. What are you feeling about the earnings sector so far? Earnings, and what sectors do you think are attractive to you?
So firstly, I'll completely concur with your views. The earnings expectations for FY27 are somewhere in the mid-teens range, and it does appear, looking at the first quarter, and we all know that the first quarter was impacted by the war, particularly the months of April and the first half of May were significantly impacted by the war on account of the consumer sentiment. And yet we see numbers which are fairly gratifying. So to that extent, landing up at mid-teens level for whole of FY27 is certainly a high probability event. And obviously what's also helping is the very weak base of FY25 and FY26. The other thing is that we are seeing some signs of the income tax cuts and the GST cuts that happened last year propping up the consumer sentiment. It was very evident in consumer discretionary like autos way back in October, November of last year, and that's flown through over the last 6-7 months as well. But we are now also starting to see signs of that in less discretionary categories and in some cases even staples, so to speak. So yes, all of this is only going to help in terms of earnings. To your question on which sectors do we like, I think if we and we obviously have to contextualize everything in terms of valuations. If we look at the private sector banks, I would say they are available at less than one standard deviation valuations. We have a case where the markets are still trading higher than their long-term averages, but here we have most of the private sector banks trade at, let alone averages, I would say less than one standard deviation of the long-term averages. So clearly there seems to be a disconnect, and we are of the camp that there hasn't been any lack of pricing power. There hasn't been any new competition which should warrant such a massive. So that's sector number one for you. Look, we are positive on IT, and it's not just because of our view on valuations. Valuations clearly are very attractive, notwithstanding the very recent bounce back that we've seen over the last 1 week. But we are in the camp that AI is going to be a net positive for the Indian IT services industry beyond the first few quarters, where it could be disruptive, just like any previous wave of technologies have been disruptive in the near term. But beyond that, the scope of work for IT services companies definitely increases, like we've seen in the past as well. So we find that to be, once again, a sector where the near-term news flow and the news flow on AI has completely led to disbelief about the growth prospects of these companies over the next 5-10 years. So that's another sector that we like. Lastly, consumption. Because of reasons that I just mentioned, I think after last 3-4 years of weak consumption, certain moves by the government, I would say not just the income tax and the GST cuts, but the upcoming 8th Pay Commission plus the welfare schemes launched by the states definitely would impact consumption over the coming quarters and years. Yeah.
Got it. All right, Ajay, just to get some clarity on IT. You're sounding reasonably more optimistic, and you're pretty clear on that. Not sitting on the fence, it appears, as of now, but you're maintaining a positive bias. And I think as a percentage of your fund, I think it has close to 9% of weightage.
Yeah.
All right. So y'all are not the fund that is underweight. As of now, you're more or less in line with what the weightage is.
We're actually slightly overweight.
Slightly overweight. Got it. That's good to see. You spoke about consumption, actually. The street was bracing for a big IPO coming in, and it may not happen. We don't know with regard to these food delivery, quick commerce players. And in that sense, if I look at your portfolio, Eternal's one stock out there that's seen a big move. From the top, it was close to 400 rupees. At one point of time, we saw it close to 50 bucks as well. And post its results, actually, the street is believing that the bigger boys will actually do much better. And that's why the stock has done quite well. That would be one of your top holdings, right?
Yeah. I mean, you have the fact sheet with you very clearly, but I'm only afraid that I cannot be very specific on stocks. So, I won't be able to answer anything, particularly on any of the stocks in the portfolio. Yeah.
Spoke about consumption, but delivery theme, I think, is something that you like. And what is your view? Suppose this third player to get listed doesn't come. Will it be an additional fillip to this one?
So see, the big picture view I can give you, and once again, like I said, can't get too specific, but look, the big view is that, and let's say that I have no view on whether the IPO for the third player comes or it fails. The fact of the matter remains that the number 2 and the number 3 player have been in the fray for fairly long now. They've been in the marketplace for the last 4 or 5 years, and yet they don't have any paths towards profitability. So restricting myself only to the industry-wide view, our view clearly is that there are, very, very few players who will be able to maintain both growth as well as profitability at the same time. As of now, it just appears that, most of the players are either solving for growth, and when they realize that their profits when they realize that their losses are actually widening, they start to cut down on their cash burn, but that obviously comes at the expense of growth. And if there is, somebody who can solve for both growth as well as profitability, then you clearly know, where would the, market share gain land up. Yeah.
Damned if you do, damned if you don't. That's the conundrum that these guys are facing right now. And if you do both, then for investors, the valuations aren't coming any cheap. So, it's a very interesting paradox to be a part of right now. Though we'll continue our conversation for another time. Thank you so much for joining in. We'll leave it here with the news of the markets actually now picking some pace, up 50 points of the frontline index, and a large part of that led by the auto pack. We'll take a short break, come back, as always, get you a check on what the dealing rooms are saying. And alongside that, we'll also get you our tomorrow trade calls. Buy today, sell tomorrow.
Welcome back. We have a bit of a weekly expiry element as well that will play out on the Sensex, because there's the weekly expiry today. But just pull up the, if you pull up the Nifty Bank as well as Reliance Industries, you'll see the Nifty Bank that was down 250 points. It's cut its losses to around 50 points. Now it's being a little bit volatile. But a good recovery is what we've seen from the lows. In fact, it's on the verge of moving to the green. And the other one that we highlighted at the start of the show is Reliance Industries. That as well has been a bit of an underperformer, but it's now crossing that 20 DMA which has been a mark from where it's getting some kind of rejection. So keep an eye out on both those two. Beautiful looking screen as we speak, 60 points up. Well, let's find out what's going on in D-Street chatter. Nimesh joins us to tell us what has he picked up. Hey, Nimesh.
Hi, Nigel. A bit of lackluster day of trade. Even the institutional activity seems to be on the lower side today. I guess the bigger momentum will come only when we cross 24,350, 24,400 on the upside, because that's been acting as a very strong resistance for the last many weeks. So that's the feedback as well. That, once we cross that level, you'll see a bit of short covering rally as well, not in Nifty but in the Bank Nifty as well. So that's overall feedback. From a flow perspective, as I said, a bit of lack of participation. But within that, the space which is seeing a bit of buying is metal names today. So it's not only individual metal stock, but across the board there is a bit of buying back in metal names in today's trade. Again, sharp reactions to earnings continue, and maybe because of why you're seeing the mid-cap index down 0.5% today. But broadly, it's been a lackluster day and lack of participation as well from larger institutions in the broader market stocks today.
Yeah, but you would have dug out some news from somewhere. So tell us about the individual stocks.
Well, so that's the kind of pressure you put in, Nigel, every day, right? So the first stock on my list today is IFL Finance. That's been buzzing in trade in a relatively quieter day, up to 1% after a large block. So 1.5% equity got changed hands. My sense is it's a FDI to FI trade. The largest FDI holder was a seller in today's block, and the leading long-only FI was a buyer in today's block. So any disclosures could be quite interesting in IFL Finance, so watch out for that. The second name is KPIT Tech, down 10% in today's trade on large volumes as well. My sense is post Q1 earnings and a disappointing con call. A couple of large FIs have been seller. There was a block deal reported in yesterday's trade as well. Looks like with today's volume, there has been a clear out trade with those two large FIs. So watch out for any disclosure if there are any further blocks from those two FIs in KPIT Tech today. Third, couple of names where there is buying, and both are metal names, Hindalco as well as Vedanta. So expect high delivery volumes on the buy side in those two names. And on the other side, GMR Airports and Siemens Energy, they both stand out in terms of delivery-based selling from the larger FI. So maybe that's the reason why GMR Airports is down 3%, largely on back of sell flows.
All right, take that point. GMR Airports now down about 3%. Siemens Energy down 2% as well. Thanks a lot for that, Nimesh. A bunch of stocks that we'll keep a track on in an otherwise lackluster market, as Nimesh said. But we are seeing some traction on the Nifty Bank, as earlier pointed out. And, the gains continue on a lot of these individual names as well. Balkrishna Industries started off straight off the blocks, doing extremely well. And now as we move towards trade, it's moved towards the high point of trade as well. It's up nearly 10.5% now. So a big move is what we're seeing out there. And Vedant Fashions is the other one which really stands out with a gain of almost 3.5%. That's obviously the one that runs the Manyavar range of retail stores. That's the one which is higher by about 3.5%. Good time to get in the tomorrow trade then. Mitesh Thakkar joins in. Mitesh, what do you do in this market? Buy today or sell today?
Both. So I think Swiggy has broken out very nicely, and you can see that it's now managed to get past the weekly averages. So it's a BTST with a stop at 293.5 for targets of 300, maybe a position call tomorrow morning as well. And Premier Energies is on the negative side, is breaking below its key support area of around 1,010. That's a STBT with a stop at 993.5 for a target of 965 to about 960.
Got it. All right. Mitesh, one quick word on Union Bank. Any view on that particular name? That's a stock that's gone through a bit of consolidation in the last 1 month or so. And the Nifty in that time actually has done quite good. Any view on this name?
So still in consolidation, 177 is the breakout on the upside. That is where we had a closing on the 17th of April and the 10th of April. These are weekly closings. And it's basically doing a 177, 152 kind of a range. It's still in that range.
Inner range. Got that. Okay, thanks a lot for that, Mitesh. By the way, bottom of the screen, Vedanta Limited. Remember, all that, most of its share value comes in, or almost all of it comes in from Hindustan Zinc as of now. So, those numbers in that sense are relatively immaterial. Remember, post demerger, suddenly someone bid it up to around 350 rupees or thereabouts. But from there, it's seen quite a big correction from 350, 360, come back down to around 267 or thereabouts. Numbers not very, very material because you already have, Hindustan Zinc that has delivered numbers. But let's tell you about the other metal number that's going to keep me busy today, Tata Steel. We keep an eye on those numbers, probably come out by around 6, 7 p.m. odd. We'll update you on that. Revenue growth, we're expecting close to around 9 to around 10%, in terms of a top line. The EBITDA number, will that pop up by close to around 25%, which tells you that margins could improve to roughly around 16% from around 14%, and the profit number will be all around the place. So, take that with a pinch of salt, but look at the operational performance. Now, we already had the provisional volumes that have come in there, and India looked quite good because there's a good growth of, high single digit to around double digit. Came in at around 5.17 million tons or thereabouts, which is good, compares with around 4.75 million tons. So the India delivery number was good. While the European business, well, out there, both Netherlands operations as well as the UK operations, actually the deliveries were a little bit lower. What are the factors that will play out? Well, coking coal costs, that will partially offset the benefit that we'll see of higher prices. So realizations could move up by 4 to around 5,000 rupees per ton, very, very roughly, and that's what mostly the industry number as well is. But coking coal costs could go up by around $15 per ton. So, that's the other part of it. The Tata Steel Europe EBITDA, well, it had moved into the green, but that could come back into the black. That's because of lower volumes in Netherlands. And also, we could see, though, there will be lower losses in UK. So the two big numbers that you'll be looking at for Tata Steel, since we already have the volume numbers, on India business, there'll be some improvement in the EBITDA per ton. 17,740. That's the important mark, around 17,500 to around 18,000 rupees. The other one that you're looking at is the European business, which we're looking at a negative number of around $15. So important to watch on that front as well. Outlook for the year, what's the outlook on debt number? All of that is going to be important. Tata Steel, Tisco, will it do the disco or not, is what we'll be watching out for later today. Mangalam couldn't resist that. But when we talk about the stock that you're tracking, is it going to be smoking hot?
It may not be smoking hot this time around, but as Abneesh said, that perhaps a lot of the weakness is priced in because the stock is down 30% this year so far, trading at levels last seen in 2017, so near a 10-year low for that stock, and trades at 17 times FY28 price to earnings as well. What are the key expectations here? 8 to 10% decline in cigarette volumes. We've seen numbers coming in from Godfrey Phillips, VST. So the sector itself is obviously struggling because of the big spike that we saw in cigarette taxes. 8 to 10% decline in cigarette volumes, but the EBITDA out there, or the EBIT out there, would decline even further, 25 to 35%. And the only shining part will be the FMCG business, where the revenue growth is expected to be between 12 to 15%, with margin expansion to the tune of 100 to 150 basis points. Put all of this together, you are expecting an overall decline of 12% in the company's revenue, 17,362 crores. The EBITDA falls a little more. 21% decline is what we're expecting, a little shy of that 5,000 crore mark, which would imply that there would be a margin gash of nearly 500 basis points. And you have the net profit, which declines by about 19% as well, just shy of that 4,000 crore mark versus a number that was closer to 5,000 crore same time last year. Cigarette price hikes would impact volumes, but at the same time, the operating profit for cigarettes is projected to plunge because price hikes were insufficient to fully offset the tax increase and mix shifts as well. The other two segments of the company, they may be dark horses. Agri-business, we are expecting revenues to decline out there because of vessel shortages and, the West Asia issues. But paper boards, gradual recovery seen out there anywhere between 3 to 5%. So, numbers not much expected, but then again, not much is, priced in as well. The stock's down about 30%. Any positive surprise, the street may perhaps latch onto that. But with that, let's go across to Sudarshan. We've done Tisco, Disco, ITC, whether it's smoking hot or not. But Sudarshan, will Maruti be doing a vroom vroom?
The biggest four-wheeler company or the biggest auto company of India is going to report its earnings for Q1 FY27 tomorrow. And like all the other auto companies here too, revenue growth is expected to be healthy, backed by strong volume growth. But the important part in Maruti would be margin front. We'll have to see how much margin drag here comes, and also what will be the outlook for the FY27, especially in the passenger vehicle segment, because company is a market leader. Now talking about the headline numbers, profit might see a fall of 13%. Revenue may see an increase of 36%, and EBITDA can jump by 12%, but margin can see a drop to 9.8% versus 12% in the same quarter last year. Volumes here also were up 29% YY, but on a sequential basis, it was flat, up 1%. Realization may increase by 5% YY because of the price increase that company had taken, but on a sequential basis here too, we might see a drop of 1%. Now going forward, exactly what would be looking for, or especially in the commentary, what exactly would be focused. First, what does company talk about on the EV? Because as of now, company just have one electric vehicle, that is e-Vitara, and as of now, it has been mainly catering to the export market. So what's the plan over there? Second, what's the outlook for FY27 as far as the passenger vehicle is segment? Because recently, company had talked about 10% growth outlook for the industry, but overall earnings are expected to be strong, especially on the revenue front.
Got it. All right. Sud, thanks a lot for that. By the way, just keep an eye out on a couple of stocks in the broader markets. Z Entertainment, well, that stock has spiked up now. There's a camp that's extremely bullish on prospects and that this one will actually, give up the recent underperformance. So that stock, in fact, is suddenly spiking away. Sudeep Bandopadhyay, market expert, joins us. Sudeep, everything is good at a price. Has Z come to that price?
Well, this is one stock which I tend to avoid, Nigel. There has been lots of ups and downs. The investors have time and again lost money in this stock. Yes, valuation does look attractive, and it has been looking attractive for quite some time. There was a bump up when they took that World Cup telecast rights, and it has been continuing since then. But I think I will err on the side of caution as far as Z is concerned.
Already you'll be cautious on Z, that's the view. But, what about, I don't know whether you track this or not, SML Mahindra. Sudeep, ever since the news that came yesterday where Mahindra Group will divest their buses and trucks business into this company, 2 days of 2 consecutive upper circuits of 20%. The stock is up 42% this week so far. Have you tracked it?
Well, I did, Mangalam, and I think it's from a Mahindra perspective, it's a very good step. The commercial vehicle segment will be very focused, needs a focused handling, and that's exactly what they're doing. And this SML Mahindra will now compete with Ashok Leyland and Tata Motor commercial vehicles. Obviously, they are much smaller compared to these two behemoths. And we will have to track the performance. We'll have to see how they go ahead and handle the competition and establish themselves in this particular segment. So at this stage, to get excited by this corporate action would be probably inappropriate. And already, as you rightly said, the price has moved up last 2 days, continuously upper circuit. So definitely not worth touching the stock at this stage. But interesting development, and we would like to keep this company under watch for some time. Let's see how this performs. This is definitely positive for Mahindra and Mahindra.
Okay, all right. We've got Bajaj Finance that have come out with this set of numbers, and I don't know what to say about that. I think the net profit number could include some kind of a one-off.
Exceptional, seems
like
it.
I mean, that's what it looks like. We'll wait by for further clarity with regard to the asset quality. What is the growth outlook that you're looking at, and any kind of commentary that's going to be important for Bajaj Finance. For the time being, we just had the net profit number, but it appears it had an element of a one-off out there. Our ticker team will get that number back for our viewers on the screen. Remember, the stock is, well, it's seen a bit of a correction, then it's bounced back from the low, but it's still a distance away from the recent high. So Bajaj Finance is the number that we're looking at. Mangalam, do you have the expectations?
We do have the expectations, but more importantly, we had the cheat sheet as well, right? Bajaj Finance always gives the first quarter update where the AUM growth was about 24%. Deposits declined by about 5%. The customer franchise grew by about 16.8%. And the new loans booked went up by about 20%. Growth guidance actually moderated from the historical 25 to 30% to focus on asset quality. And brokerages, however, continued to remain bullish on the counter. So we'll try and get some more on that as well. And in terms of expectations, asset quality is expected to remain stable. Credit costs between 1.7 to 2%. Net profit growth expected between 23 to 26%. Obviously, so to that, we will monitor more. Or actually, there was no exceptional. If you look at the poll, the net profit is 5850 crores versus 4700 crores, rather 5986 crores versus 4700 crores year on year. The poll was a bit of a flashing mistake, I think. Our poll suggested a net profit of 5850 crores. So the net profit number should be compared with the poll of 5850 crores, and the number that has been reported is closer to 6,000 crores. So marginally better, largely in line with what the actual expectations were versus what was inadvertently flashed. So we apologize for that flash error. But if you look at the reported net profit, 5850 crores was the poll. The number is 5986 crores.
Okay, all right, Sudeep, that's probably the only number that we have right now. But what is your view, results aside, at around 1,000 rupees, 1,050 rupees, your view on Bajaj Finance?
Well, it's definitely a good stock from a long-term perspective. It was never cheap, and it will not be cheap But if I have to pick up one NBFC, probably I'll go for Shriram at this stage. I think the valuation-wise and growth potential-wise and the amount of money they have raised in the recent past gives me a little more comfort in Shriram at this stage.
All right, so you are you prefer Shriram to Bajaj Finance. What about the jewelry space? Titan's been doing extremely well, but we saw a big surge in Kalyan. Now, last 2 days have not been very good for Thangamayil. Thangamayil actually has been one of the best performers this year so far, not only across jewelry space but generally as well, up 200% despite a 20% correction that we've seen in the last 2 trading sessions. If you look at the current stock is down low. 2 days of lower circuit. The management commentary with regards to quarter-on-quarter momentum has been slightly soft. Do you think this dip is an opportunity to buy, hoping for recovery in the second half, or maybe stay away?
Mangalam, I normally advise staying away from these regional players. This is exactly the reason why I tell them, because the volatility is too much. It's very difficult to predict on a long-term basis their performance way forward. So whether it's a Thangamayil, whether it's PN Gadgil, whether it's some of the other smaller players, including Senco, I always have been, for many years now, been liking Titan. If you want to be in jewelry, be in Titan, definitely. Even at this price, buy for long term. I also have been liking Kalyan for a considerable period of time since listing, in fact. And I still believe that the correction we saw after both Titan and Kalyan declared or announced their business updates was unfortunate, and Kalyan picked up from the next day itself, and it's still on an upward momentum, and it deserves that. Their franchise-led expansion model is very good from a balance sheet point of view. Their expansion into North India as well as West Asia is margin accretive. Also, overall, the business has been doing good. And Candier brand expansion will determine the future as far as Kalyan is concerned. So if I have to pick something else other than Titan, I will go for Kalyan, not for Thangamayil, PN Gadgil or Senco.
All right, take that point. Just as we speak, the markets move to the high point of trade right now. 89 points on the Nifty. Sensex up by nearly 300 points. Remember, it's a Thursday, also the day of Sensex expiry, so there could be some moves out there. The Nifty Bank has now moved into the green. SBI is the one which is leading it higher right now. The Nifty well above the 24,300 mark as well. Take a short break, come back, getting more on the markets on the other side. The market zooming ahead right now. Coal India is the one which is spiked as well. And, moments ago, we did get the numbers from Vedanta Aluminum. At that point, the stock was just marginally higher. Now, as we speak, it's seen incremental gains. That stock's up 4% right now. And alongside that, we've seen some additional gains coming in on Exide as well, which has moved to the high point of trade. So along, all the lines, Nigel, we are seeing decent gains come by. And Z, that you spoke about, continues to gain some traction. Hyundai Motors, the auto pack is doing well. Hyundai was saying, I wasn't participating up until now, but going home with big gains at the high point of trade for that one as well. Look at that.
I don't know whether Sudarshan is going to be joining in and giving us a quick analysis on this one, but for the time being, a stock that had, the IPO I think was 1,700-1,800 rupees. It danced all the way to around 2,500, 2,600, and then it saw a correction. For the time being, no growth in terms of revenues. But I'll tell you what the street likes, I think, is on the operational performance. So actually, that as well is a little bit subdued. So we'll have to see on a sequential basis whether or not there is some improvement. For the time being, a bit of a pop-up. Profitability as well is down by close to 30%. I'm not sure whether or not we had the poll. If that's the case, we should actually get that number up for you. For the time being, the stock is going a little bit higher. Margins have come in at around 9.3%. In the previous quarter, it was at around 10% or thereabouts. So margins actually have been maintained out there. We'll wait by further analysis, but for the time being, stock goes on with a gain of around 2%. But let's wind down the markets for you. Well, we go on with a gain of around 50 points. Well, not bad at the kind of global environment we woke up to. Mahindra & Mahindra, that reported set of numbers, the street liked, the stock goes up 2%. Coal India posted its numbers, that stock did see some selling. It's popped up in trade today. And Eicher Motors, kick-starting the vehicle, the thump is thumping along. Royal Enfield continues to ride strong. Valuations could be an argument, but that one, in fact, is adding capacity, going to around 4.5 million units in the next 4 years or so. And also the international revenues at around 1,000 crores in a single quarter. That's the first time ever. On the flip side, Adani Ports came in for selling. The street is worried. Are they going to be biting a very large inorganic growth, which could be larger than their size? That's the problem. That's weighing on sentiment, it seems. We'll have to wait by to see whether or not there is any truth in that report. But for the time being, the stock goes on with a cut of around 3%. HDFC Life as well, profit taking. That one was down by close to around 2%. From the broader market, stocks did a thing of their own. Sona, BLW, Precision, flying away, up 6%. TVS Motors, revving up the engine. Godfrey Phillips, smoking is injurious to health. The stock saw a big correction earlier this week, and today it was up and about in trade. The other stocks that were losing, KPIT Technologies after the big rally yesterday, it saw selling. Prestige Estates as well, that was under pressure today. And Vari Energies as well went home with a cut of close to around 5%. Net, it was the day for the big boys, going home with a gain of around 50 points. Not too bad, one would have to say. On that note, though, we'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting for you on the other side.
The last trade ends the day, makes the Nifty close above the 24,300 mark. Auto stocks lead the up move. Broader markets underperform.
M&M meets estimates in Q1. Revenue rises 23% even as margins contract sharply. Automobile business continues to gain market share with volumes rising 21%.
Bajaj Finance misses estimates in the first quarter despite reporting strong growth. Profits rise more than 10% and net interest income up 7%. Asset quality remains stable.
Hello, good evening. You've tuned into CNBC TV 18. You're watching Markets Forward with me, Vinny Motiwala. Along with me is my colleague Mangalam Malu as well. And this is a show where we will take you through all the key data points to gear up for tomorrow's trading session. So stay tuned in for that. In terms of markets today, we managed to close at 24,296, almost near the day's highest point for the Nifty. Broader end of the market was not that exciting. IT continued to see a bit more of an up move as well, though came off from the day's highest point for the Nifty IT. But Mangalam, a day where we at least saw good gains coming in for the Nifty 50.
Yep, a day where we actually got away with a lot more, because it could have been a lot worse. When we started trade, oil was upwards of 90, and even when we ended trade, oil held around that $91 per barrel mark. This compares with about $87 that we saw yesterday. Geopolitical uncertainty and the kind of weakness that we've seen in the Asian markets, the volatility that we've seen out there, told you that maybe there could be a bigger gash coming. But that wasn't the case to be. In fact, we went ahead and did an outperformance, and there was great transition of power that took place between the banking index as well as the IT stocks. So if you look at the IT pack, that did well in the first half of trade, and towards the end petered away. So we saw that end lower at the low point of trade, whereas the banking index actually on the other side was muted for most part of the trading session and towards the end picked higher. And as a result of which, the Nifty was relatively unscathed. And then we got the additional support that came in from both Reliance as well as the Auto Pack. Reliance was the top individual stock contributor on the frontline index. But we have a lot for you on the show today. Let's give you the lineup. Over the next 30 minutes, we bring you the top movers and shakers. Vivek Iyer joins in with that. Next to the big wall and all those important stocks that were buzzing around. We also get you details coming in from M&M, largely in line set of numbers, but the stock did well today. Reddington, Hexaware's earnings, all of them, they were stocks that moved on either side today on the back of numbers. Exide was also one of them. And then, before we wrap up, we will get you the key market events to watch out for ahead of tomorrow's trading session. But with that, let's go across to Vivek for this special link on all the big movers and shakers of the day. Vivek.
Well, thank you so much for that. What a session we had, quite topsy-turvy, and some positivity seen, especially in the latter half of the trading session. In terms of individual stocks and sectors, you can't look beyond what essentially was a day where you saw all of the auto stocks do very well ahead of its results. Maruti up almost 2%, TVS Motors continued its up move, Hero MotoCorp ahead of its results up 3%, so that did quite well. In terms of individual stocks, Reddington, very, very strong set of numbers coming in for that particular company, up over 8% on very good volumes. The entire IT pack, the rally over there continued, and when you're looking at names like Wipro, Coforge, all of these stocks continue to move higher in the session today. Balkrishna Industries, one name from the auto ancillary space, tire company doing very well, 10% higher on very strong volumes. And standalone refiners, given the fact that you're actually seeing a bit of a bump up, especially as far as crude oil prices are concerned, both MRPL and Chennai Petro managed to end the day with significant gains. On the other hand, quite a few laggards as well. Can't look beyond Wari Energies, very weak EBITDA margins in Q1 is something that the street didn't like, down over 4%. KPIT Tech immediately post the results yesterday, saw a sharp rally. That entire rally fizzled out yesterday. In fact, closed below where we started off trade yesterday morning as well. Eris Life Sciences, export guidance was cut by the management. Street didn't like that, down over 3.5%. Syngene, again, consecutive quarters of missing earnings expectations is something that the street didn't like. Guidance of degrowth for FY27. And lastly, one name from the realty name pack that saw significant selling pressure today, Prestige Estates, one of the top drags in the F&O space.
Okay, Vivek, thank you so much for taking us through the list of the stocks that were in focus today, moving around in the trading session. But let's move on and talk about M&M. That reported its numbers as well. The stock was gaining almost 2% after the numbers came out. It closed slightly a smidge below the 2% mark as well. Largely, numbers were in line with expectations. But for more details on this one, let's go across to Sudarshan. He's here to take us through that. Sudarshan?
So headline numbers were largely in line with estimate, but what led to the stock price move higher was the core internals, and those looked very strong as far as Mahindra & Mahindra's Q1 FY27 is concerned. So just talk about headline numbers. First profit has seen an increase of 7%, revenue jumped 23%, EBITDA has seen a jump of 5%, and margin, as expected, seen a fall. It has come at 12.3% versus 14.3% in the same quarter last year. Why I'm saying that internals were looking very strong? Because company continues to gain market share. You talk about SUV market share is increased by 50 basis points on a sequential basis. LCV market share is increased by more than 150 basis points. If you talk about the tractor segment, company continues to be the market leader with market share of almost 45%. Volume front, both tractor and auto segments have seen a double-digit growth of more than 20% YOY, and realization too has seen an increase of more than 1% for auto, and for tractor segment it was up by 1.5%. Now what does company say? Going forward for the tractor outlook, company had already given the industry outlook of mid-single-digit growth, and it believes that it will be able to maintain that growth outlook of mid-single-digit despite some negative reports about the monsoon. Company is saying that it will be maintained, and as far as the auto segment is concerned, company continues to see a healthy growth. So on the back of inline set of numbers, strong internals, we have seen an increase in the stock price.
Strong internals keeping the stock chirped up in trade. Sudarshan, thank you so much for that. But let's take the conversation forward. And we have our experts joining us today. We have Sudeep Bandyopadhyay of Indie Trade Capital, as well as Richard Jain from Motilal Oswal Financial Services to take this conversation forward. Thank you, gentlemen, for joining us on the show, as always. Richard, today, obviously, we did see a day where we saw that recovery coming in the market as well. Given the geopolitical tensions, the cues that we had this morning, is still managing to close around the 24,300 mark, right? What are the levels that we should keep an eye out on now? And obviously, we just have we are at the beginning of the August series as well. So what are you watching out for?
Yeah, very good afternoon, very good afternoon to everyone. Well, since it's been almost 3 months where we have seen that the markets on the index front is still going through that consolidation phase. If you look at historical data, then at the end of April, we were around 24,300. And today also we have closed right around 24,300 marks. So nothing in terms of directional move have been seen in last 3 months. Now the breakout of this entire consolidation is placed about 24,500, because last 2 or 3 occasions, whenever the index has come near that 24,400 to 500 range, it has faced selling pressure over there. And also the 200 DMA for the Nifty is placed in that zone itself. I think 24,400, 500 would be very crucial to watch out in this August series. In case the market manages to surpass those levels, then we could see a good trended phase on the positive side. But for now, 24,400 is the resistance that we'll be watching out for, and 24,000 to 23,900 would be the immediate support range.
Okay, we'll keep an eye out on those levels over there for the markets. But let's talk about a couple of other names that were in focus today. One was Redington. Now, they came out with their numbers late last night. What the numbers looked like: record revenue, record profit, record growth in terms of revenue and profit as well. Margin expansion of 50 basis points, improving capital efficiency, working capital days improved as well. That is the betterment what came in. Now, overall, when you look at it, the revenues of the company saw 35% growth. Margins came in at 2% versus 1.54% as well. CISA, that is the Singapore India side of the business as well. That's seen a very good growth, 63% YOY growth. In that, all the segments, that's mobility, technology, as well as software and PC and end-to-end point, or PC is what they call it. Those segments saw a very, very strong growth. So that was supporting it. Like I mentioned, working capital days, that started seeing an improvement as well. That came in at 32 days versus 37 days previously. There was a shift in the mix more towards the software side of the business as well. And that is better in terms of margins. And that is why we're expecting to see improvement in terms of margins. So obviously, these were the main reasons today why Redington was in focus and was up and away in the trading session. Now, another stock, related to the IT side as well is Hexaware. This one, numbers were in line, but what came in as a miss was that guidance. The company cut its calendar year 26 guidance, and the guidance cut is coming mainly for revenue. Range they've given of 6 to 7% revenue guidance for the full year of calendar 26 versus previous guidance of 7.6% YOY was the expectation. Mainly deal ramp-ups, that doesn't look too exciting, and macros are worsening, so that is why they cut the guidance. EBIT margin guidance they maintained in the range of 13 to 14%. So that is why that was one of the stocks, Mangalam, that saw a fall in the trading session today. 2 stocks there in focus today.
Yep, and post-close, we also got earnings coming in from Swiggy, and they look slightly muted as compared to street expectations. And to that extent, that stock will be extremely important in tomorrow's trading session. And that's largely because the stock had seen a big rally going into the numbers, ended at the high point of trade. And prior to that as well, we saw a 7% up move in yesterday's trading session. 17%, 17.5% food delivery GOV with margin compressing is a mild miss on street expectations. But the bigger miss would be on quick commerce, where the company had promised contribution break-even in the first quarter. That hasn't happened. There's still losses have narrowed, but contribution is still negative at minus 0.02%. So that stock extremely crucial to track. Sudeep, Swiggy, what are your thoughts on that one?
Well, I will be positive, Mangalam. I think, first quarter, they had expected that they will become an Indian-owned, Indian-managed company, and thereby will be able to hold inventory in their books, which would have increased their margins significantly. But unfortunately, it didn't happen. It only happened toward, just few weeks back. And so the second quarter, I'm looking at the possibility of their margins going up on the Instamart side. And I think things should start looking up. So tomorrow, of course, the market probably will correct to some extent. And that may be an opportunity to pick up Swiggy for the improvement, which I'm expecting in the Q2.
Okay, that's the word coming in on Swiggy from Sudeep. But let's talk about a couple of other names that came out with their numbers. That is Bajaj Finance, met with estimates in Q1, reporting strong growth, stable asset quality. What more are the internals? What more are the details for this one? Obviously, we saw a spike up coming in the stock once the numbers were reported and then came back down. So let's get the details for this one. Ananya is here to take us through all of that. Ananya, over to you.
Well, yes, for Bajaj Finance, the numbers were largely in line. If you see, the NII was up 23% year on year, but came in around 4% below the street estimates. However, PPOP rose 22% and PAT increased 27% to 5,980 crores, both beating the estimates here. So profitability remains strong here. Now, if you talk about the business momentum, it remained robust with AUM growing 24%, new loans booked rising 20%, and customer franchise expanding 17%. Asset quality was very strong. It improves in a seasonally weak quarter, so that is a key noticeable point here. GNPA declining to 0.96% and NPA 2.39%. So overall, if you look, it was a good quarter when it comes to the core profitability. But Street was expecting more from Bajaj Finance.
Okay, Street was maybe expecting a bit more from Bajaj Finance. Thanks so much for that, Ananya. But a whole host of other companies also came out with their numbers. Let's go close to Sonal to list down those companies for us as well. Sonal.
Let me start with Mahanagar Gas, which reported a good set. The stock came up from the highs of the day, but if you look at the sequential recovery, that was strong despite the West Asia crisis. Revenues up 15.5%. There was an EBITDA growth of 32%. Margins also improved to levels of 14.5%, and profits were up 49% as well. At a time, there were gas curbs, high gas costs. Company has been able to improve margins. Additionally, the volumes have been flat on a quarter-on-quarter basis, but they are up 2% on a YY basis. And if we talk about the stock performance as well, absolutely flat year to date because of ongoing issues. This week itself, the stock saw gains of around 4 to 5%. For Exide, again, it was a healthy quarter one. All segments saw double-digit growth. Their revenues were up 18%. Their EBITDA was up 15.5%. The net profits also increased 28% on a YY basis. So good going for Exide as well. If we talk about Ajanta Pharma, a sharp uptick in terms of their revenue growth, which saw 25% uptick on a YY basis. Their profits were up 31%. EBITDA growth of around 21%, and margins came in at 26.1%. The company also declared first interim dividend of around 32 rupees per share for FY27, and they also filed tax return post the surge. There's no impact which is ascertainable right now, but the stock reacted positively to the earnings that the company reported.
Sonal, thank you so much for that. A whole host of other stocks also in focus. A quick one from you, Ruchit, in terms of Bajaj Finance. What are you keeping an eye out in terms of levels? Street seems like was expecting more. But in terms of the technicals, anything that we could watch out for?
The stock has recently seen a decent up move from the lows of around 860 in the mid of June. 1.5 months, the stock has rallied from 860 to 1060. So the good thing is that the declines that we are getting, the stock is not going below its 50-day EMA, which is acting as a crucial support, which is now placed around 1,000 rupees. So 1,000 would be the crucial support to watch out for. Till that is intact, the near-term trend remains to be positive, and what the reaction comes tomorrow would be important. But no, I would say in case if anyone has long positions, they should continue to hold on, keeping a stop loss below 1,000 rupees.
All right, take that point. Thanks a lot, gentlemen, for joining in and giving us your views on a whole host of stocks and sectors. Look forward to speaking to you all later as well. With that, we take a short break, come back, get you the top corporate voices along with the key market events to watch out for tomorrow. Stay with us. Welcome back. You're watching us here on Markets Forward. Let's talk about Asian Paints. That saw cuts over 1% despite a strong set of numbers in the first quarter. Speaking to CNBC TV18, the company said that demand remained resilient in the first quarter with broad-based growth led by healthy rural and B2B demand. Management expects volume growth of 8 to 10% in FY27, says value growth is likely to outpace volumes aided by recent price hikes. They also maintain their margin guidance of 18 to 20% while adding that they gained market share during the quarter despite intensive competitive discounting.
I think the overall volumes is something which would really matter in terms of how we are able to grow, because some of the value will get kind of really vitiated from a point of view of what price increases, and there could be price decreases which could kind of take in the second half depending on how the volatility of the raw materials and the inflationary environment is going to that extent. So I think what is really good to watch out is that if we look at the volume growth, I think that should be, in the range of about 8 to 10%, as we have said, and therefore the consequent margins, I think the guidance of 18 to 20% should hold.
MTAR Tech was locked in upper circuit after it posted a strong set of numbers in Q1 FY27. And speaking to CNBC TV18, the management said that its clean energy business continues to gather momentum, with the company receiving a significant share of new orders from this segment. The management says that its order pipeline remains strong and has dismissed concerns around Bloom Energy's data center related orders. The company expects to outperform its current guidance, with second half of the year expected to be stronger than the first half.
Stock of Indo-MIM listed at a heady premium of 44% to its IPO offer price of 485 rupees. The public issue of the shares of global metal injection molding leader was subscribed by 72 times. Speaking to CNBC TV18, the company's whole-time director and CEO Krishna Chivukala said that they expect 10 to 15% growth over the next 5 years.
We'll be in line with what we posted in the DRHP. I think in terms of, where the growth is going to come from, I think I'd rather focus on what our strategies are, because that's really what's gotten us where we are today. And I think that's going to be what propels us and continues to drive growth in the company going forward. And I think for for us as a group, it continues to be aerospace, whether it's machining, metal injection molding, defense, land-based gas turbines, medical components. All of these areas have strong tailwinds in the market. When you talk about land-based gas turbines and jet engines, I mean, you're talking about a segment that collectively is easily somewhere in the $50 to $60 billion range. With a 5-year, yes. I mean, we believe 10 to 15% growth is what we're going to be doing. We try to be a little bit conservative. The exact operating margins are going to be depending on what type of business we bring in, and that's something that's a little bit difficult to forecast. But we think that what we're doing right now should be in line with what we're doing over the 5-year.
That were the top corporate voices for today. But before we wrap up this edition of Markets Forward, let's go across to Upasna, who's here to list out all the key events to watch out for in tomorrow's trading session. Upasna, over to you.
Well, first up, let us look at some of the important results that are scheduled for tomorrow for the likes of ITC, IOC, Maruti Suzuki, Sun Pharma, ABB, even Aditya Birla Capital, Dixon Tech, Glenmark Pharma. All these counters will be reporting their Q1 FY27 numbers tomorrow. Now, on the IPO front, Manipal Health closes for subscription, and also mind you that the Union Cabinet meet is scheduled for tomorrow at 1 p.m. So we'll be watching out for all the key updates out there as well. And also Parliament monsoon session also continues till the end of August is what we know. So certainly updates on that front also will be important to watch out for. Now let us look at some of the global economic cues. Bank of Japan interest rate decision will be out tomorrow, and also the CPI data for the month of July on a Y&Y basis is something we'll be closely tracking. Europe core CPI data will be out for the month of July. And coming back home, that is in India, federal fiscal deficit for the month of June, foreign exchange reserves, RBI monetary and credit information review will also take place. So all in all, looks like quite an eventful day tomorrow.
Indeed, quite an eventful day tomorrow. We will monitor that. More importantly, it is a Friday. Thanks a lot for that. With that, we'll wrap up on this edition of Markets Forward. Thank you for watching. Don't go anywhere because we'll be back with more news and updates on the other side. Stay tuned to CNBC TV 18.
Hello and welcome to Business 360. I'm Arundhati Ramanan and here are the headlines that we're tracking for you this evening. US launches fresh strikes on Iran amid fears the war is widening. Iran says 3 civilians, including a 2-year-old, killed in US attacks. Suspected Iranian drones target 2 ships in a port in Egypt. 1 worker killed in Kuwait. Brent crude prices remain above $90 per barrel. U.S. Treasury sell-off continues after a divided Federal Reserve leaves interest rates unchanged. The yield on the 30-year U.S. bond hits the highest level since 2007. Sensex and Nifty end the day in the green after a volatile session on Dalal Street's mid-cap index suffers sharp cuts. Rupee is on a tight leash against the dollar. M&M meets estimates in Q1. Revenue rises 23%, even as margins contract sharply. Automobile business continues to gain market share, with volumes rising 21%. Microsoft shares rally after quarterly profits cross $35 billion. Annual revenue from cloud business hits $100 billion for the first time. Shares of Facebook's parent Meta slides as disappointing growth outlook and dwindling free cash flow worries investors.
If you truly want to go out and yank that economic wealth that has been over the years taken by others, you'll need to back some winners.
Indigo MD Rahul Bhatia tells CNBC TV 18 India needs a few big carriers if India wants to compete with global airline behemoths. Adds that backing some winners and allowing them to grow is the need of the hour. Supreme Court agrees to examine the use of pellet guns for crowd control after multiple people were injured during the Delhi police crackdown on student protests. Court directs the Rapid Action Force to preserve records of the ammunition used but stop short of issuing a blanket ban on the use of pellet guns. Parliament likely to debate the Foreign Contribution Amendment Bill this monsoon session. The new bill introduces stringent compliance requirements for NGOs and associations receiving foreign funding in India. Also allows a designated authority to take custody of assets in case an organization ceases to have an FCRA certificate. Critics argue the bill is aimed at silencing voices critical of the government. The death toll due to flooding in Assam rises to 78. More than 3 lakh people remain affected across 7 districts. 21,000 hectares of crop damaged as the state faces its worst flooding in years. Neeraj Chopra qualifies for the javelin finals along with 2 other Indians at the Commonwealth Games. India currently stands at 8th position in the medals tally with 3 gold medals. The top story this evening, the U.S. renews strikes on Iran in what it has called a response to Tehran's attacks on U.S. air bases across the Gulf. Here are the latest developments. The U.S. military has said the targets struck were linked to the Iranian Revolutionary Guards, including command centers and coastal surveillance sites. The strikes come just hours after U.S. President Donald Trump said that Washington will hit Iran hard. According to Iranian state media, parts of cities in the Bushehr province as well as the Qasem Island were struck with U.S. attacks. Search and rescue operations are underway, clearing rubble in residential building in the Qasem Island. However, no casualties have been reported so far. Escalation has also spread to countries like Egypt. According to Egyptian government, a drone strike triggered fires on 2 ships in one of the country's ports. British maritime security firm Ambre has said that one of the targeted ships was a US-owned floating storage tanker. This as Iran continues to launch strikes across Gulf nations. The Jordanian military said it intercepted 5 Iranian missiles successfully. However, Kuwait alleged that an Iranian attack struck a building related to a Chinese company, which killed 1 worker. The IRGC has also said that it will carry out further attacks in retaliation to U.S. strikes. In the oil market, Brent crude prices surged above the $90 per barrel mark. The rising crude prices have helped British energy major Shell report a strong set of numbers in the second quarter, with profits smashing street estimates. This has marked Shell's best quarterly results since the second quarter of 2022, when oil and gas prices surged in the wake of Russia's full-scale invasion of Ukraine.
I've been briefed. It's a little more of the same. but it's going to be straightening out. It's going to be straightening out. In the meantime, we're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but they tried shooting it last night. So we had 5 rocket shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement at some point, but we're going to hit them very hard.
Russian forces killed at least 14 people in a fresh wave of strikes across Ukraine. Children were among the victims in the attacks that stretched from Kiev to Lviv. Ukrainian officials said that Russia used ballistic missiles. The barrage came just a day after Ukrainian President Zelensky warned that Moscow was preparing a massive assault. This comes as Ukrainian forces hit 2 of Russia's biggest oil refineries overnight in its latest long-range strikes. On to the day's market action. Sensex and Nifty ended in the green after a volatile session. Benchmarks outperformed the mid-caps. Nifty ended above the 24,300 mark, led higher by the auto and IT pack, along with Reliance. Nifty Bank fell nearly 60 points, but bank stocks recovered from lows, with HDFC Bank and SBI closing in the green. U.S. Treasury sell-off continued after a divided Federal Reserve leaves interest rates unchanged. The yield on the 30-year U.S. bond hit the highest level since 2007. The U.S. Federal Reserve's decision to hold rates steady were not unanimous. The FOMC committee voted 9-3 to leave federal bond funds rate in a range of 3.5% to 3.75%. This marks the first time since 2016 that 3 members have dissented and were in favor of a rate hike. Addressing a press conference, Fed Chair Kevin Walsh described the policy deliberations as a real family fight.
The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight.
And back home in key earnings, M&M has met estimates in the first quarter. Revenue rose 23%, even as margins contracted sharply. Sudarshan Kumar is here to decode those numbers for us. Sudarshan?
So headline numbers were largely in line with estimate, but what led to the stock price move higher was the core internals, and those looked very strong as far as Mahindra & Mahindra's Q1 FY27 is concerned. So just talk about headline numbers. First profit has seen an increase of 7%, revenue jumped 23%, EBITDA has seen a jump of 5%, and margin, as expected, seen a fall. It has come at 12.3% versus 14.3% in the same quarter last year. Why I'm saying that internals were looking very strong? Because company continues to gain market share. You talk about SUV market share has increased by 50 basis points on a sequential basis. LCV market share has increased by more than 150 basis points. If you talk about the tractor segment, company continues to be the market leader with market share of almost 45%. Volume front, both tractor and auto segments have seen a double-digit growth of more than 20% YOY, and realization too has seen an increase of more than 1% for auto, and for tractor segment it was up by 1.5%. Now what does company say? Going forward for the tractor outlook, company had already given the industry outlook of mid-single-digit growth, and it believes that it will be able to maintain that growth outlook of mid-single-digit despite some negative reports about the monsoon. Company is saying that it will be maintained, and as far as the auto segment is concerned, company continues to see a healthy growth. So on the back of inline set of numbers, strong internals, we have seen an increase in the stock price.
All right, Sudarshan, many thanks for those details. And from one auto company to another, Hyundai Motor India has reported a weak set of numbers in the first quarter. Profits slumped 35% to 890 crore rupees, while revenue from operations remained largely flat. EBITDA fell 31%, while margins contracted 400 basis points on an annual basis. Bajaj Finance met estimates in the first quarter. Net interest income rose 23% compared to the same quarter last year, but this was slightly below what a CNBC TV18 poll was expecting. Profits rose 27% and asset quality remained stable. Commerce Minister Piyush Goyal says a trade deal with the U.S. will be signed as soon as India gets a competitive advantage. The U.S. Senate has recently advanced a bill to impose 100% tariffs on Russia's trading partners, including India and China. When asked about it, Goyal said he would not comment on speculation.
As soon as the United States is able to ensure that we get a comparative advantage over our competitors, the countries in our neighborhood, the countries in the ASEAN region and other countries with whom we compete. That was the basis of our first tranche of the BTA. And once that basis is re-established, the US BTA will be ready up and above. They have imposed some tariffs under one investigation. Others are under discussion.
The government mounted its defense of ethanol-blended petrol in the parliament. In a written response, Road Transport Minister Gadkari said that without domestically produced ethanol, petrol prices would have spiked up to 125 rupees when the West Asia war was at its peak. Gadkari said that India reduced its exposure to international crude oil price volatility by replacing a part of the imported petrol with ethanol. That's not all. Gadkari also said that 20 crore two-wheelers and over 3 crore petrol cars have been operating on E15 Plus and E20 petrol for over 2.5 years without any verified evidence of widespread engine failure or vehicle breakdown attributable to ethanol blending. Food delivery platform Swiggy's first quarter numbers came in softer than what the street estimated. Net loss narrowed while revenue grew over 37% on an annual basis. The company's food delivery business rose over 17%, while its quick commerce business jumped nearly 40%. However, both verticals missed estimates. And speaking of Swiggy, the Bangalore Hotels Association has warned that hotels and restaurants will stop accepting orders from Swiggy and Zomato after the 15th of August if the food delivery aggregators do not address certain concerns. Some of these include commissions, platform-funded discounting, and other charges imposed. Restaurant owners argue that steep commissions and discounts have hurt their margins and forcing them to raise prices on the app. The Supreme Court has agreed to hear MCX's plea to revive proceedings over compensation claims of 2,500 crore rupees against NSE. The Apex Court will hear the matter on MCX-SX plea on August 18th. MCX is claiming compensation over NSE's alleged abuse of market dominance through zero pricing in currency derivatives segment. SC had directed for a stay on the proceedings in 2018. Microsoft shares rallied after quarterly profits crossed $35 billion. Annual revenue from cloud business hit $100 billion for the first time. Shares of Facebook's parent Meta slid as disappointing growth outlook and dwindling free cash flow worried investors. Rachna Dhanrajani has more details on this. Rachna, what's boosted Microsoft's quarterly performance?
Well, 3 earnings reports and 1 question. Who's making money off the AI build-out? Well, Microsoft answered it best. Azure annual revenue crossed $100 billion for the first time, up 41%, putting it behind only Amazon Web Services and ahead of Google Cloud. Q4 revenue was $90 billion, up 18% against $87.6 billion expected. Adjusted EPS at $4.74. Copilot paid seats crossed 30 million mark, and the quarter carried a $3.2 billion gain on Microsoft's Anthropic stake. Critically, CapEx came in at $41 billion, below the $42 billion that the street was anticipating. And Microsoft has now guided to 45% Azure growth this quarter, above consensus. Spending less than feared while growing faster than expected. That is what brought Microsoft above. But Meta is on the other side of that trade. Q2 EPS missed, Q3 guidance came in light, and revenue rose 28% to $60.8 billion, but costs jumped 55% and operating margin fell to 31% from 43%. The number that moved the stock, however, was free cash flow, down to just $784 million against an average of roughly $12 billion over the previous 8 quarters. CapEx of $31.1 billion almost entirely consumed operating cash flow of $31.9 billion. The capex floor for the year was raised to $130 to $145 billion. Then the share slid nearly 10% in extended trade. But Samsung sits on the receiving end of all of it. Q2 operating profit jumped 19 times to a record 89.5 trillion won, roughly $62 billion. Revenue is up 130%. The chip division drove it. Memory is at an all-time high, while mobile fell, and Samsung expects the memory market to stay undersupplied through H2 on continued AI infrastructure spending. With Alphabet alone lifting full-year capex guidance to between $195 to $205 billion last week that we saw, that call by Samsung looks well supported for now.
All right, Rachna, many thanks for taking us through that wrap of all the global tech earnings. And staying with tech, OpenAI's agent that went rogue last week has also compromised a customer at another tech company. As per Reuters, OpenAI's rogue agent broke into New York-based Modal Labs and exploited vulnerable code written by a customer that was hosted on the firm's platform. Modal executives emphasized that the company itself was not hacked. OpenAI said the rogue agent broke into 4 accounts across 4 separate services. It added that it deactivated, encrypted, and restricted the tested AI model from research access. The big interview of the day, Indigo promoter and managing director Rahul Bhatia feels that as India eyes on becoming the world's 3rd largest aviation market, it needs to back a few winners. In a rare interview with Shireen Bhan as the airline clocks 20 years, Bhatia said India needs a few big carriers if it truly wants to compete with global airlines. Bhatia also spoke on the ATF Stabilization Fund, which did not find takers despite a lot of back and forth between airlines and the government. Here's a slice of that conversation.
We all understand that the India opportunity is large, but what we don't understand is how large is the opportunity. We just don't know. All we have to do is make sure that we have cost leadership by which we can, put out affordable fares to consumers, bring up demand, fill up planes, and just keep going, keep that flywheel going. I think Willie has said this already. All I know is that when you look at international markets, it's actually preposterous that we have only 50 long-haul planes in India for a country of our size. So I think there's great opportunity. This is our view, and I say this with utmost humility. What is Emirates' market share in Dubai? What is Qatar's market share in Qatar? In Doha? What is Lufthansa's market share in Frankfurt? What is BA's market share at Heathrow? And the list goes on. And the reason I bring this up is that if India, this is not Indigo, if India truly wants to compete with carriers in their home markets who are of the size of some of the ones I've named, or Singapore Airlines in Singapore, India needs a few big carriers. Otherwise, you'll never, ever be able to compete. So, we have to take into context that this, of course, we can have 10 airlines in India, 20 airlines in India. But to be able to, this is not about competing in India. I think this journey is about India competing with the world. And if you really want to take them on, you will need to have 1 or 2 or 3 winners who will actually just do what they have to do. And you have to allow them to grow. And because if you truly want to be, we talk about India being sort of the 3rd largest aviation market by a certain year. If you truly want to go out and yank that economic wealth that has been over the years taken by others, you'll need to back some winners.
And you can catch that entire conversation at 5:30 p.m. and 7:30 p.m. only on CNBC TV 18. On that note, it's time for a short break, but coming up next, Supreme Court agrees to examine the use of pellet guns for crowd control after multiple people were injured during the Delhi police crackdown on student protests. That and more when we come back. Stay tuned. The Supreme Court has agreed to examine the use of pellet guns for crowd control. This comes after multiple people were injured during the police crackdown on student protests in Delhi. The court directed the Rapid Action Force to preserve records of the ammunition used, but stopped short of issuing a blanket ban on the use of pellet guns. Senior lawyer Vrinda Grover, who appeared for the petitioner, said the government must place the standing order which authorized the use of those guns in Delhi.
On a peaceful assembly of this kind, where people are exercising the right to protest, which the court has now repeatedly said that yes, all citizens have a right to protest when they are dissatisfied, it is for the union or the NCT to place on record before the court which is the regulation, which is the standing order, if any, on the basis of which pellet guns were used.
And in Parliament action, the Rajya Sabha took up the government's new bill proposing stricter punishment for exam frauds. The bill was passed by the Lok Sabha yesterday. Leader of opposition in the upper house, Mallikarjun Kharge, demanded a statement from Home Minister Amit Shah on the police crackdown on student protests in Delhi. Kharge alleged RSS functionaries have taken several posts across education institutions and demanded their removal. This sparked a ruckus in Parliament. Meanwhile, opposition parties continue to protest inside and outside Parliament, demanding action over the police crackdown in Jantar Mantar. Samajwadi Party leaders also protested over the theft of donations at the Ram Temple in Ayodhya. The Parliament is likely to debate the Foreign Contribution Amendment Bill this monsoon session. The new bill introduces stringent compliance requirements for NGOs and associations receiving foreign funding in India. That's not all. It also allows taking control of assets created using foreign contributions if an organization's registration ceases, whether due to cancellation, surrender or non-renewal. Ashmit Kumar decodes the new bill.
Well, the FCRA amendment bill is pending before the Parliament. It is looking to tighten the FCRA regime with respect to NGOs, with respect to their assets. So what are the key changes being proposed? Well, here's number one. Earlier, a certificate, an FCRA certificate, would cease to exist only if it was cancelled or surrendered. Now, under the proposed amendment, it can also lapse if the NGO in question does not apply for renewal in time or if the renewal application is cancelled by the government. That's change number one. Change number two is that earlier, the government was authorized to take over assets of an NGO only if the FCRA certificate was either cancelled or surrendered. Now, with this latest provision of not applying for renewal in time or the renewal being rejected, that is the third situation where now the government will be authorized to take over assets of the NGO in question. Change number three. Earlier, there was no designated authority for taking over of assets. Now, a very clearly defined designated authority has been provided in the proposed bill for taking over of these assets in case of lapsing of the FCRA certificate. Change number four. Earlier, only assets that were fully funded by foreign funds were the ones that were picked up, rounded up by the government in case of lapse of the certificate. Now, even assets that are partially funded through these foreign funds are eligible to be taken over by the designated authority. And finally, change number five. Earlier, the NGOs under suspension could deal with their assets, could manage their assets. Now there's a very clear freeze. NGOs whose certificates have lapsed for whichever of the three reasons are not authorized, are not eligible to deal with their own assets.
All right, Ashmit, many thanks for those details. But with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Hello and welcome. You're with us on a fresh new edition of the Global Reset. I'm Prashant Nair. On the program today, we will discuss whether for the business of refining, this is a new normal. We've talked about oil prices, the surge that we've seen. Oil prices have gone up. They've fallen sharply and they've gone back up again. But if you look at product pricing, product spreads, diesel, ATF, petrochemical prices, I mean, spreads there remain very, very high. And that is essentially what we'll focus on here with two guests, Pankaj Srivastava, who's the Senior Vice President of Commodity Markets Oil at Rystad Energy, and Xavier Tang, who is the Senior Crude Analyst at Vortexa. So that conversation comes up in just a bit from now. Before we go to them, here's a quick run-through of some of the global headlines which you need to take note of. West Asia first, US President Trump has said that Iran will be hit very hard after the IRGC, that's the Revolutionary Guard, launched a ballistic missile attack on a US base in Jordan. There was other news as well overnight. A drone hit a US-owned gas storage tanker at Egypt's Mediterranean port of Dementor, causing a fire, according to maritime security firms. When asked about the attacks, this is what Trump had to say.
I've been briefed. It's a little more of the same, but it's going to be straightening out. It's going to be straightening out. In the meantime, we're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but, they tried shooting it last night. So we had 5 rockets shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement at some point, but we're going to hit them very hard.
Well, Trump also said that he wanted to add Iran to the tariffs list and not just for sanctions, adding that that was pushed by Senator Lindsey Graham before he died recently. Elsewhere, Iranian media reports 4 Iranian advisors were killed in joint US-Saudi strikes on Iraq. Iraq has condemned those strikes, warning they risk dragging the country deeper into the conflict. Okay, that's West Asia. Let's shift focus to back to the US with the Fed in focus. The Federal Reserve left rates unchanged for a 5th straight meeting at 3.5 to 3.75%. There were 3 dissenting votes, hawkish dissents, those essentially who wanted a raise this time around. Here is CNBC's Steve Leisman with highlights of what happened at the Fed. And of course, a fair bit of attention focuses on the new Fed chair, Kevin Warsh's press conference. Listen.
Neither the long end of the bond market nor the stock market reacted favorably to the Fed's decision today or the comments made by Fed Chairman Kevin Warsh, some suggesting the market reaction was a thumbs down on his commitment to fighting inflation. The long end taking a hard hit with the 30-year yield surging 10 basis points and the price dropping. At 522, it hit the highest yield since 2007. The spread between the 2 and the 10-year bonds, as investor Jeff Gunlock pointed out, steepened, which undid the flattening from the last press conference. Markets now expect a hike in September, but there's a 69% probability on a hike, a 31% probability on a hold. We're subtly hinting that a Fed hike could be coming.
It's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make.
And the 9-3 vote included dissents from Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas. Sometimes those dissents tell you where the Fed is going eventually. But the question is why the rate hike didn't happen at this meeting, with the chair constantly promising price stability and getting back to the 2% target. Mark Spindell from Potomac River Fund telling me the reaction of the long end of inflation expectations of gold all during the press conference reveals a market questioning the chairman's resolve. He said 2 opportunities to raise rates and hasn't, even as the market builds in expectations for rate hikes. So a hike may be coming from the Federal Reserve, but the problem is Warsh's failure to answer basic questions about what he's thinking and why, and makes it difficult to predict, and at some point raises the question about whether he will act and why. Steve Leisman, CNBC Business News.
You know, in response to the 3 dissenting voices, the 3 dissenters who voted in favor of a hike, this is what Fed Chair Kevin Warsh had to say. He basically said he wanted a family fight, to put it lightly, and he got it. Listen.
The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight.
Which got resolved in favor of a no hike, at least in this particular meeting. The September one, perhaps, as the markets are pointing out, perhaps is closer. We'll step into a quick break here. We'll come back. The discussion on refining and whether this is a new normal with Pankaj Srivastava of Rystad Energy and Xavier Tang of Vortex. Stay tuned, coming up in just a bit. Welcome back. You're with us here under the Global Reset. Asia's refining market is in the middle of an extraordinary squeeze. Diesel cracks have surged from $39 a barrel in late June to about $80 mark. This is driven, of course, by tighter product supply, stronger backup power demand, and renewed disruption risks across the Middle East. With global product inventories offering less of a cushion, the big question is whether this is a temporary geopolitical spike or the start of a structurally higher refining margin cycle? That's a question we're going to try and answer here. Pankaj Srivastav is with us from Rystad Energy, and Xavier Tang is with us from Vortex. Gentlemen, great to have both of you here. Thank you very much for joining us. Pankaj, let me sort of, ask you to respond. $80 diesel cracks, right? How much of this, according to you, Pankaj, reflects genuine tightness, and how much of this is geopolitical risk premium, so to speak, which can unwind quickly, as quickly as it built up?
So, if you are talking about the geopolitical risk, as far as the crude prices are concerned, we think that close to $20 per barrel addition is there into the crude prices because of the geopolitical risk. And the diesel and the jet, both cracks are responding much faster as compared to the other products. And the rise is because of a couple of the reasons. One thing is that Russian exports, diesel exports has been almost dropped to one third, which used to happen in the previous month, close to 1200 kbpsd on a weekly basis. Now it is close to 400. So that is one of the supply constraint which is coming from the product side. In addition to that, most of these cracks, I can contribute maybe 30% plus crack margins is because of the Middle East constraint. So because we should always think that Middle East is just not only supplying the crude, they are one of the major supplier of the product also. And that product supply squeeze is also adding up to the diesel as well as the jet fuel crisis. Some of the things which has happened recently as far as the refining space is concerned, obviously the runs are going down. Asia is running close to 28 million barrels of refining capacity, which used to be 34 million barrels. So yes, the shortage is coming from that side also. And Europe and US, they are basically running close to their max refining capacity and trying to somehow manage the market. But Asian market is going to see this higher cracks at least by the end of this quarter, unless and until we see the geopolitical tensions get reduced and the Red Sea disruptions comes to a little bit more logical way. Because if you see in the June, as you mentioned, the cracks were lower, and the time we start seeing the double blow to the flows, the cracks are showing a significant higher. So 30%, 30 to 40% geopolitical risk premium can be very easily considered into the current prices. And it is going to continue for at least this quarter, and after the this quarters, once the refinery runs are going to normalize, we will see some respite on the diesel cracks. Our expectation is that if the crisis get resolved by the end of August, by the end of the year, we will see refinery runs coming close to the normal levels, and that will automatically reflect into the diesel cracks.
Right. So you're saying if it gets resolved, we on diesel we go back to $40. Possible, Pankaj, right?
Yes. It is
so this is a temporary spike, basis what we're seeing.
Yes. Yeah.
And you began by saying Russian diesel exports are one third of what they used to be. So that's largely because their refining capacity is a fair bit of disruption. Every second day we hear about some drones hitting some refinery site, etc. Right? So there apparently the situation is they are sending oil out and getting product in. Is that what's happening?
No, so if you see a little bit, I will go a little bit back. Before the pre-war level, the Russian refinery used to operate close to 5.4 million barrels of the capacity. And that is basically keeping some sort of the balance as well as the export market is concerned, the diesel export market is concerned. But because of the drone attacks, we have seen the significant capacities were disrupted, and the Russian refineries are running about 4.3 million barrels. So, and the first thing, and if you see a little bit configuration perspective of the Russian refinery, they are more focused on the diesel production, and that a drop in the capacity has, and one unique thing has happened this time is also that previous attacks were mainly used to be on the peripherals of the refinery complexes, let's say the tank farm and some of the pipelines, etc. But this time, we have observed that the main diesel producing or the conversion units, which basically convert crude oil into the diesel, the gasoline, those units has been targeted, and recovery or the repair of those units are going to take significant amount of time. So we should be not relying on that the Russian supply is going to come back very quickly. We should be hoping that this resolution of the SOH and that will be the basically main driver for bringing down the cracks.
Right, got it. It used to. You're saying the Russian refining capacity used to be 5.4 million barrels.
That is the running capacity. Basically, the crude processing, they used to process that much amount of the crude before the pre-war level. February.
About 5.5 million barrels a day.
Yes.
Okay, and what is it now?
It is currently close to 4.3, 4.2 million barrels a day.
Okay.
So almost 1.5 million barrel drop has happened.
Okay. Okay. Because you began by saying that diesel exports are down to, not by 1/3, but to 1/3.
By 1/3.
By 1/3.
From, yes.
Okay. Got it. Fair enough. Let's get Xavier in as well. Xavier, come in here. What's your sense? You heard Pankaj talk about some of these issues. Where is the tightness most visible according to you? I mean, if you look at a holistic, broader picture, is it Gulf exports? Is it inventories being very low? Is it tanker availability? What's your opinion?
No, I think there are a few factors that's definitely affecting the market. First of all, if you look at the crude markets, the majority of the crude supplies that are affected are actually the medium sour crude grades, those that are coming from the Strait of Hormuz, as well as those that are passing through the Bab al-Mandab region. So right now, the conflict has even expanded towards the Red Sea. So in terms of crude supplies, the Asian refiners will start seeing a delay in terms of their cargo arrivals, especially those that are bought in the Red Sea region, simply because some of these crude tankers would now need to reroute their supplies through the Suez Canal or even the Suez pipeline. And what this essentially does is it delays the cargo arrivals for some of the refiners in the Northeast Asia region by about a month or so. And because of that, what we are expecting is that there could be some further reduction in terms of refinery runs over the next few months or so. So what that also means is that there will be a tightening in terms of the medium sour barrels that will eventually land into these refineries. That's the first point on the crude market side. The second point is about the diesel supply and demand balance. So we have talked about the Russian diesel supply that's being affected. What we have also seen is that there has been a strong move to shift diesel supplies from the east of Suez or the Asia region towards the west of Suez market because the demand for diesel is actually pretty high over there. So what we are seeing is a send out in terms of supply drainage within Asia region, and it's all moving towards the Atlantic basin. And what this essentially means is that the diesel supply will get tighter within Asia because of these outflows towards there. Now, in addition to that, what we are also seeing is tighter crude markets, crude supplies coming out from Russia as well as Kazakhstan. Right now, there has been drone attacks, not just on the refineries itself in the Middle East region, that's impacting crude supplies, but also in the Black Sea region. So what we have heard from the market is some of these tankers in the Black Sea has been attacked, and that has resulted in a reduction in loadings in the Black Sea, and that has kind of affected some of the Black Sea Russian Euros exports, as well as the CPC blend exports coming out from there. Eventually, that will have some form of trickling down into the product markets, especially when some of these refiners are unable to get their medium sour crude supplies.
Got it.
In terms of refinery margins, I would say that some of the refineries are actually benefiting a lot right now because of these high middle distillates cracks that we are seeing. And that's largely due to the tightness in both the product front as well as the medium sour crude tightness. And so this two-prong tightness, this will eventually affect the refinery margins, more so for the complex refineries who are able to maximize their middle distillates use compared to the simpler refineries.
Got it. Got it. No, very helpful. Pankaj, if I can come to you, a quick couple of questions. What's the situation in India? Because there was this, you saw what's happened in the US, right? Some senators out of Connecticut saying, will India and China perhaps need to be, that Russia sanctions bill and, pretty stark comments coming through. You think it'll be pushed through and again, once again becomes a problem?
Okay, so I will say that the Indian refineries and the Russian crude has a very strong marriage. And whatever the disruptions and the issues being created, I think that is not going to impact because India is going to buy the Russian crudes unless and until the other alternatives are available. So even if these sanctions are there, if you see a little bit the history since middle of the last year, the sanctions were put on place. The EU placed the secondary sanctions on the.
But Pankaj, when those sanctions were placed, purchases from Russia dropped quite a bit, right?
Yeah, it has been dropped to the minimum of close to 1 million barrels. Yeah, and but that supply that drop has been compensated by the supply from the Middle East and other countries like the UAE, because UAE is currently out of OPEC. Fujairah is the open port for the supply. So US supply has been increased to India significantly. Brazil has been one of the major suppliers, Guyana, some African countries. So India was somehow able to manage the situation despite having the sanctions on the Russian oil. Now, this situation, if you are talking about again the 100% tariffs on being planned to imposed on India on the Russian, I see, yes, the country has started importing close to 2.25 million barrel in the last month. So that number may come down, but if we are expecting that that will become zero, it is not
It'll
possible.
not happen. It may fall back.
Yeah.
Got it.
And one point I just wanted to, and another thing is that Indian refinery system is already running more than 110% utilization. And the reason is, yes, the demand, as well as the couple of the new refineries are also going to start up. Like the Barmer refinery in Rajasthan has started up. So they are also relying on the more crude supply. Unless US ensures some alternate for the India, I don't think so that the Russian supply will be go away. And the Nara refinery, which is currently under the Rosneft, is going to continue to receive the amount of the crude they require, almost 400 kbpd.
Okay, got it. I had a basic question, Pankaj. Somebody was making the point that when you from again India perspective, when you see this Brent price at 90, whatever, 89, 90 now, the point somebody was making that's not very relevant from an Indian perspective because we are doing a lot of bilateral deals. Say, for example, for Russia, so we are not buying oil at 90 or 80 or whatever it is. It perhaps is much lower. Is that the correct way to look at it? Quickly.
Yeah, so there is a certain level of the discount used to be available for the Russian crude till the August delivery. But because of the Red Sea disruptions, we started seeing that discounts are not available from the September time onwards. So yes, it is not like that the India is not facing the brunt of the brunt because of the higher crude prices. Yes, but sometimes these physical deal, one-to-one deal, are going to help India to reduce their overall crude purchase cost. But one thing I will say that these bilateral, as you mentioned rightly, the deal with the UAE, Russia, and other like the Brazil, these countries are going to help India in long
in
term.
terms of supplies.
Yeah,
Since this latest flare-up happened in the Middle East, would you have a sense of what are we paying for oil?
Yeah, anything between 90 to $110 per barrel range. But the physical deals are a little bit because and at this point of time, Indian refineries are pretty much okay as far as.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the government is expected to table a new bill this monsoon session that not only changes the statutory framework under which NGOs can receive foreign funds, it also imposes a stronger takeover clause if the institution fails to obtain a fresh certificate or fails to have the certificate renewed or restored within the prescribed time frame. So what are the key changes proposed in the Foreign Contribution Regulation Amendment Bill? Well, first of all, an NGO's FCRA registration would be treated as lapsed if it fails to apply for renewal or its request is rejected for renewal, is not granted before the certificate expires. Once the registration is deemed to have lapsed, the government could automatically take control of foreign-funded assets. Under the current law, this was possible only when a registration was formally cancelled or surrendered. The bill also proposes appointing a designated authority to take custody of, manage, supervise, sell or permanently transfer such assets. Another key change, land infrastructure or other assets created wholly or partially with foreign funds, even if co-funded by domestic donations, would come under the law. And finally, NGOs under suspension would not be allowed to sell or transfer these foreign-funded assets without prior central government approval. Under the existing rules, suspended NGOs could still deal with their assets under general laws. Now, to help us unpack what this FCRA amendment essentially means, what the impact could be, how the government is looking to defend it in Parliament, joining me now is with me Mr. PDT Achari, former Secretary General of the Lok Sabha. Mr. Achari, thank you so much for joining us. Pleasure connecting with you. Tell us, we've read your recent piece that you had authored. You refer to this bill, this amendment bill, as a sledgehammer. Help us understand why.
It is nobody's case that there should not be any regulation of the foreign contribution. In fact, right from 1976, there has been a law to regulate the inflow of foreign funds. And that is necessary also. There is no dispute over that. The point is, when you are allowing foreign fund to come, then how are you regulating it? If you are regulating it in such a way that it is impossible for the organizations, associations, and NGOs and all that to access foreign funds, then there is no meaning, there is no point in allowing foreign fund. Either you ban it or allow them certain freedom. But here, what I find is that some of the provisions certainly have this sledgehammer effect, because under these provisions, see, the assets that have been created out of these foreign funds will go to the government in case there is a cancellation or there is a surrender. That is one thing which I highlighted in my article. If there is a surrender, and suppose a person gets foreign funds and spends that money on building certain assets, and he runs it, after some time he decides to surrender it, he no longer requires the foreign funds. In that case, he can surrender it. Why should he continue to get foreign funds if the asset that he has created has generated enough funds so that he could run it smoothly? In that case, naturally, he will surrender it. But here, surrender is a punishment. That is the provision. If you surrender it, then the entire property will go to the government, maybe provisionally, but the point is, it is very difficult to get it back from the authority to which it goes. That is one very, very difficult. I mean, it's a provision which is very difficult to understand. I don't understand the logic behind it. Then there is another provision. Yeah. You want to ask
Mr.
something?
Achari, you've raised a couple of very pertinent points. Let's run through them one by one. First, Section 16A that you've clearly pointed out is of concern to you. Now, under the earlier regime, mostly the assets takeover when that would happen would be assets that were fully funded by foreign funds. One of the concerns that you flagged is that even an asset that is partly funded by foreign funds and partly by domestic funds, even that is eligible for takeover by a designated authority. Tell us why this is a concern that you're flagging.
Actually, suppose a person builds an orphanage and 20% he has spent from the foreign contribution and 80% he has raised from other sources. And on some ground, he loses it. And the property, entire orphanage will go to the government. And then the funniest thing is, the most impractical thing according to me is that if he makes an application and all that, then the authority has the power to return the 80% of the assets created back to him. But if an orphanage is divided, can an orphanage or can any asset be divided in this manner? I do not really understand. So it is beyond my understanding. That is why I have actually flagged that particular provision. I said it is, impractical, so to say.
Another provision, Mr. Achari, that you've raised concern about is that in case of surrender, what you were referring to in your first response, that in case an organization decides that it doesn't need foreign funding anymore and therefore it goes on to relinquish its FCRA certificate, if that were to happen, as per the new law, is that NGO or is that organization also required to relinquish the assets that were formed using the foreign funds?
Yes, absolutely. Absolutely. The whole fund will go. That is why I ask, a question. Is surrender a punishment? I mean, does surrender lead to a punishment? What exactly is the logic behind it? I don't really understand that thing.
Sure. Mr. Achari, I also want to get a sense that as per Section 16L of this bill, there is an exemption provision. The government can exempt certain entities or a group of entities from application of this FCRA amendment bill and the very stringent provisions. Who is that aimed at? What are we looking at? Why would the government want to give itself that exemption power?
See, I actually, I'm at a loss to understand the purpose behind it. Because an organization which is receiving funds from foreign countries is totally exempted from the provisions of the Act. I mean, there is a total exemption. That is what it means. When you are regulating foreign funds, when you are regulating the use, when you are regulating the receiving of foreign funds, how can you exempt a particular organization or particular individual or group of individuals from the provisions of this Act? And that means the government is seeking to create a particular group of organizations on which this law will not apply at all. Why? What is the reason? There is no reason mentioned in that. It says the government is of the view that it has to be done in the public interest. The public interest, what exactly is public interest? It's a very, very wide term, which cannot be easily defined. And the government, as I said, government is the custodian of public interest, and public interest is what the government says it is. That is the thing. The entire thing will be decided by the government. If the government wants to exempt a certain organization, for whatever reason, it can do that. But how can the government be given such unfettered power? And I have pointed out that it will hit Article 14 of the Constitution. And I have said that because there are two conditions which need to be fulfilled. One is intelligible differential. That means there has to be an intelligible difference between one group of organizations on which the law applies and the another group of organizations on which the law doesn't apply. But where is the guidance in this in this particular provision? And then there has to be a rational nexus. You must tell us clearly why certain organizations are being exempted, on what ground. There has to be a rational nexus between the
perspective. In the government's perspective is that, look, it is not uncommon for democratic countries, whether it's Canada, US, Australia, to regulate foreign funding. It's not uncommon for even these countries to do that. The government has also gone on to say that as far as regulation is concerned, the state needs to monitor to ensure that there's no money laundering, that there is no misuse of the funds in question, that the national security interest is preserved. Why then would there be a natural opposition to some of this tightening that we're beginning to see as far as foreign funding regulation is concerned?
See, as I said in the beginning, nobody will question the government's authority to regulate the inflow of foreign funds. It has to be done because foreign funds, the kind of unchecked inflow of foreign funds can create problems. It can destabilize the system, and it can vitiate the system and all that kind of thing. These are all things, indisputable, and nobody will question that. The point is how you are going to do this. This bill gives the government a lot of powers to use the government's discretion in doing this. That is the whole problem, because in every clause you will find this public interest. And that is the question. The government will decide what is public interest. That is it.
Sure.
So
Mr.
that
Acharya,
is creating problem. Otherwise, nobody has any dispute. Nobody has any problem about regulating the foreign funds.
Mr. Achari, before I let you go, just a couple of quick questions in terms of if this bill were to get passed by the Parliament and then subsequently be notified and take effect, what to your mind would be the very real-world consequences that you would see on the ground?
Well, I can foresee there are certain organizations, for example, from Kerala, the Christian organizations have raised so many apprehensions. They have expressed their serious doubts and apprehensions about the impact of this bill. And here there is a provision for giving registration and also cancelling registration if a person is involved in conversion. And anybody can go and file a petition in the court or in the police station saying that this fellow is doing this conversion, is a forced conversion or coercive conversion, and therefore his thing should be, his registration should be cancelled. And it becomes little easier now in the present situation. Because we come across, we hear so many cases where the people who are involved in, the people who are running NGOs and involved in religious activities are being taken to court and all that sort of thing. All these things have happened. And in that case, people who are running genuine institutions, they can be framed. That is the thing. So there are enough number of people in this country who can go to the court and or go to the police station and do this. And here the law says either prosecution or conviction. That means a person is prosecuted. That itself is enough for you to cancel the registration and take over his assets.
Right, Mr. Achari, appreciate your insight that you've given us in terms of what, to your mind, would be perhaps the legal loopholes and how it can be addressed going forward and what perhaps the impact could be. We're yet to, of course, see a vote on this in the Parliament. We're yet to see a discussion on this. We'll, of course, keep our viewers updated. Mr. Achari, thank you once again for sharing your time and perspective. With that, let's slip into a very short break. But coming up next, Qualcomm's head of automotive, IoT, robotics arm bets on India, bets on a new set of technologies to drive growth. We get you that special conversation on the other side. Welcome back to News Center. Now, Qualcomm Technologies is betting big on autonomous vehicle segment. Speaking to me earlier, Nakul Duggal of Qualcomm Technologies said that local innovation is driving India's automotive industry, and he believes autonomous vehicles will enter the Indian market soon. He also said that India's manufacturing growth story remains robust with a fantastic future ahead, adding that it's a great time to invest and build in India.
Car is a digital cabin. And the car is an autonomous machine on wheels. And both of those are being powered through software using advanced chips. And nobody would have really said exactly those words, but if you really think about it, that is exactly what's going on. When you think about electrification, the car actually gets significantly simplified because you have a battery pack, because you have a battery management system, you have an inverter. So the concept of horsepower kind of becomes a bit unnecessary. But what it gets replaced with is intelligence in the car that is about creating an experience for the passenger, for the driver, and then safety. And that, I think, is probably the best example I can give to you as to what form physical AI takes in the context of an everyday product that is both a consumer product but also a safe product, an industrialized product that has to be able to deal with a fairly complex environment.
Great. Let me also ask about when we talk from an Indian perspective, there's a great demand from the users as well, and a great deal of integration that we're already beginning to see from Indian car makers, whether it's the Tatas, whether it's the Mahindras doing a lot of work in terms of bringing in additional capabilities as a part of the user driving experience. Tell us, how does that look to you as a market? Is there greater integration that is possible? And also, are there lessons to be learned from some of the more developed markets, say perhaps China?
Yeah. You know, we've actually been very fortunate. We've engaged with excellent partners throughout. I was meeting with Ultraviolet this morning here in Gurgaon. I think there is so much of local innovation that is going on, and it's actually innovation for market conditions, for consumer needs, for the uniqueness that the specific market requires, whether it's a safety experience or an agentic experience. And there is a tremendous amount of domestic innovation that's been going on in these markets for a long time. Way before, you know, we were talking about digital in kind of associations. And so naturally what we see is the use of our products for a very localized experience.
Tell us, 10 years down the road, given the pace of development that we've seen, we began by talking about how much has happened in just 6 months. Tell us, 10 years down the road, 2036, what does a car begin to do for the user in 2036?
Yeah, I think a car is a robot in 2036. A car is a robot, and you essentially are using it either as a personal mode of conveyance or potentially just something that you hail that is providing you with the transportation service experience. It is obviously highly dependent upon the infrastructure that it is traveling over and the kind of guardrails that are available. But look, the technology is already very far along. And if you put in enough guardrails, if you put in enough hardware into these products, they can actually be mostly driving safer than human drivers can. So certainly 10 years from now, we are going to be in a very different place.
But on that note,
I think the good news is the safety is improving. As you start to bring all this technology, safety is improving, and that means lesser accidents, lower fatalities, etc.
how far away are we from a humanoid robot that can perhaps do my laundry back at home?
Yeah. I would like to get a humanoid robot that can do my laundry. So yeah, you'll have to get in line. I think for tasks that are highly repeatable, I think the technology actually is there. I think the question really is how robust is it? And how does it deal with unstructured tasks? How does it deal with randomness? How does it deal with things that require you to have, for lack of a better word, intuition? Robots are by definition not intuitive, or at least the current day robots are not. But I think there are two parallel paths that are kind of ongoing. I think one is to make the hardware robust enough that it can be used for a very large generalized set of skills. And then over time you're teaching those skills to the robot. And then the second piece is how do you actually make the ability for learning the skills as repeatable and as scalable as possible.
We're already beginning to see in certain industries cameras, body cameras being installed on workers, and that perhaps being used to train. How far ahead are we in that journey? Of course, we're only seeing disparate reporting. But how far away are we in terms of concentrated, focused learning of these systems to actually help yield the kind of results that we're hoping?
I think it depends upon the industry. In certain industries, actually fairly far along. If you look at law enforcement, body cameras are used very widely because you want to be able to use that for recording the scene. It's part of the evidence chain. You could also use that for translation. If you want to speak a language that the person is not speaking, how do you immediately get that feedback? We see cameras that are connected to real-time AI transcription services, so you can go across languages. But then the same exact product, the same exact implementation is used in hospitality, is used in healthcare, is used on the retail shop floor, because you want to be able to use that camera and get access to information. What is happening is that the convergence, and this is again a great example of physical AI, the interaction layer with the human is not necessarily just text. It's actually audio and video. So it's audio data, it's camera data. And as you start to make that one seamless stream of information, that's what you're then processing and engaging the human. And so that is actually moving fairly quickly.
India has been going hard as far as its semiconductor aspirations are concerned. We saw India Semiconductor Mission Phase 1 that was focused primarily on fabs, OSATs, ATMPs. Now the focus is on the broader ecosystem, whether it's materials. Fabs, of course, the focus continues, but there's also a big emphasis as a part of this program, specifically on designing. I just want to get your thoughts. Is this perhaps, does this give you reason for hope? What will it take for taking India's journey forward? And can Qualcomm perhaps be a part of this India Semiconductor Mission?
So, we have very recently partnered with Tata. We are working with them. They're manufacturing a number of our automotive grade modules for us. That's something I think that we kicked off earlier part of this year. I think India has a fantastic future in manufacturing for electronics, for SMT, for semiconductors. If you think about the state of geopolitics, if you think about the need for multiple diversified supply chains, I think this is actually a really great time for India to be investing in everything that it is doing. These things do take time to scale, but I think that India is also unique in that, in addition to being a very, an opportunity to export, there is a very large domestic opportunity in India, both in terms of India's own growth, all of the industries that exist, and semiconductors are becoming part and parcel of really everything that you will see in front of you as far as any kind of digitization goes. So I think it's a tremendous opportunity. It requires effort, no different than really any other similar scale market. But one thing that is pretty clear is that of all of the opportunities that exist at scale in front of India, this is the one that has massive national need, but also a very large international export opportunity.
I want to get a sense from a policy standpoint. What would perhaps be some of the key things you'll be watching out for as India builds on this journey to encourage greater robotics, AI on the edge, as well as integration with industries such as the automotive space?
That's a great question. I think I think the size of the opportunity is so broad. There is so much of diversity in every industry that we are talking about. I'm just very excited about how quickly India is leapfrogging in markets where it can, where it sees the opportunity to be able to not just introduce something that was built in some other market a few years ago, but to actually figure out how to jump ahead to wherever it will naturally go. And I think it couples really nicely with a lot of the domestic innovation that is going on, especially in the automotive space. I really feel like there is this very localized differentiation that is building, and I think that will apply to a wide variety of other industries as those grow as well. I think industrial automation will probably be the next area, and with the growth in robotics, I feel like that could probably be the next very interesting space to watch.
And with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
In 2005, India's aviation industry saw the emergence of a new player, a startup that would rewrite the rules of the airline business and defy the odds of survival in a sector that's seen the demise of several private airlines. 20 years on, Indigo Airlines is India's largest airline with an overwhelming 66% market share, fleet size of more than 400 aircraft, annual revenue in FY26 of 10 billion, delivering profits in a sector that's been marred by airlines losing money, with the aspiration of being India's most formidable international airline. But what was considered its competitive advantage, its scale, is being seen as a vulnerability for the sector in light of the collapse of its operations in December of 2025, which forced the regulator to step in with penalties and restrictions. While operations have normalized, winning back customer trust and regulatory confidence is among the key challenges for the airline as it starts its third decade of connecting Indians. Joining me now to talk about Indigo's flight path is its co-founder, its interim CEO, and its managing director, Rahul Bhatia. Rahul, it's great to have you back on CNBC TV 18. Many thanks. We don't really get a chance to speak to you very often, so it's good to have you speak to us today. Congratulations are in order as you complete 20 years. And as I said, Indigo's had many important milestones, not just for the airline, but for the Indian aviation sector as well. It's sad, though, that it coincides with what happened in December of 2025, forcing you to come back to manage the airline. Is that a regret?
So, you talked about 66% market share and the footprint. Can we talk about that a little bit?
Yes.
Because I think this is something the company has failed in sort of educating the world. So 34% of, actually 1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in, we only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure, we are able to experiment. And the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing for the sake of the country.
I'll pick up on your words. You're saying you're being badgered for your size and scale today. That was not the case up until December 2025. People were not going after Indigo. Of course, the times when you saw the prices spike and so on and so forth, that was the case, but that was the case in the natural course of things. This badgering, the fear of a monopoly, the fear of this emerging as a national vulnerability has only started post what happened in December, which was a debacle. There's no other way to sort of put it. That's where I wanted to push you a little bit. You talked about cost optimization and why that gives you the ability to fly to routes that other people can fly to but choose not to fly to. Are there limits to this lean, mean machine that you've operated for 20 years? And were those limits really tested in December?
No, I mean, I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet. A couple of days before that, there was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption at Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some of the some carriers larger than Indigo that have been through issues like that, Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is this something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
Yes, operations have normalized, but let's talk a little bit about what you've been able to change. There have, of course, been leadership changes. As I pointed out, you have come back as interim CEO. Billy Walsh will take over as the new CEO. You've had other changes. You've got a new CHRO, you've got a new CFO, you've got a new Chief Strategy and Transformation Officer. How much of what we saw happen in December was a result of poor management decisions, a leadership issue, and hence you believe that the leadership changes that you've been able to bring in will help address some of those challenges?
I think the changes that we have seen over the last 3 or 4 months, some of them have to do in preparing this company for the future. Some of them have to do with holding some people accountable for what happened in December. It's a mix. It's not about one thing or the other. It's really taking stock of what happened that should not have happened, and also building resilience in the organization for the future.
Regulatory confidence, and that is going to be key now as you start your third decade of operation. And at this point in time, it's pretty evident that the government is concerned about the so-called monopoly that you enjoy, the 66% market share that we just spoke of. The Civil Aviation Minister in Lok Sabha has gone on record to say that India needs more airlines. He believes that we need 5 more airlines, and he believes that India cannot be, quote unquote, I'm paraphrasing what he says, cannot be held hostage by one large airline. How do you win back regulatory confidence? You've also got the Competition Commission looking at issues of violation of dominance. You have, of course, proposed a competition settlement. How do you win back regulatory trust?
So in terms of sort of our operational resilience, I'd say this fairly confidently, that if you went under the covers of this airline, it's probably one of the finest airlines operationally globally. Like I said to you, what happened in December was actually coming together. It was a perfect kahuna. A lot of things came together that did what happened. But I mean, the regulator watches us on a daily basis, watches the entire industry on a daily basis, and I think we demonstrate on a regular basis that we do a fine job. Something you may not know: technical dispatch reliability, which essentially talks about how many missions you can't complete in a day because of technical reasons. Indigo, since inception up till today, has had one of the finest TDRs globally amongst all A320 operators. So if you go under the covers of this company, it's a well-run machine. December happened, and it's clear to us that it's something that we cannot afford. I mean, it is we clearly recognize that we have a responsibility towards the nation because of who we are and what we do, and we do on a daily basis everything we can to make sure that we can live up to that promise.
You talked about going under the hood of the airline, and the DGCA set up its own committee. You set up, the board set up its own internal review, external review as well. Now, the DGCA, in its findings of what happened in December, talked about operational deficiencies. It talked about optimization, which perhaps had been pushed beyond its limits. It talked about the lack of FDTL preparedness. Now, if I were to ask you on each of those fronts, which has, of course, been publicly spoken about by the regulator, what is the corrective action that's been taken? If you can give us examples of, for instance, in terms of roster buffers, where do we find ourselves today in terms of active pilot ratios? Where do we find ourselves today, so that there is a sense that this is unlikely to repeat?
I mean, we have now been flying for 6 months since December, and our punctuality has never been better. And this is something where you earn your wings every single day. We fly over 2,000 trips a day, and I think the machine runs fairly smoothly. Our only appeal to the government is that put regulations in place. Okay, let me go back. I know of no airline operator in the world, whether they fly 1 aircraft or 1,000 aircraft, that they want to fly an unsafe operation. Right? I hope you and I agree
Absolutely.
to that. And our only appeal to the government has been that when you look at FDTL regulations, look at it from two lenses. One, that we must do what is best in class on a global basis. Right? Look at regulations around the world and figure out what's the right thing to do. But if we put in regulations in place which actually, in the garb of being safe, make the industry as a whole uncompetitive because you're actually taking down productivity of the cockpit, I think is something that we need to look at, because you cannot have on the one side an aspiration for the nation as a whole to get on to the stage of global aviation and yet have its airlines compete with the rest of the world with an uncompetitive cost structure.
So you're saying the current FDTL regulations make Indian aviation uncompetitive?
In terms of cockpit productivity, absolutely.
In light of the FDTL regulations, will you need to staff differently from what you've been accustomed to doing over the last 20 years?
Well, like I said, if productivity is going to take a beating because of the FDTL regulations, we are staffing differently. We already are.
Which means that you will need to hire more, or will you change the way that you fly?
It's a mix of both.
It's a difficult geopolitical environment. It's a difficult environment as far as the currency is concerned. You've seen that impact on your earnings as well. It's a difficult environment on fuel. Again, you've seen an impact of that on your earnings with the fuel bill doubling. So realistically, with this mix, which is a challenging mix, will you need to recalibrate your international expansion plans, at least in the short to medium term?
I think in the near term, we are going to have a lot of our fleet look eastward because of the overflying restrictions over Pakistan, what's going on in Iran. But, we don't think that that's something that's going to remain for a prolonged period of time. As and when it changes, we will recalibrate.
Fuel and the rupee, both not in your control. There's not much that you can do with it. The government came out with its proposal for a stabilization fund. There has been no takers so far. Why do you believe that's the case? And if things were to continue as they are, both on fuel as well as the rupee, what can we expect realistically in the near term as far as financials are concerned?
Oh, it's going to be tough. The stabilization fund, I think, there was a lot of back and forth between the industry and the government. And I think when it came close to having an agreement, there was peace, relative peace in West Asia. The fuel prices came down. And then, of course, this thing did not see the light of day. If things creep back up again, I'm sure there will be an engagement again with the government and the operators to see how we can sort of bridge.
What would you like the government to change? What would you like the government to tweak to make this more viable for people like you to take this up?
I think more than viability, Shireen, it's about being able to offer affordable fares to customers, right? Clearly, the government would not like that the fares go up sharply. And that's, again, a conversation between the government and the airline community to see at what level would we want the fares to be. Because finally, at the end of the day, the fuel goes up. The industry will have to pass along some of that burden to consumers.
Yeah. It's still just about $90 a barrel at this point in time. We don't know where it's going to go given how volatile things are. But can you hold prices at the current levels?
I think prices have firmed up over the last little while. And I think the consumer base is responding positively to it. Are we able to flip all of that over to the customer? I'm not sure, but I think a fair bit is moving where customers are paying higher fares.
What about the rupee? And, you've had a forex hit of over 8,000 crore rupees on account of that. What's the outlook there?
I mean, hard for us to say, but, Shireen, in our business, cash is king. You need to keep yourself, you need to have cash in the bank to keep the operations going. I mean, we saw that in COVID. We burned through a lot of free cash at that moment in time, and we just need to hunker down and make sure that you run a business as efficiently as you can to weather through these things.
Speaking of cash, I mean, the balance sheet is strong. You've got over 50,000 crore in cash, even free cash flow over 30,000 crores at this point in time. So from that perspective, enough resilience there to be able to ride out the current wave of uncertainty and the current fuel shock?
We think so.
Let me ask you now about, beyond the international bet, what are some of the other priorities that you intend to focus on? I know, as you look at expanding both domestically as well as internationally, what changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
I think Indigo's journey over the last 20 years was all about building an extensive domestic network. We are not finished doing that. We will continue to do that. That will remain the core of the airline. But having built this network, the next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India. And that's something which, for reasons I probably prefer not to discuss, was handed over to airlines and geographies outside of this country. With that, there was a lot of export of economic wealth from this country to airlines that don't reside here and were carrying Indians. I think there's an immense responsibility on our part as Indigo and on the part of airlines like Air India to bring all of that back. So that's our sort of next step. And I think we are well positioned to do that just because of the domestic network. We are able to collect people into a hub and then fly them on bigger planes to other parts of the world. So that's really what we want to do as stage one. And there will come a time at some point in the future where we will, once see the airport hubs sort of mature, where we will carry customers from one geography to another through India. They don't necessarily have to be our customers, but I'm taking an example, somebody from the UK to Australia. I think once we build our network and once the airports are transit friendly, we see that happening.
Is that a decade journey?
I think phase one is certainly more than a decade worth of journey, but in that you'll start to see tricklings of what we call sixth freedom carriage through India.
Is this why you've brought in Billy Walsh as CEO? The fact that you want to build on your international expansion plans, is that part of the reason why you've decided to bring in a former BA CEO into Indigo?
Well, the plan was set up well before Billy's arrival, right? I mean, we had ordered XLRs and 350s well before Willie showed up. So that plan has been in place for a long time.
So how are things going to be split between you and Billy Walsh? He, of course, comes in as CEO. You are managing director. You will hand over the CEO responsibilities to him. But how do the two of you operate and run this airline going forward?
Well, I've always had a very sort of a soft touch approach to oversight. I mean, at the end of the day, you have a chief executive who's got to do what they've got to do. You can't, as a promoter, interfere in the business. And I'll have some level of oversight, but the business is going to be run by Willie. And like you said, Willie's own background with Aer Lingus, and then British Airways and IAG, I think is well positioned to put together, our journey into the future when it comes to going international.
What is the mandate that you've set for him, or the board has set for him?
I don't think there's a mandate. I think, let me talk about Willie a little bit. So Willie's done everything he's done. He's been now the DG at IATA. I mean, he's the sort of guy who's seen it all, done it all kind of chap. And I think for him, his acceptance to come and be part of the Indigo journey, I think while it has something to say about Indigo for a man of that caliber to come and play their magic in the country, but I think to a greater extent, I think it's a reflection of how he sees India and the opportunity it represents. I don't think, and I'm sorry to say this on behalf of Willie, and I shouldn't be, but let me say how I see it. For him, this is not a stepping stone journey. I would think so. He's kind of done what he's had to do over the years, but for him, this is really a journey about making a difference, and I personally greatly look forward to his contribution.
You know, you talked about, for Willie, this being not just a bet on Indigo, but a bet really to understand how the Indian market is going to grow from here. There's potential and significant headroom. What do you see as the addressable market as we talk about Indian aviation? I mean, you know, every day you get reports talking about the numbers, but from an insider's point of view, given all the constraints, given all the uncertainty and the challenges, what do you really see as the headroom for growth from where you are?
Yeah. So let me go back to 2006. So when I think in the calendar year of 2006. We started in August, and by December, I think we had 6 planes in the fleet. We begged and borrowed 2 slots in Delhi, parking bays, 2 slots at what used to be the Bangalore airport at that time. And then we started to park planes in Jaipur because there was no slots to be had. And we were parking those things late at night, bring them back up to Delhi early in the morning so they could do their daily run. So in 2006, had you asked me, Rahul, would you have been able to foresee at that time where Indigo is today? I would be honest to tell you, no, I wouldn't have. I keep telling internally, we all understand that the India opportunity is large, but what we don't understand is how large is the opportunity. We just don't know. All we have to do is make sure that we have cost leadership by which we can, put out affordable fares to consumers, bring up demand, fill up planes, and just keep going, keep that flywheel going. I think Willie has said this already. All I know is that when you look at international markets, it's actually preposterous that we have only 50 long-haul planes in India for a country of our size. So I think there's great opportunity into the future. I wanted to actually, if it's okay with you, I know you're interviewing me, but I've thought that maybe we can talk about a couple of issues, if it's okay with you.
Absolutely.
And I want to go back to this market share sort of narrative.
Sure.
This is our view, and I say this with utmost humility. What is Emirates' market share in Dubai? What is Qatar's market share in Qatar, in Doha? What is Lufthansa's market share in Frankfurt? What is BA's market share at Heathrow? And the list goes on. And the reason I bring this up is that if India, this is not Indigo, if India truly wants to compete with carriers in their home markets who are of the size of some of the ones I've named, or Singapore Airlines in Singapore, India needs a few big carriers. Otherwise, you'll never, ever be able to compete. So, we have to take into context that this, of course, we can have 10 airlines in India, 20 airlines in India. But to be able to, this is not about competing in India. I think this journey is about India competing with the world. And if you really want to take them on, you will need to have 1 or 2 or 3 winners who will actually just do what they have to do. And you have to allow them to grow. And because if you truly want to be, we talk about India being sort of the 3rd largest aviation market by a certain year. If you truly want to go out and yank that economic wealth that has been over the years taken by others, you'll need to back some winners.
Well, speaking
That's the one part. And the other thing I wanted to talk a little bit about,
No, go ahead.
Sorry for, stealing your time. I'd like to talk a little bit about airfares. So we constantly, the industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India And when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines. Has gone up, and this is the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete. And in that mix also is ATF and the tax on ATF. We need to ask ourselves the question, if we really want to get there, then I think we collectively have a responsibility to make sure that we have a cost structure that makes the industry, from a profitability standpoint, sustain. It has sustained profitability. Because if you don't, you'll have people who come and go, right? People will come, they'll put in money, they'll fly an airline, they may not make it, and then they go away. But if you want this to be a profitable industry, then I think we collectively have a responsibility to make sure we go there. And once you have that, you will have investment come in. You will have airlines come in. People will invest in airlines. But all of that needs to change.
You're right in pointing out that what we've seen in terms of taxation, whether it's ATF and, of course, the examples that you gave on UDF and other charges, have been a problem. You talked about your cost leadership and how that has allowed you to be able to connect to locations that others don't wish to connect to. Is that cost leadership today under more pressure than it has been over the last 20 years? Will you be able to deliver and connect to the locations that you would otherwise like to connect to, which may no longer be viable for you to do so? How much pressure is there on your cost leadership today?
Well, we talked about this earlier. This FDTL regulation puts pressure. I mean, we have an ATR fleet that is under tremendous pressure because of this new FDTL regulation. Suddenly, many markets from being profitable have become unprofitable. And I think there needs to be a discourse amongst all the stakeholders to see we need to fundamentally change a few things for the industry to prosper. And the responsibility does not lie only on airlines. And the reason I brought up airfares is because every time the fare goes up, guess who gets the beating? It's the airlines. Nobody ever talks about all the other elements of that airfare. So and we try. I mean, we have been working with the government and they've been very supportive. But we need to keep working on this thing to make sure that the ecosystem in India in totality competes with the best in the world. And then, of course, we will, the opportunity is there.
So given where things currently are, as far as taxation and other charges are concerned, your own profitability has been under strain, 2 consecutive quarters of losses. Of course, the operational performance still continues to be robust. But if this were to continue, and we've got plenty of examples of Indian aviation, which unfortunately has been a graveyard of airlines, are we looking more vulnerable today from an industry standpoint? And there's barely a handful left.
Like I said, the industry, Shireen, will remain under pressure till we make some fundamental changes. And I think all the stakeholders need to have a deep look into this and see what can be done. You can't have a situation where aviation in India is increasingly considered infrastructure and a public utility. And yet when it comes to taxes, it's seen as an elitist mode of transport, right? We carry more first-time flyers than ever before on a daily basis. And I think like I said, we need to review this.
possibility of airport operators being able to run airlines, own airlines themselves. This is not the policy at this point in time, but we're given to understand that this could be up for review, that the Adani Group may be looking at getting into the airline business. You've gone on record to say that that would amount to a massive conflict of interest. Now, explain to people who are watching why you believe that to be the case.
I said what I said last week, and I'll give you several examples. So if you have an airport operator who controls slots, gates, parking spaces, movement of aircraft, and they actually end up having an airline, there is conflict of interest. Other than these city-states where there's common ownership of an airport and an airline, there is no example in the world where an airport is owning an airline or vice versa, and for good reason. And there are countries where there is no ban on airport operators owning an airline, but there's enough regulation behind it which ensures that there is a level playing field. As recently as this West Asia crisis, we have all seen that in Dubai, Emirates flew its full complement of flights into India. No Indian carrier could fly into Dubai. And the only reason they could pull off this stunt was that the airport and the airline is owned by a common shareholder. It's completely uncompetitive. But the reality is it happened. And it's happened not once, it's happened in the past too. They had an incident some years ago where the runway was blocked for a long period of time. And the only airlines that could fly in and out of Dubai was Emirates. Everybody else was shut off. The investment into airlines in India is completely open. People can come in. I think it's one of the most friendly policies in terms of starting up an airline. There's no barrier to that. People can come in and do what they have to do. But to have airports start an airline, I just think is a fundamental issue. And again, I think we as a nation should look at global best practices and just bring them to bear.
Yeah, and I don't know which way this is going to go. We don't want to preempt, possible change or not by the government. But if there were to be a change, and you said that there are countries where there is no ban, but there is enough regulation in place to put the guardrails so that there is no conflict or apparent conflict of interest. Should the government allow airport operators like the Adanis to start and own airlines? What kind of guardrails do you believe need to be put in place to create a level playing field?
Like I said, I mean, you have to have regulation on slots, on infrastructure. There's a whole slew of things that need to be put in place. But what I struggle to understand is when there is no barrier to entry from any airline operator, is that not enough? The other issue is that, and it goes back to our earlier conversation, why, if the government wants more airlines, very welcome. We love competition. It keeps us on our toes. But we need to understand that the industry as a whole needs to get to a point where it can get to being profitable. Once you get that, you will find investment, you will find people who are interested, and more airlines will come in. But to just get more airlines with the cost structure that we have today, you're going to have more mortality. It just, you will not fix the problem by bringing in more airlines. Right. And we talked about fares a little while ago. Fares in India remain one of the most competitive on a global basis. Right? So it's not that people are not people are getting fares higher than they should. I mean, we can give enough evidence of the fact that the fare structure in India remains one of the lowest in the world. But we need to fundamentally fix sort of the inherent cost of the business, and then everything else will flow. But you can't, if you try to bring in more players, you're just going to have more mortality.
Without addressing actually the cost issue that you already spoke about.
Correct.
Let's talk a little bit about your flight path going forward now with the expansion that you expect on the international front. What is the run rate that we're talking about in terms of fleet addition? Are we still looking at that aircraft a week coming in? What should we realistically now expect given the supply chain issues as well?
Yeah, I think, I don't know if it's one a week or a little more than one a week, but we have a steady stream of planes coming in. I think some years it gets up to even higher numbers. But we also start to, when we bring in, I'm taking a number, 60, 70 aircraft a year, we also flush out some of the older fleet. But I think the average guidance we have is that we will continue to grow into the next decade at low double-digit numbers.
That's as far as the fleet is concerned. One of the other big developments that you announced a couple of days ago was, of course, the engine order with CFM. Is that part of the de-risking strategy as well? 1,000 engines that you've now placed an order with CFM for, given the challenges and the problems that we saw with Pratt & Whitney?
Yeah, I think the more important element of this is setting up the MRO, because we see these constraints plaguing the industry for a period of time into the future, and we want to be more in control of our destiny. And I think the whole arrangement with ordering, I think the next batch of 510 odd planes are going to be powered by the CFM engines, which is 1,000 plus engines. But the underlay of that is that we want to, starting in the early 2030s, set up an MRO and bring that capability in-house so that we don't have to send our engines around the world and have them wait for months on end to get trued up and be brought back to the country.
If I were to ask you to distill for me the biggest learnings in the last 20 years, because, forget all of the recent challenges, you've run a lean, mean operation, and you've managed to do so while making money, which has not been usual. It's been unprecedented, especially in the Indian aviation market. Distill for me what you've been able to do differently, things that you would take forward as you start your third decade, things that you would perhaps now drop because they may have, expired their utility date. If you could run me through that.
I think the anchor of Indigo's success has been cost leadership, and we have been relentless about that, and that's something that we will always hold very fiercely to. That's been the core of our success in the past. It will remain the core of our success in the future. And I think something I said to you earlier, the heart of the business, which is really India and the near region, where we offer a simple, sometimes an all economy, most of the time an all economy product. In some sort of metro to metro markets, we have a differentiated product, but that will remain fundamental to our future. And then we'll experiment flying, going international, and making, trying to make two ends meet with sort of growing globally.
On-time performance was really the premise as far as Indigo was concerned when you launched. As you look at broadening your offerings, as you, of course, now moved into stretch and the business class offerings and so on and so forth, from a customer's point of view, what will be some of the other big changes that the customers can expect in terms of experience?
It's something I keep saying internally to the organization. I've just been there for the last sort of 4 odd months, but I think there are two things we need to focus on. One is to focus on the external customer, and I'll explain to you what I mean by that. And another thing is to focus internally at the organization, and that speaks to what I call the cultural reset. Externally, my view is that, and this goes back to this whole narrative of Indigo has a footprint which is much too large. We need to be able to. The endeavor should be that people should want to fly Indigo out of choice, not because they have to. And I think that's a message that's internal to the organization, that we just need to make sure that we are evolving from a customer service standpoint, where people wish to fly us because they truly want to, as opposed to because they have to. And I think the same ethos goes internally, where I think the company needs to have a cultural, basically a cultural reset, where people choose to come to work because they enjoy it, not because they have to. And I think if you can make these two things come together, you will win.
Well, Rahul Bhatia, it's been an absolute pleasure. Thanks very much for speaking to us. We wish you the very best of luck and appreciate your time today on CNBC TV 18.
You have a good trip.
Thank you so much.
Thanks.
Well, with that, it is time for us to wrap up this edition of On the Record. From all of us here for now, thanks very much for watching. We'll be back again. Till then, goodbye.
today this is the only wearable which actually integrates all 4 pillars into one. So most of others focus on one pillar.
Okay.
Like they will do sleep. Somebody will focus on fitness. We realize sleep, stress, fitness, and nutrition. All 4 are important. So in fact, some people tell us that it's so accurate. They go back at the end of the day, check their day, and say कि किससे मिलना चाहिए, किससे नहीं मिलना चाहिए. Who should I spend time with?
Who caused the maximum stress in the day? Yeah, that's true.
You can't change behavior by telling people, I put a coach in front of you, I'll ask you to go to the gym and they should do that. That is where this came into picture. When people look at their own data, they want to make a change. And once they make a change, they want to make more changes. When I see somebody wearing a ring, I feel happy as a founder, but I also know that they're thanking us for improving their health. The most stressed hour in the day was youthful, trustworthy. Ranbir really fit the bill. And I actually proposed to Ranbir that come on 70% equity and 30% I'll actually give cash. Ranbir said, no, I want 100% equity and I want to invest in the business. The early diagnostics and tracking market is supposed to be around 63 billion by 2030. These are massive numbers. I think it's exciting times in India where, let's say, Gabbett, Temple, we're actually questioning and building for better health.
Seeing Cult as a listed entity.
So great for the ecosystem. I think it's a great milestone for Cult. I think they have a massive network now. So it'll be great for the industry.
Kunal Shah is an investor as well, heading WhatsApp. What was that like?
When Indian founders get attached to this global network, there's so much better that we can do. People gift Gabbett a lot, like the gift of health has picked up a lot, which I love.
So you're replacing mithai with the ring, is it?
This is great. We might be at a point where we can actually say, you might have a risk of a X disease 5 years from now. Please go to a doctor today, or please get this screening done, or do something about it.
Do you want to live forever?
If I can live healthy, why not?
The next breakthrough in healthcare may not be something you swallow. It may be something you wear, powered by data and worn on your finger. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Preventive healthcare is fast emerging as one of technology's biggest opportunities. Smart wearables, AI-powered diagnostics and longevity platforms are redefining how he took Zomato to its IPO and then decided to start up himself. Gabbett is an integrated health platform that spans wearables, diagnostics, AI coaching, nutrition, and now even skincare. Its smart ring tracks over 150 biomarkers, while its AI platform turns that data into personalized health recommendations. Backed by Norvest venture partners, Dipinder Goyal, Kunal Shah, and celebrity investors like Ranbir Kapoor and Badshah, Gabbett is now positioning itself as much more than just a wearable company. So, can India build a global health tech champion? Can AI add healthy years, not just years, to our lives? And what does it take to build a full-stack longevity company from India? Joining me now is the founder and CEO of Gabbett, Gaurav Gupta. Gaurav, great to have you join us here on Young Turks Reloaded. Let me start by talking to you about how Gabbett came about. You know, you were pitching food to people, courtesy Zomato, getting them to indulge in all their cravings, and then you decided to go healthy on us. How did that happen?
Hi, Shireen. It's good to be here. Thanks for having me here. I was building Zomato, and this happened due to COVID. So for the first time in COVID, travel stopped for me. I used to travel like crazy before that, consulting, Zomato, all of that. And because there was no travel, I fell into a good rhythm of working out regularly, playing tennis regularly, eating better food, sleeping at home, not on flights. And my health dramatically improved. I lost like 15 kgs of weight. Metabolically, I was 49 when I was 39. Now I'm 36 when I'm 45. So this was an awakening for me. I said, this is magical. Like all these pillars of health that we talk about, fitness, nutrition, sleep, and stress, is just magical in terms of what you can do. And I said, at the right time, I'd like to build a mission which can do this for millions of people.
But how are you tracking your own health journey through COVID?
Oh, through COVID, I wasn't tracking anything, to be honest. I was just like doing what, all these things were happening to me. So tracking was not a part then.
Okay.
Yeah, and then after the IPO, I felt this was a good time. And then I actually spent a year figuring out how to build for this mission, because before that, it was just my journey. And when I got deeper into it, I realized besides the fact that these 4 pillars are interconnected, they feed off each other, which is magical. The other important part is that if you think about bad habits, you get a kick right away and you keep doing it. But in good habits, results come after, let's say, weeks and months.
Yes,
how do you keep
delayed
going?
gratification.
Exactly.
Yeah.
So you need some trigger to keep you going. And that's where I realized tracking is super important for that. And above all, first principle, you can't improve something that you can't measure. So that is when I realized that.
But you did improve something that you didn't measure.
But I didn't know how much I improved at that time. I could have done even better. And I think, of course, there are two parts to this. One, you know that you're changing, right? For example, your weight will start coming down, your fat percentage will start coming down. But how much is coming down? Is it in the right direction? I think for that, you need that. So, of course, to make change, it's not that you don't need it. But to actually keep optimizing, you need to know something better. And as I said, it's not just about measuring. It is about the trigger. Oh, I increased my view to max by 1 point. Amazing. Like, can I do more? Because those results you will start seeing faster than some of the other results that are not measurable.
But consumer change, especially behavioral change, is a hard game and it's a long game. So what was the thesis that you walked into with?
So very interestingly, so if you look at most health plays till now, or like playback like last 10 years, it's all been about fitness plans, nutrition plans. So if you look at human psychology, what we're saying is, you give me money, I'll give you pain. Because changing food is pain. Going to the gym when you're not used to is pain. It doesn't make sense. I think that's what we uncovered, that this is not the way to address health. You can't change behavior by telling people, I put a coach in front of you, I'll ask you to go to the gym and they should do that. That is where this came into picture. So now it's like buying a ring is like buying anything online. You buy clothes online, you buy shoes online, you just buy a ring online, or any tracker for that matter online. Put it on your finger. And when you start looking at your data, yourself, you actually start changing. And that is the motivation that gets people to change their behaviors.
What the differentiators can be for somebody like you at this point in time, where it's now getting increasingly competitive, and I would say in some cases even commoditized?
Yeah, so I think whenever you build a product from first principle in the right way, like when we started building Gabbit, people were like, why are you addressing all these 4 pillars? Why would not pick, like, because if you look at companies around you, some companies have taken sleep as a pillar. Some companies have taken fitness as a pillar. Some people have taken, like, say, calm, has taken meditation as a pillar. So we said, but health, good health comes from all these 4 together. So we said we'll combine all these 4. So even in the ring today, the reason the ring is also doing so well is not just because it tracks, there are all of the markers there, but it tracks all the 4 pillars. So it's probably the only variable which does a good job of all 4 pillars of health.
So let's talk about building it, you know, getting the data together, looking at what foundational models to build this on. Take me through that process.
So it took us 2 years to build this. And I think one, we had to come to the right form factor. So we said, okay, so it's step by step, right? So we realized tracking is important. 90% people can't sleep with a band or a watch in their hand. They feel constrained. So then bands and watches were out. So we said, okay, ring makes sense. People are used to wearing rings. We could actually bolt on 10 days of battery on this. People are inherently lazy. We want the most, like the most outcome from the least effort. So people hate, the biggest reason people stop using their wearables, they hate to charge their product. We said, okay, then we have to work on battery life. Accuracy is important. Accuracy is hygiene. But I think if we improve the battery life, more people will use it, more people will adopt it. So I think it came from there. Took us 2 years to get to a point where we could build something. Of course, initial algorithms were built just on our team and everything. And then, of course, more users came in and made the algorithm better. So I think our users have also contributed to making the product better. And the last thing on this, I would say, is that it's not just about data. What we also realized was people are not looking for data. People are saying,
how do I use this data? What do I do with it?
With it? So that's why Gabbit has always been designed to not be a wearable company or a ring company. It's been designed to be an ecosystem. Where ecosystem, I mean that you come here, you get what you want to improve your health. Starts with data and not just wearable. So we have wearable data through the ring. Then we got blood tests you can do on Gabbit. So you can actually track 115 biomarkers just from blood tests in addition to the ring. Then there is CGM, continuous glucose monitoring, because that's important to track. And there is a smart scale for body composition, fat percentage, all of that. And now we built an AI engine, to your point about combining both, where Gabbit 1, we call it Gabbit 1, it looks at all these 150 plus markers and really tells you what are the 3 things that are really hampering your health, what are 3 things working well for your health, and hence what are the 3-4 things you should work on.
You know, getting investors on board, how hard, how difficult, how challenging was that?
So honestly, because of what we have done at Zomato, Our seed investment was done by Norwest Venture Partners. It was not so difficult. What was important for me, again, was that we wanted believers and the right partners on board, and Norwest has been great partners. More interestingly, we actually got people like Ranveer on board as an investor. And I think that's
How did that happen?
So that's also a funny story. So I think we wanted a brand ambassador where people can relate to someone. And we wanted somebody who's youthful, trustworthy, honest. Ranveer really fit the bill. So reached out. And of course, the discussion started like a normal endorsement deal. I said, I don't have that kind of money to give you. I'm a first-year startup. And we met. We met for 2, 3, 4 hours and hit it off really well. And I actually proposed to Ranveer that come on 70% equity and 30% I'll actually give cash for the deal that we're doing. Ranveer said, no, I want 100% equity and I want to invest in the business. So he's a total believer. So I think having him, having Badshah, we also have Madhuri Dixit, Dr. Nene on board.
Yeah.
So I think it's just been great to have such trustworthy people who actually believe in the brand, talk about it.
Take me through what you've been able to do in terms of sales at this point in time, but what you believe the next 5 years could potentially look like as people become much more aware of their own health journeys.
If you just look at the overall preventive health market, that's supposed to be close to like $540 billion in India in the next like 2030. Interestingly, within that, the early diagnostics and tracking market is supposed to be around 63 billion by 2030. These are massive numbers.
Yeah.
Of course, they have multiple components built into it. And even wearables alone, smart wearables alone is supposed to be around $10 billion by 2030. So I think from an overall market opportunity, I think there's a lot of opportunity. People are getting more conscious. So they're close to like 150 million plus like health conscious individuals who actually some dimension of their life, they think about health and do something about it. So I think there's huge opportunity. But what is important here is not just the opportunity, but what you offer to this opportunity. So before Gabit came into picture, a high quality wearable, which was accurate, you actually had to shell 30,000 rupees and sometimes even pay subscription on top of it every month. So we were able to come up with something which is around 15,000 rupees, no subscription. And people were like first shocked that you're giving a high quality product and at half the price. How is it possible?
How did you do it?
So we said, okay, there's no point launching a ring for 30,000. It has to be as low as possible. Even 15,000 wasn't a number, right? And we said, okay, let's work backwards to say where is the lowest we can get to while delivering a high quality outcome. Put a great team together and spend like 2 years doing that. It was not like a 6-month thing and just like launched it. So I think it was all about that. And I think once we got all those 4 pillars in, we got a 10-day battery life in, an affordable product with no subscription in, and once started people using it, they're like, wow, this is great. And it just took on from there.
So, between the wearable as well as the entire ecosystem, what are we talking about now in terms of revenue and, what is the visibility that you have as you build the business out?
So we are right now probably the largest smartphone player in India right now, growing at 150% year on year. We have lakhs of customers, lakhs of happy customers whose health is getting better. In fact, a lot of customers, once they buy it, their families actually buy it.
What is the ambition now as far as this ecosystem is concerned? I mean, are there boundaries? Are there areas where you will not venture into? Or at this point in time, there's lots of exploration on about what could be allied services, allied areas that you could potentially get into.
Today, we are very focused on now growing this ecosystem, which is an ecosystem of tracking and then aided by supplementation. And supplements were also on the cards. Either we would have done it ourselves or we would actually got the right partners to do it. And I think I came across a brand, I had it, and I'm saying, who's making this kind of protein? I need to meet this team. So came out to be Swedish team, building for some reason products for Sweden and India, because the founder was actually married to an Indian guy, and got them on board, and then basically started the supplements journey. But the idea is to actually make sure that we get India to be more healthy, move more, sleep better, eat better, and be more mindful. And I think more importantly, get in the habit of tracking. Today, we don't track ourselves. And I think tracking not for the sake of tracking, tracking not to say, look at your steps every day, but actually understanding what's happening inside your body. So for example, getting a blood test done every 3-6 months is a good practice. Just knowing what's happening. If you're taking supplements or you're planning to do supplements, figure out where you need supplementation. Just because somebody spoke about it, might not be relevant for you. Like for example, when I started taking my vitamin D, in 2 months I got to toxic levels from being underserved for vitamin D, because my absorption for vitamin D is very different. And then it's like, I need to track this. I need to have a blood test done to figure out once in a while. So I think those are things we are focused on, and we want to grow this too. And the best part about all of this is, like, while I build this, I'm getting healthier, my wife's getting healthier, parents are getting healthier, team's getting healthier.
Is the balance sheet getting healthier as well?
That also. So we are actually CM3 positive now. So we now are at a scale, and this is very early in our business, where we just have to cover for corporate costs. But we are actually making money at a unit economics level, covering marketing costs, everything. So yeah.
What's the competitive landscape like for you? I know that you now have the OpenAIs and the Claudes of the world offering medical advice, which people are very happy and willing to take and trust. So in this mix, how do you position yourself?
So yeah, so one, I think, we compete with wearables alone as well. And I think there also, it's all about making the product more affordable, easier to use, and better quality. So I think, so that's what we've done with the smarting, and that's why it's done well. So we got the Best Smarting of the Year award by Amazon in 2025. So that is a cornerstone of building what we're doing, and the fact that we have all the 4 pillars on the ring. It has 10 days.
And that's the customer acquisition channel.
Yeah, this has become a customer acquisition channel. So people get excited with this, they love it, and they start with this, and they get into the ecosystem. And once they get into the ecosystem, they realize, oh, Gabbett has a much larger ecosystem. So then they take on supplements. If there's some customers who bought the ring, have come into the ecosystem, and now in the next few months, they've actually bought more worth of supplements from us than they've actually spent on the ring. Because again, once you start with supplements and it's helping you, that's a monthly recurring revenue. So that's pretty much the business model that we're operating on. And that's what we want to expand.
We're now in a situation where Dippy, who's an investor in Gabbett, has also decided to go on his own health journey with Temple. Of course, he's designed something around brain flow and come up with something called entropy. Are you tracking that story?
Yes, of course. I think he's also taking a very strong and a bold take on health, which is about blood flow to the brain. And I think it's exciting times in India where, let's say, Gabbett, Temple, we're actually questioning and building for better health. In India. So, and I think in any market, for example, when we started food delivery, 2015, people used to laugh at us that you're telling us that anybody in India would download an app, order food from an app, and order food for 200, 300 rupees. You will deliver it dedicatedly and you'll make money on it. Till 2018, 19, people were just laughing at us. And today's behavior. And a part of the reason that happened was because 2 players didn't give up, Zomato and Swiggy, and pushed the envelope on it. I think the same thing will happen on health now. So when Zomato is already large or Gabbett becomes large, I think the mindset of a new day startup where you're agile, you're still paranoid that somebody tomorrow can topple you, I think is super important.
How do you stay ahead of the curve? What is the market telling you in terms of what is already happening, but more importantly, where this journey is likely to head? How do you sort of cater and anticipate to those changes?
Oh, so you have to have a learning mindset all the time. And when I say learning mindset, it's not just about my personal growth. It's also about what's happening in the industry, where this is moving. And you also have to keep a close eye of what people are asking for. So just to give an example, like this is not just there to track your sleep. is not just there to track your calories. It is actually there to, so this exactly knows when my heart goes out of rhythm. It's super powerful.
When does your heart go out of rhythm?
A lot of times, right? And because it happens, you can, if you just now look at all this data, and with the power of AI now, I think in the next 1 or 2 years, we can predict so much about somebody's health and what might happen in the future. We might be at a point where we can actually say, you might have a risk of a X disease 5 years from now. Please go to a doctor today, or please get this screening done, or do something about it. I think that's where this is headed, and that's going to be revolutionary. So,
are you moving in that direction?
yes, we are moving in that direction. In fact, we're actually partnered with some global institutes. We have a cardiovascular doctor from Harvard on a scientific advisory council, and we're working on using this data and AI on actually predicting important health outcomes much before they happen.
Yeah, I don't know if you saw the viral Devi Shetty video, which has been doing the rounds over the last 24 hours, where he's talking about how everybody, even as early as 17, should get their blood tests done. How do you ensure that you give customers actionable insight, actionable advice?
I'll give you an example. So when I did this on myself, Gabbard 1, which was like 3 months back, it said, you've increased your workouts drastically over the last 4 months. I had done that because it can track that. You have reduced your carb intake dramatically in the last 4 months. And I can see this as stress on your pancreas in your blood report. Can you please stop doing these two extreme things at the same time? Now, that is very actionable. I can't think of anybody in this world who could have told me, except for, let's say, Gabbard right now. I think that's what we're trying to do. So when we introduce a test or something as an offering for customers on Gabbard, we're very mindful of two things. One, it has to be, of course, accurate, but it also has to be deterministic to give you some action. And of course, we also try to make it affordable so more and more people get into that habit of doing it.
What are the interesting things that India is doing on the back of the data that you've been able to collect? When are Indians most active? When are Indians most stressed out? When are Indians the happiest, where their heart rate is telling you a different story? I mean, what's the data telling you?
Interesting. So the most stressed hour in the day, surprisingly, and I don't know the reason why, is 9 p.m. at night.
They're watching the 9 p.m. news.
Maybe it's that. I don't know. I was very surprised to see that.
Yeah, I would be very surprised because I would have thought that 9 p.m. means you're back home, you're unwinding, you're getting ready to put the day away.
Yeah.
But perhaps it's also anticipating the next day, and maybe that's causing the stress.
I don't know, but yeah, that's true.
So 9 p.m. is
9
the most stressful hour on the back of the data that you have for Indians.
Yeah.
What else?
The most workout done on Gabbard is, of course, walking by far. And that's another problem, right? Like out of all the workouts done, almost like 53% is actually just walking. But the next one is actually surprisingly strength training, which I'm very pleasantly surprised with. That
Have you seen an uptick in that more recently?
So over the last 2 years, we've seen this consistently, to be honest, not recently. The next one is actually HIIT, and the fourth is yoga. So I was actually pleasantly surprised by second and third, because just from that perspective, like even HIIT is very good for you. Like people don't understand this. Like people who have great skin, people who have great health, they actually do fitness regularly. Because it's all connected. It builds and breaks collagen in your body. So yeah, these are some of the other interesting insights from data that we've seen.
We've got Cult heading to the Lal Street, and this is going to be one of the new listings and very different from the IPOs that we've already seen from the Indian startup ecosystem. Seeing Cult as a listed entity, what do you believe that could mean as far as this health ecosystem is concerned?
So great for the ecosystem. I think it's a great milestone for Cult. I think they've actually, of course, changed the game on how people think about gyms and going out to gyms and for fitness. I think they have a massive network now. So it'll be great for the industry. And I think more and more players need to come into the industry, innovate in the industry, and push the envelope on products which can actually help customers. Either it's on the tracking side, either it's on the supplement side, or it could be anything else that people actually come up with. So I think, that'll be good.
Kunal Shah is an investor as well. Now sitting in the valley, heading WhatsApp. What was that like, getting Kunal on board?
Oh, it was great. I think we had a chat, and it was a very quick chat, and he was convinced of what we were doing, and he came on board.
Does he wear it?
So he's actually changed his health quite a bit.
Yeah.
I'll have to check with him whether he's wearing it or not right now. But super excited with what he's going to do in the global stage now. And I think it's great for India as well. I think, and that's what, like when Indian founders get attached to this global network, there's so much better that we can do. Right? For example, we are learning a lot from people that we understand globally in health and what we can do.
So what is the AI journey, or the next chapter of the AI journey, going to mean as far as Gabbard is concerned?
It's going to be around predictive health. I think from almost like the first few months of getting this in people's hands, I understood that this is not just about sleep tracking. It is much more than that. So I think using for, let's say for an individual, let's say for you, if we take all your data and put AI on top of it and ask the question saying, what do you predict will happen in the next 5 years and what should we take care of today? I think that's going to be game changing. And I'm very excited about that.
And how soon do you believe you're going to be able to be ready to have an authoritative answer on that front?
In the next 12 to 18 months.
12 to 18 months?
Yeah.
Okay.
Yeah.
So the work is underway?
Yes.
And what, there's 70 odd people today working on Gabbit?
Yeah, 70 odd people working today at Gabbit, a lot of AI agents working at Gabbit. AI plus people is a magical combination. It's a very dominant force. It's not just AI, it's not just people, but put together, I think it's amazing. And that's what we've done in the last 1 year at Gabbit. And that's why with such a small team, we've scaled the business so much and the P&L is also looking so good because we are actually making sure that we're able to use the power of AI for customer experience, for even sales and some of the other functions that we've tried.
From IIT Delhi to where you are today, what is it about IIT that has given the Indian startup ecosystem the kind of heft that it has?
I think it's just the mindset to not give up, to be honest, and do something ambitious and just not give up. Like building Zomato, going through the food delivery journey was not easy. When everybody around you is telling you this is not possible. Like even Gabbit, when we were building it, people were like, why are you building an ecosystem? Why are you doing all 4 pillars together? Why wouldn't you just one product? But I said, health has to be addressed like this. And now we're seeing the benefit of that. Like people are loving Gabbit One. People are coming together. They're actually preferring Gabbit because it's an ecosystem, even compared to some global players. So I think not giving up and being like really believing in what you want to do. And just that drive, I think is what, and I don't think it's IIT, to be honest. I think any person who has that will actually go through and make it happen.
You think that we could see an Indian company like Gabbit, like Temple, etc., make it on the global stage, take an Indian consumer product global?
Absolutely. Absolutely.
We're at that inflection point?
Yes, we are at the inflection point. Like this kind of innovation is coming out of India. We are at the inflection point for sure. And they call it like the combination of hunger and smarts that we have as a community, I think is amazing for us.
So when do you believe we're going to see that breakout moment?
I don't know when, but we'll definitely see it in the next few years.
Well, we wish you the very best of luck with Gabbit. Thanks so much for stopping by on Young Turks Reloaded. We wish you the very best of luck with your health journey, and we hope that a lot of Indians who are on Gabbit are certainly going to live healthier, happier lives. But thanks very much for joining us here on the program.
Thank you so much, Sherry.
Well, with that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, we'd like to hear from you. Send us your feedback and your comments. Till next week, from all of us here on the team, goodbye. Thanks very much for watching.
Hello and welcome to India Business Hour. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you at this hour. Crude oil prices jump as US and Iran resume attacks after a brief pause. US claims to have prevented a surprise missile attack from Iran and joins forces with Saudi Arabia to target Tehran-backed militia in Iraq. At least 20 killed in joint airstrikes by US and Saudi.
There will come a time at some point in the future where we will once see the airport hubs sort of mature, where we will carry customers from one geography to another through India.
Indigo gets ready for a decade of international expansion as the airline clocks its 20th anniversary. MD Rahul Bhatia says India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines.
We keep getting badgered on our size and scale. Like I said, what is not understood is what we are doing, which no one else is doing.
Rahul Bhatia responds to critics raising alarm over Indigo's overwhelming market share, says 1/3 of Indigo's network are unique markets that no one else flies to, credits their cost leadership for their size and scale. U.S. government moves a step closer to imposing 100% tariff on Russia's trading partners, including India and China. Senate votes overwhelmingly to advance the new Russia sanctions bill in a rare bipartisan move. One of the authors of the bill accuses India and China specifically for fueling Putin's war machine. Asian Paints beats estimates in Q1. Profit rises 40%. Margins expand by over 200 basis points. FMCG major Dabur meets estimates in Q1, even as volume growth falls short of expectations. Supreme Court quashes a 2021 government memorandum allowing retrospective environmental clearance to projects that commenced without obtaining one. Government retains the power to issue retrospective clearances, but only through a valid notification and not through an office memorandum. Lok Sabha passes a new bill proposing stricter punishment for exam frauds. Government and opposition clash in Parliament after Rahul Gandhi accuses Home Minister Amit Shah of ordering the police action on student protests in Delhi. BJP denies the charge and demands an apology. Delhi police asks Elon Musk's social media platform X to remove abusive social media posts against Prime Minister Modi made during the student protests, seeks details of the accounts that posted this content, including full name, address, email, and contact details. The death toll due to floods in Assam rises to 75. More than 3 lakh people remain affected across 7 districts, including over 600 villages. More than 32,000 people take shelter across 82 relief camps. Maharashtra's new food safety regulator turns the spotlight on schools, says all canteens will need proper FSSAI licenses, bans the sale of junk food in the 50-meter vicinity of all schools. FIFA's plan to sell stake in the World Cup to private investors draws widespread condemnation across Europe. The continent's football authorities and the English Football Association express grave concern. The top story this evening, oil prices surge after Donald Trump warns that the U.S. will hit Iran hard as war resumes. Here are the latest developments. President Trump told Fox News, and I quote, "They are going to get a beating," end of quote. President Trump also claimed that the U.S. forces coordinated with Iraqi government before responding to the attack on U.S. bases in the Gulf. The U.S. president was referring to Iran's attacks on American air bases in Jordan overnight, which were intercepted. The Iranian Revolutionary Guards also said that it has struck and stopped 3 vessels in the Strait of Hormuz overnight. According to a report on Wall Street, U.S. officials believe that IRGC is actively trying to undermine negotiations to renew the ceasefire and reopen the strait. Soon after, U.S. and Saudi Arabia struck parts of Iraq that are allegedly being used by Iranian proxy groups. Saudi Arabia said that the strikes were in response to drone attacks on its oil facilities. This is the first time that U.S. and Saudi forces have coordinated to launch an attack in the region. This comes as Israeli Prime Minister Benjamin Netanyahu met with U.S. President Donald Trump in Washington. This was the first time that the two leaders met in person since the start of the conflict in February. The Israeli Prime Minister told Fox News that the meeting was one of the best he has ever had with Trump. Oil markets surged as Brent crude prices hit the $90 per barrel mark. As per ship tracker Kepler, 39 ships have transited through the Strait of Hormuz as of the 28th of July. According to a Reuters report, Iran has ruled out Oman's proposal for joint management of the Strait of Hormuz.
How'd that meeting go?
It was great. It was one of the best meetings that we've had. And I always hate to disappoint our would-be critics who are trying to find, cracks in our alliance. And what they find, like today, is a wall of granite, because the president is so clear. I mean, we have a common commitment. We don't want to see this fanatic regime in Tehran have nuclear weapons to threaten every American and to threaten the peace of the world and to threaten the existence of Israel. So we have a common goal, and it's going to be achieved either through diplomatic means or other means.
The US government moved a step closer to impose 100% tariff on Russia's trading partners, including India and China. The US Senate voted overwhelmingly to advance a new Russia sanctions bill in a rare bipartisan move. One of the authors of the bill accuses India and China specifically for fueling Putin's war machine.
It's carefully crafted to make sure we are not hitting our allies and that we are hitting China and India. Let's be really blunt. China and India are the main culprits here. They purchase the vast majority of oil and gas. They are fueling Russia's war machine, and they are doing us no favors anywhere else in the world.
At least 15 sailors, including 13 Indians, are trapped aboard a cargo vessel at a Ukrainian port amid drone and missile attacks. The Forward Seamen's Union of India shared a video purportedly recorded from the ship and warned that the crew is caught in a terrible and life-threatening situation. The External Affairs Ministry has said that the government is in constant touch with concerned authorities to ensure safety and security of the Indians on board. To the market action of the day, Dalal Street started the new series on a positive note. Nifty gained over 1% to close firmly above the 24,200 mark. IT stocks led the up move, with that index clocking 8% gains this week alone. While the broader markets underperformed the blue chips, both the Nifty Bank and the mid-cap index ended 0.8% higher. The U.S. Federal Reserve is set to announce its interest rate policy decision tonight. According to a CNBC Fed survey, Wall Street does not expect a rate cut. 57% of the respondents see one or more rate hikes through June 2027. However, 23% still expect no change in interest rates. And you can catch the Fed policy decision right here on CNBC TV 18 from 11 p.m. onwards tonight. The Finance Ministry has warned that the conflict in West Asia remains a downside risk to economic growth. In its monthly review, the ministry said a sustained surge in crude oil prices could add pressure on inflation, fiscal deficit, and the current account deficit. It also said swifter policy responses and effective implementation are crucial to attract both domestic and foreign investment. The big interview of the day, from a low-cost airline to now a dominant force in the Indian skies, Indigo's 20-year journey is one of resilience and cost efficiency. Now the airline is betting big on global expansion. In a rare television interview with Shireen Bhan, Bhatia said India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines. He also responded to critics raising alarms over Indigo's overwhelming market share. Bhatia said 1/3 of Indigo's network are unique markets that no one else flies to.
1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in, we only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure. We are able to experiment, and the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing.
As you look at expanding both domestically as well as internationally, what changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
I think Indigo's journey over the last 20 years was all about building an extensive domestic network. We are not finished doing that. We will continue to do that. That will remain the core of the airline. But having built this network, the next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India. And that's something which, for reasons I probably prefer not to discuss, was handed over to airlines and geographies outside of this country. With that, there was a lot of export of economic wealth from this country to airlines that don't reside here and were carrying Indians. I think there's an immense responsibility on our part as Indigo and on the part of airlines like Air India to bring all of that back. So that's our sort of next step. And I think we are well positioned to do that just because of the domestic network. We're able to collect people into a hub and then fly them on bigger planes to other parts of the world. So that's really what we want to do as stage one. And there will come a time at some point in the future where we will, once see the airport hubs sort of mature, where we will carry customers from one geography to another through India. They don't necessarily have to be our customers, but I'm taking an example, somebody from the UK to Australia. I think once we build our network and once the airports are transit friendly, we constantly, the industry always gets, again I use a word and you'll hang on to it, hammered for airfares. And this again something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines, has gone up. And this is, the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
The possibility of airport operators being able to run own airlines themselves, this is not the policy at this point in time, but we're given to understand that this could be up for review, that the Adani Group may be looking at getting into the airline business. You've gone on record to say that that would amount to a massive conflict of interest. Now, explain to people who are watching why you believe that to be the case.
I said what I said last week, and I'll give you several examples. So if you have an airport operator who controls slots, gates, parking spaces, movement of aircraft, and they actually end up having an airline, there is conflict of interest. Other than these city-states where there's common ownership of an airport and an airline, there is no example in the world where an airport is owning an airline or vice versa, and for good reason. And there are countries where there is no ban on airport operators owning an airline, but there's enough regulation behind it which ensures that there is a level playing field. As recently as this West Asia crisis, we have all seen that in Dubai, Emirates flew its full complement of flights into India. No Indian carrier could fly into Dubai. And the only reason they could pull off this stunt was that the airport and the airline is owned by a common shareholder. It's completely uncompetitive. But the reality is it happened. And it's happened not once, it's happened in the past too. They had an incident some years ago where the runway was blocked for a long period of time. And the only airlines that could fly in and out of Dubai was Emirates. Everybody else was shut off. The investment into airlines in India is completely open. People can come in. I think it's one of the most friendly policies in terms of starting up an airline. There's no barrier to that. people can come in and do what they have to do. But to have airports start an airline, I just think is a fundamental issue.
A quick check on the earnings action of the day. Adani Enterprises has reported a net loss of over 1,100 crore rupees in the first quarter. This is in comparison to a net profit of 885 crore rupees that it had reported during the same quarter last year. The net loss for the quarter is due to a one-time loss of over 2,600 crore rupees, which it paid as a settlement amount to the U.S. Office of Foreign Assets Control. Revenue grew 50%, while margins narrowed by over 400 basis points on an annual basis. Asian Paints has reported a strong set of numbers in the first quarter, beating estimates on all parameters. Net profit jumped nearly 40% year-on-year, comfortably ahead of the CNBC TV18 poll. Revenue grew 18%, also topping estimates. The paint major's decorative business posted healthy volume growth as well. FMCG giant Dabur's first quarter results came in largely in line with estimates. Net profit rose over 15%, while revenue rose nearly 11% on an annual basis. Margins held steady at 19%. However, domestic volume growth of 5% came in below estimates. In global earnings action, Procter & Gamble's quarterly profit fell as higher costs and sluggish sales weighed on its bottom line. The Pantene shampoo maker also gave a soft outlook for the current fiscal year, forecasting profit and sales below Wall Street's expectations. CEO Shailesh Jejurikar said the company expects continued volatility in the coming quarters. In a statement, the company also said Jejurikar has been appointed as the chairman of the board of directors of P&G. Lok Sabha has passed a new bill proposing stricter punishment for exam frauds. Government and opposition clashed in parliament after Rahul Gandhi accuses Home Minister Amit Shah of ordering the police action on student protests in Delhi. BJP has denied the charge and demands an apology.
Sir, the Home Minister authorized the shooting of our students, sir. He put pellets into the blood of our students. He ordered the students of India to be shot.
किस तर्क के साथ आप ये बयान दिया है, ये बहुत गलत बात बोला है राहुल गांधी जी, बहुत गलत बात बोला। मैं इसका आपत्ति करता हूँ, कार्रवाई से निकालना ही चाहिए, लेकिन राहुल गांधी जी आप माफी मांगिए, ये ठीक बात नहीं है।
कहीं भी गोली चलाने का आदेश कोई मंत्री नहीं देता, वो मैजिस्ट्रेट देता है, एसडीएम देता है, डीएम देता है। दूसरी बात, ये बार बार स्पष्ट किया गया कि गोली चली ही नहीं, अश्रु गैस, टीयर गैस का इस्तेमाल हुआ, लेकिन जब गोली चली ही नहीं तो आदेश देने का सवाल ही नहीं पैदा होता।
Delhi police asked Elon Musk's social media platform X to remove abusive social media posts against Prime Minister Modi made during the student protests. Seeks details of the accounts that posted this content, including the full name, address, email, and the contact details. The Rajya Sabha has passed the Prevention of Insults to National Honour Bill. The legislation makes insults to the national song Vande Mataram a criminal offence and places it on par with the national anthem. The bill expands the scope of the existing law to include acts such as intentionally obstructing the rendition of the national song or causing disturbance during its singing. Those found guilty could face up to 3 years imprisonment. The Supreme Court has quashed the Centre's 2021 office memorandum that allows retrospective environmental clearances, terming it illegal. The Apex Court also restricted the Centre from issuing administrative orders, granting blanket permission for retrospective environmental clearances. However, it clarified that provisions for such clearances could be introduced through a formal notification. The Supreme Court has closed the criminal case against former Prime Minister Manmohan Singh in the coal block allocation scam case. Nearly 2 years after his demise, a special judge has accepted closure reports filed by the CBI. The case pertains to the alleged irregular allocation of a Talabira 2 coal block in Odisha to Hindalco Industries during the UPA government's tenure. The flood situation in Assam remains grim. The death toll in the state has risen to 75 and more than 3 lakh people remain affected across 7 districts, including over 600 villages. Over 32,000 people have taken shelter across 82 relief camps. The state government has increased ex gratia assistance for families of flood victims to 9 lakh rupees and relaxed compensation norms. Coming up on India Business Hour, FIFA's plan to sell stake in the World Cup to private investors draws widespread condemnation across Europe. Details in just a bit. Stay tuned. And you can also catch all of CNBC TV 18's news and updates on Facebook, YouTube, Instagram, X, and Geo Hotstar. Do subscribe to CNBC TV 18 Access for exclusive stories. Welcome back. You're watching India Business Hour. Tukaram Munde-led Maharashtra FDA continues its food safety crackdown. It has issued new directives mandating that all school canteens, hostel kitchens, midday meal contractors and Anganwadis obtain an FSSAI license to operate. That's not all. Under the new rules, items with excess fat, trans fats and high sugar content are prohibited from being sold or advertised within school premises and their immediate surroundings. My colleague Santya caught up with Munde, whose crusade against food adulteration has drawn attention in the last few weeks.
These regulations have come into existence in 2021. The objective is to provide balanced diet to the children as per their needs, which requires proteins, fibers, calories, macronutrients, micronutrients. And these dietary needs of school children are decided by National Institute of Nutrition, and on that basis, regulations have been framed by Food Safety Authority of India. These have been in place since 2021, and we need stricter implementation and better compliance from the schools. This order we have issued a day before to ensure that compliance is done by the school, because there was some hesitancy and confusion about the roles of different institutions and individuals. The primary role of implementing and complying with this regulation lies with the management of the school, principal and the management. Along with that, school education department, concerned boards of the schools to which they are affiliated are also responsible, and parents, and of course comes the role of FDA.
What about schools which are providing food themselves, because you said that it could lead to de-affiliation from the board as well?
Yes. So where the vendors are not separate, school themselves are the vendor, they need to be registered with that. That is the first requirement. Then, if the schools do not implement it, boards can act against them by de-affiliating also, because all boards are covered.
FIFA's plan to sell stake in the World Cup to private investors has drawn widespread condemnation across Europe. The continent's football authorities and the English Football Association expressed grave concern. Matthew Thomas explains what the plan entails. Matthew?
Well, FIFA has stunned the football world with plans to seek private investment in the World Cup. The governing body was even forced to issue an official statement after reports sparked widespread backlash. Here's what's being proposed. FIFA wants to create a new company called FIFA Forward Enterprises, which would manage its biggest competitions, including the World Cup. If this is approved, the new entity would raise $4.2 billion from private investors. Based on a $20 billion valuation, that's equivalent to a 21% stake. FIFA insists it will always have control over the entity, as it will retain 79%